Namaste, Suprabhat, good morning, and because we are in the land of Maharashtra, आपले स्वागत आहे. महाराष्ट्राच्या भूमीवर स्वागत आहे. I hope I got that right. Good morning, ladies and gentlemen. Let's have some energy here. Thank you. मेरा नाम है गीतिका गंजूधर और ट्रस्ट ग्रुप की ओर से मैं आप सबका हार्दिक स्वागत करती हूँ, हार्दिक अभिनंदन करती हूँ. On behalf of the Trust Group, I welcome you all to the 5th edition of Trust Group's India Debt Capital Market Summit 2025. Put your hands together. Esteemed delegates, renowned sector experts, valued patrons, respected members of the press and electronic media, and dear friends of the Trust Group, we are so honored and so privileged to have your presence here with us this morning. Thank you very much for coming. Ladies and gentlemen, it gives me immense delight and pleasure to say how IDCMS has emerged and today stands tall as India's premium platform for India's top issuers and investors to engage and explore the dynamics of the Indian debt capital market. I'm from business school and my specialization was marketing, but over the last few years of hosting this summit, I can give all of you a run for your money with all the knowledge that I've gained over the years here. But on a serious note, immense gratitude to the Trust Group for putting their faith in me again and again. एक बार फिर से esteemed delegates, आप सबका बहुत-बहुत स्वागत, स्वागतम, अथ स्वागतम. Esteemed delegates, the India debt capital market in 2025 stands as a robust engine of breakout structural growth, driven by resilient macroeconomic fundamentals and a steadily improving regulatory landscape. As India pursues its goal of becoming the world's third largest economy, a healthy balance between growth and resilience in debt markets is pivotal. It's critical for attracting investment, especially for energy transition, managing climate change, powering infrastructure, driving adaptation of artificial intelligence, and of course ensuring sustained economic growth and development. This 5th edition of Trust's India Debt Capital Market Summit 2025 will highlight reasons for resilience, for growth, and for breakout of the market. Thought-provoking panel discussions and plenary sessions will take stage. This summit will provide a unique platform for market leaders, including banks, mutual funds, corporates, FIIs, pension and provident funds, insurance companies, and family offices. It is a day of value, value, and value at IDCMS 2025. Let's begin this summit with a powerful shloka for peace and unity from the Katha Upanishad. Om Sahana Bhavatu Sahano Bhunaktu Sahaviryam Karvavahe Tejasvina Vatitamastu Ma Vidhishavahe. Om Shanti, Shanti, Shanti. May He protect us, may He nourish us together, and may we acquire capacity to work with great energy. May our learning be brilliant and not contentious. Om peace, peace, peace. To open proceedings at IDCMS 2025, I'm now going to invite on stage Ms. Nipa Sheth, founder and director of the Trust Group, to please take the podium. With over 2 decades of expertise, ladies and gentlemen, she has truly been instrumental in advancing the fixed income space through pioneering transactions such as India's first CMBS, Basel III compliant Tier 1 and Tier 2 issues, and the certified green bond issue. It is under her leadership that Trust has earned multiple accolades, including Euromoney's India Best Investment Bank for DCM 2025, IFR Asia's India Bond House Awards, and Finance Asia's Best DCM House Domestic. She contributes actively to India's bond markets through her roles in FICCI and CII. Nipaji, please set the ball rolling. Ladies and gentlemen, it is IDCMS 2025. Please welcome on stage Ms. Nipa Sheth.
Good morning, everybody. It's great to welcome all of you back on IDCMS fifth one. A warm and a hearty welcome to Indian Debt Capital Market Summit Resilience Growth Breakout. It's an absolute pleasure to have you all here today. This theme defines not just our aspirations, but the active phases of expansions which are driving Indian economy and vital debt markets. We joined today by exceptional industry minds, and I extend a sincere welcome to esteemed panelists and our session moderators. Your collective experience and intellectual insights are the cornerstone of today's agenda, and we are grateful for dedicating your time to these crucial discussions. Your contributions will undoubtedly shape the future of our debt capital market. A special welcome to our audience, investor, regulator, market participants, and corporate leaders. Your engagement and curiosity are what make platforms like this meaningful. We look forward to your questions, interactions, and the energy you bring to today's sessions. This year's theme, Resilience, Growth, Breakout, captures not only the journey of India's debt market over the past few years, but also the opportunities ahead. Over the next few hours, we aim to dissect strategies that will turn resilience into sustainable growth and achieve the breakout momentum that will put debt market firmly on the global map. Over the last 3 years, we are seeing the change the Indian debt market has brought to the world, and we are seeing global investors participating in most of the issuances which we have. Our goal today is to create an actionable ideas and foster meaningful collaboration. With powerful agenda ahead, let's make this summit a memorable as the last one. Thank you, and let's get started.
And thank you for those words. Ladies and gentlemen, there are people who lead their journeys of life, and then there are people whose journeys of life lead people towards the land of collective growth and prosperity. The stalwarts Nipa and Utpal Sheth are two such leaders. They founded the Trust Group together, and over the journey of trust, they have not just built a solid, strong, and service-oriented organization, but along the way, they have made an incomparable and invaluable contribution to the Indian financial landscape, really. I'd now like to welcome Shri Utpal Sheth, founder and mentor, Trust Group, on stage. He needs no introduction, but he was the senior partner and CEO of Rare Enterprises, a multi-billion-dollar proprietary asset management firm based in India. I request him to take the IDCMS 2025 stage and share with us the perspective of the India debt capital market going forward. Please welcome him, ladies and gentlemen, with a resounding round of applause.
Good morning, friends. Change happens slowly and then suddenly. We are in an era of unprecedented change at an unprecedented pace. Going back in time, in the year 2001, Indian market cap to GDP was about 25%. Today, it is 120%. There has been a huge change in our GDP. We went from $500 billion then to more than $4 trillion now. GDP is 8x, but the market cap is that much more because we went from 25% market cap to GDP to 120%. Where has debt market gone in the same time? In 2014, debt market was 15%, corporate bond market, I'm saying, was 15% of India's GDP. We are still just above 20%, 21, 22%. Is that the right size of the debt market for this size of the economy? Our economy today is not the same that it was in 2001, not just in size, but also in its composition and in its quality. The economy of tomorrow and the years to come will be different. It is my contention that Indian debt market has a special role to play in the formation of that new economy. And which is why the title of today's summit includes the word breakout. Debt market, corporate bond market is also about less than 1/4 of the total bonds outstanding, which includes the government securities, the SDLs, and so on. We see that this proportion has to change for India to have a higher trajectory of growth. We have not seen in the last 10, 15 years private sector capex cycle getting triggered. But a lot else has changed. India today has the lowest debt to equity ratio. The Indian corporate sector has the lowest debt to equity ratio that we've seen in the last 40 years. I don't have data before that. Today, the rating system, the credit discipline, IBC is in place. The environment is now fully conducive for Indian debt market to take off. As they say, this is an idea whose time has come. But more than that, if not now, when? I think we have to be ready for the inflection point of growth for Indian debt capital markets. The time of resilience is behind us. The time for growth is ahead of us. And we are just breaking out. So to take you through that journey, we have some very good panel discussions today. And we will hear different perspectives and points of views. But I would urge you to keep this context of resilience, growth, and breakout in mind while you're listening to all those stimulating conversations. Thank you for joining us today. Thank you.
Ladies and gentlemen, as I said when we began, that this platform has emerged as a premium platform in India for India's top issuers and investors to engage and explore with the dynamics of the India debt capital market. Let's take a look at a film that showcases this very sentiment. I hope you all caught the highlights that were showcased in the film. I will tell you more about them later. But ladies and gentlemen, I must say that no platform can achieve such credible status without the support of all of you present here, esteemed delegates. So a round of applause for all of you and immense gratitude on behalf of us at the Trust Group. Thank you very much. So, India's fixed income markets enter 2025 at an important transition point with a stabilizing rate environment, strengthening macro fundamentals, and a more discerning credit cycle. Global uncertainties continue to test emerging market resilience, yes, but yet India's fiscal trajectory, investment push, and deepening market structure are reshaping the risk-return landscape. This session will explore how evolving rate expectations, credit differentiation, and regulatory developments are influencing pricing, liquidity, and investor behavior. The discussion aims to bring out the balance between growth-driven credit expansion and disciplined risk management as the economy accelerates its capex cycle. The panel will also highlight the structural opportunities and potential vulnerabilities that will define fixed income strategies in the near term. To lead us through this conversation, I welcome a renowned sector expert, an accomplished and awarded business journalist across 3 eventful Indian decades. With her deep understanding of India's financial markets and policy landscape, she will lead a strategic conversation on credit and rates, navigating risk and return. Please put your hands together for Ms. Latha Venkatesh, Consulting Editor, CNBC TV 18. Good morning. May I say it's always super to have you with us. The power panel, ladies and gentlemen, is as follows. Shri Ashish Kumar Chauhan, Managing Director and CEO, National Stock Exchange of India, a towering leader who is highly awarded both in India and overseas, including the Lifetime Achievement Awards by Regulation Asia and Outlook Business in 2025, CEO of the Year by Asia Asset Management in 2025, Most Influential CEO by CEO Monthly in 2024, Lifetime Achievement Award by Global Custodian in 2023, and many more. A book titled Sthita Pragya, The Process of Maintaining an Equilibrium, addresses his life's journey. We welcome him. Swagat hai aapka, sir. Also, please welcome on stage Mr. Nilesh Shah, Group President and MD, Kotak Mahindra Asset Management Company. Mr. Nilesh Shah is a part-time member of the Economic Advisory Council to the Prime Minister of India. He is member of the Insurance Advisory Council set up by IRDAI and also a member of the Board of Association of Mutual Funds in India. Good morning, sir. Swagat hai aapka. Also, please welcome Mr. Raj Kiran Rai ji, Managing Director, National Bank for Financing, Infrastructure and Development. Zordar taaliyan ho jaye hamare sabhi esteemed panelists ke liye. Mr. Raj Kiran Rai ji is a banker with 4 decades of experience at leadership and institution building across the banking and financial industry. Mr. Rai has held key positions in his career, including Chairman of the Indian Banks Association. He has also been conferred honorary fellowship by the Indian Institute of Banking and Finance in recognition of his great contribution to the field of banking and finance this side of the world. Please welcome him, everybody. Swagat hai aapka, sir. And ladies and gentlemen, once again, welcome on stage Ms. Nipa Sheikh, Founder and Director, Trust Group. I hand this first panel of the day over to the Honorable Moderator, Latha Venkatesh. Wait, please.
credit and risk, navigating risk and return. Actually, the anchor made a very good presentation of what we are here to discuss. We've seen over the past, 10 years, several important positive steps towards the debt market. We are seeing, asset monetization, the rise of InvITs and REITs, which is a whole new area that has opened up for the debt market. The other important piece is certainty in contracts, the IBC and its process. We may all want it to be better, but at least it is ensuring that contract is respected. In the infrastructure space, whether it is roads, NHAI, or whether it's power, discoms, the traditional people who have not kept their word on contracts, a bit of that is getting resolved. So we are seeing several pieces in terms of instruments, in terms of processes, and in terms of government interest, government action being resolved. Hopefully, all that will lead to an increase both in quantity and quality of fixed income instruments. On the other side, I think Utpal Seth gave you the data. At the moment, equity markets have expanded to well over the GDP, from 25% of GDP to now 120% of GDP, whereas debt markets have stayed at between 15 and 20% of GDP. So it is still dwarfed. It is still stultified. So what we are trying to see is whether the incremental steps taken so far is going to lead to something bigger, whether that inflection point that we saw in equity markets and especially in mutual funds at the turn of the pandemic. We never expected that 20 lakh crore mutual fund industry will suddenly become a 70 lakh crore mutual fund industry. So sometimes when the inflection point comes, we can see a very big growth in a very short period. So the questions I will be asking you is basically, are you seeing that inflection point somewhere around the corner? Let me start with you, Mr. Rai. 40 years in banking and the last 5 years in infrastructure financing. Are you seeing a material improvement in terms of both processes and instruments that will increase the size of the debt market?
Yeah, I think a lot of data points are already shared. Like we are seeing the scope actually from 20% of GDP. If you look at comparable countries, China is about 50% of GDP for the corporate market, and Brazil is 300%. And we have Indonesia at 30%. We are below 20. So the scope is very much there actually. And actually, again, looking at the trend, looking at mutual fund industry or equity market, what made a difference is retail participation. Now, in the bond market, 96% of the corporate bond issued are with the institutions, and they're held to maturity. These are our insurance, pension, or other institutions. The retail participation is very low. Only last few years, we are seeing fintech and platforms are coming into the bond market trading and all that. The secondary market is the weakest link in this. Basically, the retail participation needs a very robust secondary market, which is developing. And the regulations around that also is evolving, like whether it is SEBI or RBI. So we are seeing that, all that enablers being put in place. Now the corporate bond issuances also did not pick up. It is all AAA or if you look at the market, the data shows it is only 23% of the bond market is corporate bond market. So it is about 57 lakh crores today. Out of that, it is all AAA issuances or PSU issuances. Actually, you are nothing below AA, actually, yes. That kind of. So, and since we are talking of risk reward, actually, basically, I'll tell you from AAA to AA, the bond market gives you more than 100 basis point upside. Okay. So that earning perspective is not seen by even the insurance companies today. So actually everybody is scared of the risk actually. But then as you mentioned, the developments in the last 10 years has actually cleared this air actually, whether it is IBC, more robust concession agreements, very strong counterparties. We have not seen any defaults. We have a recency bias actually because what we have gone through earlier. But actually if you look at the rated domain of infra companies, we have not seen a single default actually. So it is all actually enabling an environment. I think the first thing to takeoff will be the asset monetization side. InvITs have created a AUM of more than 7 lakh crores and REITs more than 2 lakh crores and expected to triple in next 5 years. So asset monetization is nothing but, the capital coming back to the system actually. It is actually deleveraging the construction companies and all that. So actually asset monetization, government is also pushing national monetization pipeline and all that. And otherwise also there is a lot of private space. It is not only NHA InvIT. There are almost 23, 24 InvITs operating in this area, right from warehousing to transmission to road assets. So these are actually now the bond issuance. Actually, InvITs have issued more than 50,000 crores of bonds in the last 2 years. Actually. So this is actually really picking up, and we are seeing family offices coming in, retail participation coming in. So I think slowly it is picking up. So I see that inflection point is very much there. We need to encourage retail participation. What happened in mutual fund industry or equity market will happen. And some changes in the way institutions like, insurance companies, because they are the fastest growing today. Actually, with very small portion of the financial saving coming to mutual fund industry, what difference it has made, we know. Similarly, the insurance, pension and PF, their AUM is growing by 15 to 20 lakh crores every year. They are already 120 lakh crores AUM. It is almost 50% of the scheduled bank deposits. So now that money actually is not flowing into the bond market. Once that happens, retail participation and insurance companies changing the way they invest to maybe the credit enhancement, what we are proposing and kind of things, I think there will be a lot of traction in the bond market. I think we are already seeing that happening. Thank you.
I take your point, sir. There were a lot of positives in what you said, though you began negatively by pointing out that we compare very poorly with other countries which are more or less in the same development. Like for instance, Indonesia, I think it's 30% the debt market. So even in countries with comparable GDP, we have fallen back as far as the size of the debt market is concerned. And even insurance, the institutional participants that you point out, they have a 15% cap in terms of investments in insurance. And guess how much they have reached? 9.5. They're simply refusing to put the remaining part of the money in insurance bonds or in long-term corporate bonds. So the hesitation is not only in retail, it is also there in institutions. Maybe rules will have to be rewritten, but more a mindset change. And that's where I come to you, Ashish. You've seen the rise and rise of retail participation in equities, and not a small contribution has come from the NSE. The cleaning up of the process to electronic trading, and then it's spread to various cities, instantaneous clearing, almost faultless settlement of trades. All that greatly helped expand retail participation. Nilesh's perennial problem will be that in spite of the success of mutual funds, there is so much of retail that is going outside the mutual funds. That is the success of the Indian equity institutions. What do you think is holding back retail debt?
I think there are several issues, some of them structural, some of them distribution issues. So broadly, the distribution issues have been solved by way of 4G, 5G, UPI and other things. So now NSE itself services 24 crore accounts, 12.2 crore unique PAN numbers across the country, and there are, those people can always buy debt in addition to equities. I don't see why they wouldn't buy if it is attractive for them to have those returns which they expect or they are getting into other asset classes. So how does the debt ecosystem give that returns? For me, the investors chase past returns, not necessarily future, because future cannot be predicted, at least in equities. But past returns is what they chase, immediate past returns, as you said, recency bias. And on the structural side, I think India has gone into, specifically India, has gone into K-shaped kind of economy where there are portions of economy which require tremendous capital. And then there are portions of economy which don't require capital at all, which I call it capitalism without capital, which is broadly coming into equities where Zomato's and Swiggy's and rest of the things, Grow and Physics Wala and whatever, they don't require that kind of physical infrastructure to borrow. They just start with something and then they keep on evolving. So they don't require that kind of a situation in terms of the borrowing. The ones where huge amount of capital requires basically in infrastructure. And that's where I think over last 25, 30 years, we have created a situation where only government can implement infrastructure in a large scale because of the land allocation, basically land acquisition and many other things. And land in India is very costly vis-a-vis the overall sort of project costs. And that is creating issue for everyone. So for me, where the infrastructure has to be there is a lot of capital required. And somewhere on the line, we have also created, I think he said about recency bias on that count for the banks. Today, I think the overall numbers could be here and there by a few percentage, but overall bank credit to corporate is itself so bad. It is literally 1 lakh crore or less, right? And we are talking about 60% of that is now by bonds. So we are not bad as a percentage of the total leverage, but India as a leverage country is under leveraged by miles. He mentioned about China's 50% on corporate, but as a banking system size to the GDP, it's 4:1. After that, they've stopped publishing the numbers. America is even larger. Most countries have a very large sort of a bond or a government debt size or total banking system size. We are at half, literally 1/8 of what China is. And that's why I say, last week I mentioned in one of the conferences saying, we have created incentives for banks not to lend. And we have to create now disincentives for banks not to lend. Otherwise, today Bank Nifty is running highest with no work to do. Why would they go and invest and also later on go to jail? So that's where for me, we have created structures, rules, regulations, examples where failure is considered very bad. And on top of that, what happened with Templeton and others, all the credit events actually happen together, bunch up, and that creates a perception in people's minds. Last part is, we have now started creating a bond ecosystem using OBPP, online bond platforms. We have now around 28, 29 bond platforms across India. And the number of transactions per bonds, which used to be around 100, have now become 1,000. So in last 1.5 years, per year, we are having literally 10x more transactions per bond, average. And that's why many more people are coming into the bond market retail side. How do we create market makers for them? How do we see there are structural issues which we can resolve from the regulatory side. But overall, if the country doesn't sort of demand that kind of bonds or that kind of debt, it's not easy to do it. The last part is the interest rate derivatives. We have made derivatives which are deliverable, and each bond is so illiquid. But if we have index derivatives on bonds, we have already applied for government securities index bond futures and also the corporate bond index futures. So if that is allowed, then there will be a good sort of interest in terms of hedging and other things. Otherwise, again, if the market goes abroad, then only we will wake up and say, now we need to have it, right? Today we are doing it for currency futures. That market was painstakingly built for 17 years by NSE. And one day it was closed down. Now since Singapore is doing well, now it is rethinking that should we have that market here or not.
No, I take your point that the narrative has been an enemy, the recency bias as you call it. And all of us, I think on the dais, I'm not so sure about NEPA, but the remaining 4 of us have even reported on it. We went through a similar ugly phase from 1997 to 2004. If you remember, 2003 peaked with IDBI sitting and restructuring the debts of Ispat Jindal and SR. And then we saw, the period of lazy banking, as Rakesh Mohan called it. Banks just refusing to lend, or at least that's what he accused them of. And then we saw the burst of lending coming by 2006, 2008, until it led to excess credit. So hopefully the recency bias gets over, in a couple of years. But I'm more interested in this retail narrative, the institutional bias against long-term lending or aversion to infrastructure lending will be overcome. It's just a few successes, and I think institutions will come in. These insurance companies that I spoke to you about will come in. But the retail narrative has not picked up. It didn't pick up in the previous cycle of decline of the banks and then the rise of India's GDP growth pace. Will it happen now? Nilesh, specifically my issue is, how are you looking at our macros? One of the big achievements, I would think, is the way in which we have been able to tame inflation. Up until 2015, or maybe 2013, that double-digit inflation was not erased from our minds. But now, probably anyone will bet that once the inflation comes to 6%, the whole country is agitated, policymakers are agitated, and the pendulum swings back to lower inflation. Is it that retail has not got used to it? Retail still wants a 10% because you have a different inflation perception. Is that what is blocking? The very strength of the macros is a disincentive.
So, very good morning to everyone, and thanks Trust Capital for inviting me over here. As they say, whatever one says about India, opposite is also true. For example, Lata, as you mentioned, CPI recorded by statistics has definitely come down. We have seen lifetime low inflation last month. But there is an inflation which can be called lifestyle inflation. Aspirations have gone up. Last week, in one of the WhatsApp group where I am a member, someone posted a very interesting article about how one statistics ruined my life. It's an article by a fund manager called Michael Green. And he talked about American dream of 60s, 70s, 80s, where an American industrial worker will earn about $30,000, $35,000. His wife will work at home, be a housewife. They'll have 2 kids. They'll have a house, a car, and a comfortable lifestyle. Today, in the world's most capitalist city, quote unquote, a communist is a mayor. Why did that transition happen? And Michael Green describes that by saying that today, $30,000 has become $130,000. When wife has to go out to work, there is $32,000 worth of childcare expenses which gets added. In the 60s, 70s, 80s, medical insurance was $10 a month. Today, it is $10,000 a year. The housing price, lesser said the better. While American inflation has remained in the books where it is, giving Fed ample room to cut rates, the lifestyle inflation of American has reached a level where promises of freebies and reveries can get you mayorship of New York. We don't have our Michael Green here, but all of you know what I'm talking about. The statistically recorded inflation and the lifestyle inflation is probably one of the reasons why we are seeing limited retail participation in the Indian debt market. But as I mentioned, whatever one says, opposite is also true. Look at us, we Indians. We have put 38 lakh crore in currency note. Somewhere in the heart, we all believe, घर पे पैसों के झाड़ उगेंगे. ना आपके बाप दादा ने वो देखा है, ना आपके पोते वो देखने वाले हैं. but belief है, उम्मीद पे दुनिया कायम है. 38 lakh crore in currency note which depreciates day after day, year after year, generation after generation. Then we have CASA balance of about 80 lakh crore. On current account, there is no return. On savings account, there is probably 2.5% return with some exceptions. Collectively, on 1,20,000 lakh crore, we are earning either zero return or very low return, and certainly negative real return. That's roughly about 10 lakh crore a year. If I round off to 150 crore Indians, that's about 6,000 rupees a year. 6,000 रुपए का प्रॉमिस करके आप इलेक्शन जीत सकते हो. हमारी म्यूचुअल फंड इंडस्ट्री 6,000 रुपया इन्वेस्टर्स को देने को तैयार है, कोई लेने को तैयार नहीं है. So somewhere between lifestyle inflation, statistical inflation, and this policy कि घर पे पैसों के झाड़ उगेंगे, Indian debt market वहीं की वहीं रह गई. And if you permit a lighter vein comment, 97 to 2004 was the greatest period for Indian debt mutual funds. We, me, Bala, Navneet, Amitabh, Mohanty, we all delivered return better than all the equity mutual funds. And then all of us shifted from debt market.
See you.
The day you see an equity fund manager becoming a debt fund manager, you know debt market has reached that inflection point.
That's extremely well put. I take your point entirely that lifestyle inflation has been a bit of a huge culprit. And that you don't need a Michael Green to tell us that in India as well. Look at the education inflation. For most of my colleagues who have young children, they educate going to an IB school or a private school, you know, Bombay International or any of the elite schools, is an inflation that is not captured at all in the CPI. Likewise, health inflation, the health services inflation, wellness inflation, all those are clearly not captured. But I will come back to you to ask you whether, is that the only reason the debt narrative has not caught? Okay, actually, why don't you finish that argument since we are in the mood? The period you're speaking about, 1997, was the great Rangarajan PLR of 18%. So debt delivered 18% returns. I remember the UTI MIP used to give 15% fixed return at that time. Now, clearly we thought that was an evil, and we have controlled that 15% inflation. So that is not going to come back. What do you think can attract? Is interest rate the culprit?
No,
or is it that the Indian has to learn that 6% is a good enough return for me to retire?
So again, Lata, there is no one reason. There are multiple reasons which contribute this. But in some sense, if I have to ascribe one mentality, we want to run a car which is either reverse gear or fifth gear. It's exactly like our Indian cricket team. We go to play South Africa on a spin-friendly match with T20 players in a test match and hope that we will win the test match. Same thing is happening in our debt market. On one side, we have investors who are so risk-averse that they are happy to get real negative return year after year, generation after generation. And on the other hand, there are people who in chase of higher return are willing to take huge risks.
Okay, let me ask you this question very directly. Do you think a change in the tax is going to help? Because up until 2020, the debt AUM was a good 20-30% higher than equity AUM. Today, equity AUM is 60% higher than debt AUM. Debt stagnated.
Never
when
ask
the tax changed.
Never ask barber whether you need haircut or not. मैं तो यही बोलूँगा कि tax advantage दे दीजिए debt mutual fund को, but you are asking wrong person, Nipa. You have to confirm that.
No, Nipa, I mean, genuinely asking, is that going to at least trigger the retail participation?
No, I agree. Forget the debt mutual fund. Of course, debt mutual fund had the preferential tax treatment, and we saw the benefits of that. But if you see every asset class, whether it's equity, it's InvIT, REIT, even real estate, and gold, everything else has a better tax treatment than debt. So the difference is so wide today. We've seen over the last 3 years, almost 9 lakh crore of InvIT and REIT market capitalization. Though it has not penetrated deep in the retail, one of the biggest reason is also the after-tax returns which is there. I mean, there are a lot of other things that the great assets and all of that. But if you have to compare, because they're very dead alike, the reason is obviously higher return and better tax-adjusted return. So I think as an asset class, obviously some amount of equality against the other class will make a big difference in terms of HNIs and retail coming to the segment.
What's the chances we will get it, Ashish?
It's the other way around also. So, see, basically for me, the debt also gets a favorable treatment in the balance sheet. That it's allowed as an expense.
We're looking at retail interest.
What I'm saying is it's allowed as an expense. So that's where across the world, this debate is going on, whether it should be treated this way or that way, and it will have its repercussions. But
in India, at that point, 2023, when the indexation and the tax rates changed, we clearly saw the stagnation of debt AUM. And no, I accept your point that mutual fund debt is not the biggest debt basket. As Mr. Rai pointed out, insurance and pension are large. So probably we're not going to attack the entire debt market and corporate bond fixed income problem by changing the tax. But do you think that is called for? Or do you think we will even get it?
broadly, the way I understand the government's framework is that they want to reduce the complexities and that they've sort of shown over last 10, 11 years, that they want to minimize any exemptions, any other ways of doing things. And that's what probably will continue because that's given them great returns in their own mind because their collections have improved, their overall administrative hassles have reduced, people have had less complexities in their life and stuff like that. So broadly speaking, we can continue to do it, but I'll come to the same issue again and again, that if the debt starts giving more returns than equity for next 3 years, after that next 3-5 years, people will go to debt. Whatever amount of, even people ask me that in FPI, there is no tax in America, why India is charging. So I always say that that's our country. If you think that we are going to give you much more returns than that, then you don't mind paying tax. It is about the net returns and nothing about tax part. We keep on talking tax part. Instead, we should worry about how to get greater returns. And there, some of these leveraged products, if we ask for, and things like that, those are the things probably will make the markets more vibrant without having those tax complexities.
Okay, yeah, this is not what we want. A few years of static equity returns and high inflation leading to high debt returns. That's not a combination as an economy we want, but that might make debt attractive, is what you're saying. Actually, now let's have a round of answers on what would you all want to open up the debt market to ensure that it is not 20% of the GDP or 16% of the GDP, but rises to at least 30%. Mr. Rai, let me start with you. What would be the policy or private practice changes that you want seen?
Yeah, I think maybe there is a perception change needed because the asset class which is available, which can hit the bond market, is very much there today. InvITs have shown the way, REITs have shown the way, and this is something which is already there. Maybe the tax treatment, actually, what Nilesh quoted, is something actually because the government has to really look at it. But one thing actually, we need to understand why there is a necessity of this debt capital market to grow. We are talking of 30 trillion economy. The highest multiplier effect is in infra investment. Otherwise, government will not allocate 11-12 lakh crores out of budget for infra.
For CapEx.
Because this is which is driving the GDP. And if you miss our 7%, 8% growth, we will get into mid-income trap. So, because this is what happened with the other, BRIC countries also, we have seen that. India can get into that trap if you don't continue to invest and get capital into these assets. We have enough scope to do that. So, getting this long-term patient capital available with the investors, whether it's institution or retail, into the capital market and to the infra and other asset classes is very much important if you have to get that 30 trillion economy. So, the ends are very clear. The means of achieving that has to be defined. So I think the very fact in the last budget, there is a mention of partial credit enhancement by the Honorable FM itself in the budget. Itself is an indication government is seriously looking at it. Because actually for how to make the institution to invest, like insurance and pension fund, what is their problem? They are scared of the credit risk. In credit enhancement, what we do is we take the credit risk away by enhanced rating. So at least that will trigger the investment of the insurance and pension funds. And this should actually, which we have already started, we have launched the product and we will see the enhanced bond issuances in 1 to 2 months. Actually, the process is on. And actually in 4 or 5 years, we see that the triple Bs and A-rated entities getting enhanced to AA and attracting the institutional investment and this thing, much higher yields actually, definitely. It's a risk reward, this thing. And with the credit risk being taken away by institution like NAFED, will create this market. And I think the government will facilitate. It is not that government is not aware what need to be done. Because actually in a country like ours, where there are very diverse requirement of various sections, pushing one particular thing will disrupt something else. So it is we have to be very careful. But then I can assure you, because from the discussions what we have, everybody is aware what to be done. So in the sense, ultimately, we will reach there. We are a bit slow in doing that. Being a democratic country, we have to address a lot of issues. I think tax-free is one thing. Asset monetization in much bigger way is another thing. Urban infra requirements. Actually, half of our infra investment in the next 20 years will be in urban infra. It will be actually the logistic cost is something which everybody talks about it. In addition to look at urban mobility. Metros are a big thing today, where a lot of money has to be invested. Solid waste management and sewage treatment, if you don't get it right. See, urbanization is going up in a big way. So the money needs to, municipal bond market. You have seen developed economies with a huge muni bond market. And, despite...
In India, it's practically absent.
It is absent. Despite all our efforts, this year we have seen 1,000 crore issuance. It used to be either 0 or 200, 300. So it is actually because we play a role.
Which are the cities that are issuing? Which are the cities that are issuing muni bonds?
2 days back, Nasik issued 200 crores and
Surat. Surat also.
Surat issues. There are many, actually, I think New Bombay also is coming up with a bigger, I think they may come with a much bigger bond issuance. Now it is 100, 200 crores. So now actually this is something which will happen. So urban infra needs investment because the quality of life. Actually, if you want quality of life, urban investment has to happen. So there are a lot of enablers needed. Urban Challenger Fund of 1 lakh crore was announced. Actually, this is again triggering that investment, like our shipping. Again, about 70,000 crores of investment announced on maritime side and all that. So actually, the government is putting that triggers. So I am very sure that, the necessary requirements will fall into place. We will get there, and the bond market will be the biggest enabler. Because pushing banks to lend to long-term projects on the greenfield stage is right, but actually taking it out at the end of 3 years, 4 years to the bond market is the most essential part. Because we should not allow banks to hold these assets for 15 years, 20 years. It should move to the bond market. That is the essential thing. And all that enablers are coming actually now. So we'll see these changes gradually in the next 2-3 years.
Yeah, actually, the putting up of the backstop, as you pointed out, is because of the SECI coming in, renewable power picked up because SECI provided the backstop. So maybe backstops for infrastructure could increase.
Strong counterparties, we say.
Strong counterparties, yeah.
Because the exposure is not directly to the DISCOM, state DISCOM. SECI stands in between as a guarantee. Yeah. So that is like power grid stands for the transmission assets. Yes. Like that. NHAI for the road
maybe
assets.
Some institutional arrangements
could
be something
yes.
the government could think of. Does this time indicate that we have to go to the audience Q&A, or is the audience Q&A after we hit 0? Okay. Okay. Ashish, let's quickly have a round of what would you like seen?
In a way, I would like to see the government bonds marketed through the stock exchange like the sovereign gold bonds. We can do wonders to bond markets, but somehow we are not allowed to, for whatever reason. And that is, in a way, what stock markets have done to equities is well known, right? But we can do it to bond markets. It's just that we are not in the equation yet. And hopefully that will be solved at some point. And in some ways, once an investor, see, everyone doesn't want to be in speculative assets for 100%, right?
Yes.
They need to be in different sort of buckets. And once they get used to that risk-free sort of asset, for me, many of them will want to, like Nilesh Bhai keeps on telling me all the panels about why Indians invest in gold. And I say that they should be investing in government bonds, right? Why is because at least it's interest bearing, right? Gold has gone up, given great returns in last 1 year. But overall, for me, long term, we need to ensure that there is a risk-free part which each person is able to directly experience, not via 3, 4, 5 layers. Because whatever I sort of tell you that this particular group is better or that, but there are individuals who can also do better provided they have exposure available. The OBPP part has become much sort of more prevalent. We are able to now distribute very large amounts of bonds also and also provide trading facilities if we can create market makers like what we have done for SMEs. Because SMEs, although the total issue size is always 50 crore max, 100 crore max, the amount of trade available for small little investors is always there because there are two-way codes with compulsion. If we can have that kind of regulatory sort of a framework where each bond, especially given to retail, is having a market maker with 3, 5, 10 years of sort of compulsion to provide that, I think it's going to be a great way to get people exposed to, because most of us as retail investors want an exit when we feel like. But if the quotes are not available, then it kind of takes us out, right? Okay. So that's where we need to be sort of worried about. And then across the world, the governments borrow quite a lot. In India, because of the way things have started working for Indian government, that the tax collections have been very buoyant, and there is a sort of
this year
fiscal consolidation. The government debt as a percentage of GDP is now much smaller than pretty much most of the Western countries. And so that portion of the bond markets or the borrowing market, which was very vibrant, has suddenly become shrunk, right? And yesterday I was with another event where what he said about giving partial guarantees. The UK government owned entity called Guarantco has started giving partial guarantees to Indian entities, and we are raising bonds on that. So like KPI Green Energy, none of you would have heard probably, but we did how much? Close to $1 billion or something like that raise, right? Not that it will trade. But what I'm trying to tell you is there are people who have understood that India requires this. Of course, NAFED is going to lead that, but other people are also coming in to do this partial credit guarantees, and my investors are lapping up, let me tell you. All my 9 municipal bonds this year, this is like the highest municipal bonds ever issued in 1 year, right? And you can say 1,000 crores, it's small, but it's a good beginning, like REITs. Today, this year, we have raised 25,000 crore, right? And that's where, for me, these are good offshoots from the capital market side, infrastructure, regulatory. Yes, yes. I still think the market making is necessary. But otherwise, we are creating railway tracks where now you will be able to run many, many trains and bogies going forward.
This is extremely encouraging. Clearly, asset monetization through InvITs has been a very big positive. Nilesh, I know the barber will always vote for a rate cut, but is that something we can expect in terms of a tax change? Anything else that can lure the retail investor?
So, to bring vibrancy in debt market, I just want to change the perception of our coach. Our coach believes that we are all Kshatriya, warriors, will go into the battlefield without any weapon, without wearing any armor. But our coach should realize that we are not Kshatriya, we are Vaishya, we are Banya. We need protection. What do I mean by this? In fixed income, there are multiple risks. One is the credit risk. Can I enforce contract in the court of law? Partial credit guarantee, full credit guarantee. How will it work without pure definition of default? What is a default for an investor? That is not default for the guarantee provider. And when that dispute goes to the court of law, all of us know how many years it will take. The second risk is interest rate risk. How do I hedge my interest rate risk? There's no future in interest rate future. There's no option. There's no derivative to hedge your risk. Then there is liquidity risk. Well, it's like a game of minesweeper. Few games you can win, but eventually you know what is the result. Unless until we recognize that in the market participants come to make money, and to make money, they need risk management option. Whatever Mr. Rai and Ashish Bhai mentioned, undoubtedly they are necessary. But can we build a tall skyscraper without laying foundation? So I need my coach to realize that we are Vaishya, we are not Kshatriya. We are not Sunil Gavaskar who can face Malcolm Marshall and Andy Roberts without helmet. We are the Virat Kohlis and Rohit Sharmas of the world who needs helmet to face current Pat Cummins and everyone else.
No, I didn't get into the whole court system because, that is not going to be resolved by our saying. It is an inexorable problem that we have, and that is why we go in for partial credit enhancement. We go in for intermediate guarantees. 1 minute. Yes, sir.
Just actually, because since he mentioned in this form, the Reserve Bank recent partial credit enhancement guidelines are very clear on defining how the default occurs and how the payments will be done. That is resolved actually.
So hopefully,
Mr. Rai, Reserve Bank can say whatever it wants to say. Let's hear it from Supreme Court of India. I have met lawyers who have said, Nilesh bhai, कोई भी पेपर पे सिग्नेचर कर दो, कोई टेंशन नहीं है, कोर्ट में आएंगे तब देख लेंगे. There are many guidelines on regulatory side, including 81 bonds. And we have seen the cases are going on and on and on.
no,
There is no blood, there is no dead body in civil contract. And hence it never gets importance from the court of law.
No, that is a persistent and long-standing problem. But it is, I don't see how...
Lata, I have seen a rating agency refusing to downgrade a payment, downgrade a corporate paper even after default. We have seen that. Now, is there a clear definition of default on the rating agencies? Undoubtedly, yes. But it happens. And you have to live with it. Now, what do I do? If there is no helmet, there is no bed, there is no gloves, there is no pet, do you expect me to go and face Pat Cummins?
What is the specific ask? The specific ask is a rewriting of the law. If it is recasting of the legal system, then let's not even get there.
Throw the darts, hoping that something will stick.
Okay.
एक डांट फेंकेंगे, फिर देखेंगे, अरे गिरा नहीं गिरा, लगा नहीं लगा. It doesn't happen that way.
I agree. Okay, I didn't touch one large area. Do you expect India's index inclusion in more global bond indexes to open the floodgates in some fashion? While our macros are strong, we are for the first time in also a situation where US debt is paying more than our debt. So that can be a deterrent also. Even if you're included, we may remain underweight. So do you see foreign inclusion coming in at all in Indian debt making a difference?
See, given the size of our markets and the kind of credit which is required by India, I think it's a matter of time that most of the index will include it. Geopolitically, you are in a good spot. You may have the interest rates abnormality right now. We haven't seen rupee interest rates and dollar interest rates differential its lowest. But we are changing seeing the cycle change, right? The dollars are coming down. Of course, we are seeing another issue at the yen interest rates. But I think India, being in the top 5 economy and looking at the kind of infrastructure investment country requires, and I think it's going to be a delight for most of the investors to come in. Slowly and steadily, we've also seen global investors coming in Indian credit, apart from GSEC, which I think it's a phenomenon of last 2 to 3 years. So very clear that it may not happen in a hurry. All the money may not come in over the next 3 months, but I think we are sure to go there over the period of next 3 years.
I have a lighter vein comment on it. Indian debt markets are unlikely to receive foreign participation unless they learn from China. Last year, Chinese debt market collected about $47 billion, more than what cumulative Indian debt market has received from FPI investors. How did China do that? One, they kept interest rates much below US Treasury. We are unfortunately much higher than US Treasury. Second, in last 10 years, Chinese currency kept on saying that one day we will appreciate, and they depreciated 15%. We keep on saying that our currency will depreciate. So we need to learn from China, bring interest rates substantially lower than US Treasury, and keep on talking about potential rupee appreciation. It doesn't matter actually mein kya hota hai. Then foreigners will definitely come and invest.
Okay, actually we've eaten up all the time for the audience, but it'll be unfair, so please go ahead. We will renege on the time and allow people to ask a question. Sorry. Okay, if you all want to stick with the time, then that suits us. Thank you very much. Anyway, the excellent panel we have here are going to be with you for some time, and maybe you can catch up with your questions and doubts over a coffee. Thank you very much, Trust Mutual Fund, as well as all my panelists for your excellent points.
Please stay with us on stage. I'd like to request Anindya Sen and Hani Jalan to join me on stage and facilitate our speakers. Felicitating the Honorable Moderator, Ms. Lata Venkatesh, Executive Editor, CNBC TV 18. Ladies and gentlemen, the applause can be louder. This is the first panel of the day. It was a power-packed panel. May I say star-studded panel of the economic landscape of India. Immense gratitude for all the esteemed panelists and, of course, the Honorable Moderator for their presence here this morning. Thank you very much. We'd also like to thank Shri Ashish Kumar Chauhan. We'd also like to thank Mr. Nilesh Shah. Thank you very much for taking out the time and joining us here for this panel. We'd also like to express gratitude to Mr. Raj Kiran Rai Ji. Thank you, sir, very much to you too. And of course, to our very own Ms. Nipa Sheth. Thank you for joining the panel. And I request you all to come together for a group photograph. Once again, please. Honorable Moderator, if you would step into the center of the picture. Thank you. And that's our cue to say thank you to them with a round of applause, ladies and gentlemen. Thank you all very, very much. Thank you. As they make their way off stage, let me quickly take this opportunity. Thank you very much. Thank you. Thank you. And take you towards the unveiling of the Knowledge Vault that showcases a series of exclusive research and sector reports powered by CRISIL and the Trust Group. Ladies and gentlemen, the research covers debt market outlook and opinions by industry stalwarts. In addition, we are releasing a compilation of 175 issuer profiles, along with a financial peer comparison to assist investors gain a snapshot of issuers in Indian debt markets. A round of applause for the collective brilliance showcased in this Knowledge Vault. We urge you all to please check the Knowledge Vault on the screen by scanning the QR code. You also have the QR code on tables across the venue. Please do so, ladies and gentlemen. A lot of effort has gone into creating the Knowledge Vault for you. After every session, this will come up. Please do scan the QR code and take a look. All right then. At IDCMS, every session is high impact, high powered, and high value. The people who matter on the Indian economic landscape. We at IDCMS consider it ourselves a privilege to host their towering presence and benefit from their valuable insights. Ladies and gentlemen, we have in the house virtually the 18th Chief Economic Advisor to the Government of India. Before being appointed CEA, he has been an accomplished writer, author, teacher, and consultant. His weekly column in Mint on Tuesdays from 2007 until 2022, we never missed. He has also co-authored pivotal books on derivatives, global finance, and the Indian economy. He's taught at several business schools and institutes of management in India, in Singapore. He was the Dean of the IFMR Graduate School of Business and a distinguished visiting professor of economics at Korea University. He's worked in macroeconomic and financial research markets for international financial institutions in Switzerland and in Singapore too. Dr. V. Anantha Nageswaran, we at IDCMS are honored to have you as the keynote speaker for 2025 edition. And I, sir, as the host, feel privileged to welcome you at IDCMS. Ladies and gentlemen, a round of applause, please, for Dr. V. Anantha Nageswaran, who is now joining us virtually. Attention on your screens for the keynote address.
Thank you. Thank you very much. Ladies and gentlemen, distinguished guests, leaders from the financial sector and industry, a very good morning to all of you. It's a privilege to be here at the Debt Capital Market Summit happening in Mumbai, at least virtually. I'm sorry that I'm not able to join you in person, given the season for budget and economic survey preparations between November and end of January and so on. India's financial capital and a place where many of the country's most important economic transitions have begun, and that is Mumbai, so it would have been nice to be there. But I hope I can do it in the next edition. Debt markets are often treated as a technical or niche. They are not. They sit at the heart of how India will fund its growth story over the next 2 decades. If the 1990s were the decade of reform, the 2000s the decade of global integration, and 2010s the decade of infrastructure build-out and digital transformation, the 2020s and 2030s will be the decades of capital formation at scale. No large economy has sustained high growth without deep, liquid, and innovative debt markets, whether it is capital or bank-funded or both. India's development so far has been bank-led, and that model has delivered results. Let there be no doubt about that. But the size and complexity of the economy today requires, as always, a recalibration. The next 15 years of investment in energy transition, logistics and connectivity, manufacturing scale-up, healthcare, technology infrastructure, and urbanization cannot be financed by banks alone. although they will still play an important role. India needs both a strong banking system and strong debt capital markets, not one or the other, both. Banks will continue to lead in working capital and operating credit, relationship-driven lending, early-stage project finance. Debt capital markets must increasingly lead in long-duration financing, transition finance, large corporates and mid-market issuers, risk disaggregation, and price discovery. A dual-engine financing model is not optional. It's foundational. India is at a favorable moment, building on the macro stability that we have. We are contemplating developing India's debt markets and the tasks involved therein at a time when macroeconomic conditions are unusually supportive. Sustained high economic growth, macroeconomic stability despite and through global shocks, a credible fiscal consolidation path, a resilient banking system with strengthened balance sheets, anchored inflation expectations, record foreign exchange reserves, and a stable external position. These fundamentals are not common in all emerging markets. They have boosted domestic and foreign investor confidence in India and contributed to the global index inclusion of Indian government securities, a milestone that reflects not only stability, but a belief in the credibility of India's institutions and debt management. Stability, however, is just the foundation. The next frontier is depth, liquidity, and innovation. The challenge today is not the absence of a debt market, but its concentration. Large and highly rated firms raise capital with ease. The task ahead is to enable mid-sized corporates, infrastructure SPVs, supply chain firms, and municipalities to access markets systematically and affordably. A world-class debt market requires the following. I mentioned 5. They are not exhaustive, but they capture most of the important prerequisites. 1, a credible domestic credit curve across ratings. Larger free float of government securities for better benchmark pricing. Active market making to ensure liquidity even during stress. Greater participation from pensions, provident funds, and insurers. Diverse instruments, securitization, credit-enhanced bonds, municipal bonds, green and transition bonds, hybrid capital. With these pillars in place, both issuance and investment will scale and liquidity will become self-reinforcing. Our regulators have laid important foundations. Corporate bond market infrastructure, electronic platforms, rationalized stamp duties, support for securitization, InvITs, REITs, and retail access frameworks. The next phase of regulation now will move on to smarter rules and not necessarily more rules. Enable risk discovery rather than suppressing risk. Support innovation with transparency, not innovation without accountability. Simplify issuance processes, ensure predictable taxation and policy, maintain governance and disclosure as core pillars. Markets mature when risk is visible, understood, and priced. Every economy that deepened its debt market also encountered vulnerabilities, however, and that point has to be kept in mind. There is much to learn. Lessons must be adapted and not necessarily copied. For example, the United States pre-2008 experienced innovation without underwriting discipline. In other words, the lesson is innovation must never outpace transparency and accountability. In Japan, excess reliance on domestic savings led to financial repression. The lesson is we have to broaden the investor universe while safeguarding strategic resilience and autonomy. In Latin America, dependence on foreign capital left them vulnerable to sudden stop risk. Domestic institutions, the lesson is domestic institutions must anchor the market. Global capital should be complementary. These are the lessons we can broadly take from some of the international experiences. The Japan example in particular needs special nuance. Yes, India must diversify beyond a predominantly domestic investor base to achieve scale and liquidity. However, Naive openness is not an option in a world that is fragmenting across geopolitical blocks. The more global capital participates, the more questions matter about which jurisdiction, what legal frameworks, and what exit rights. Debt markets increasingly sit at the intersection of economics and geopolitics, with sanctions, friendshoring, financial fragmentation, and the weaponization of payment systems shaping flows. India's debt market must globalize without becoming dependent and integrate without becoming vulnerable. India will not build a deep debt market through regulation alone. Issuers, investors, arrangers, credit enhancers, and rating agencies must act as market builders. 5 imperatives stand out in particular. Investing in transparency. Treat governance and disclosure as reputational assets rather than just means to reduce borrowing cost. Price risk honestly. Move beyond the AAA or nothing mentality. Build sectoral and credit expertise. Innovating responsibly. Complexity without clarity destroyed securitization elsewhere. Innovation must be investor understandable and standardized. Supporting the mid-market. Credit enhancement, blended finance, and structured products can unlock issuance from the fast-growing mid-tier, where India's job creation and manufacturing capacity will emerge, but it has to be juxtaposed with what I said just 1 minute ago on innovating responsibly and pricing risk honestly and investing in transparency. Last but not the least, building liquidity as a shared responsibility. Liquid markets require trading. Only buy and hold may not necessarily create the depth in the market. The market must develop not just infrastructure, but a culture of fixed income. Therefore, investment in investor education and sound market microstructure, accountability, and governance are important prerequisites for developing the market. This matters for the nation and not just for the industry. A deep and resilient debt market strengthens the entire economy. It reduces the cost of capital for industry, mobilizes domestic savings more efficiently, relieves pressure on the banking system given the size of the country and its development and growth aspirations. It gives access to households for reliable income-generating products and helping in portfolio diversification. It anchors long-term growth and financial stability. In short, a strong banking system ensures that growth does not stall. A strong debt capital market ensures that growth does not stop. In conclusion, India stands at a rare moment. High growth, macroeconomic stability, and fiscal prudence have laid a strong foundation. The question is not whether we have a debt market, but whether we will build one capable of financing the scale of ambition we have set for ourselves. If India is to grow at 7% for the next 2 decades in real terms, in domestic currency, debt markets must move from the periphery to the center of capital allocation. Equity markets have told and continue to tell the story of India's aspiration. Debt markets will determine whether that aspiration is financed adequately. Thank you very much for the opportunity to share my thoughts with you. I wish the rest of the deliberations a great session for all of you and occasion for reflection and action thereafter. Thank you very much. Back to you.
Thank you, sir. Ladies and gentlemen, let's express our gratitude towards him with a resounding round of applause, please. Really, thank you so much. Our gratitude, sir, expressed for you. Ladies and gentlemen, with every edition at IDCMS, we try and get you the ones who truly matter across India's economic landscape. That was the Chief Economic Advisor of India. Thank you very much once again for your presence. The Trust Group has had quite the journey, and it has been an exemplary one. The sweat and toil of all of us at the Trust Group have contributed towards this day, but also what has contributed is your trust in us and our gratitude towards you. I'm going to play for all of you, esteemed delegates, a film that showcases the exemplary journey of the Trust Group. Take a look. And the Trust Group marches on, making a mindful, impactful, and service-oriented impact on India's financial landscape. Ladies and gentlemen, kya hai na? I live for tea, I live by tea. I think my blood group is positivity. I'm looking forward to a hot cup of grey, green, or black tea, and I will be back on my podium in 10 minutes from now. May I also see you all back in your seats in 10 minutes from now. The next session will be waiting for us right here at IDCMS 2025. Enjoy the beverage break. IDCMS 2025, we are waiting for all of you, our esteemed delegates, for you to take your seats once again for the next session that is raring to go. We have an expert panel with a renowned moderator waiting for you to take stage and get this next panel going at this summit. Please, everybody, settle down, take your seats. If your colleagues and friends are outside in the pre-function area, please do message them or call them to join us as fast as they can. We are going to begin any moment now. Thank you. Ladies and gentlemen, welcome back. I can see a lot of you still standing. Please do settle down. Esteemed delegates, take your seats. We're about to head straight into the next business session, panel 2 at IDCMS. Please settle down, take your seats. Good morning. I hope all of you enjoyed your coffee, your tea, that little break. Thank you for coming back on time. Let's head straight into the next business session. Ladies and gentlemen, esteemed delegates, India's corporate borrowing landscape has expanded beyond traditional loans and plain vanilla bonds as companies pursue scale acquisitions and capital-intensive growth. Over the past few years, we've seen how alternative credit has evolved from a niche solution for specialized financing needs into a broader financing layer that now supports complex, time-sensitive, or event-driven requirements from banks and mutual funds often cannot underwrite. While these avenues offer flexibility and speed, and have emerged as a complementary pillar within India's debt ecosystem, their long-term resilience remains untested through a full credit cycle, highlighting the need for stronger governance and diversified pools of capital. To lead us through this conversation, I once again welcome on the dais Ms. Lata Venkatesh, Consulting Editor, CNBC TV18. Please put your hands together and welcome her on stage. Lata, each year your presence at IDCMS adds great value to our stage. Thank you once again for joining us this year too. Please do take your seat on stage. The esteemed speakers of this session, ladies and gentlemen, will step on stage with the sound of your applause. Mr. Kaustubh Kulkarni, Group Head, Banking, M&A and Strategic Financing, JSW Steel. Please put your hands together. Good morning, sir, and a very warm welcome. Mr. Manish Banthia, CIO, Fixed Income, ICICI Prudential Asset Management Company. Good morning, sir, and a very warm welcome to you. Ladies and gentlemen, we've just had chai coffee. We should put our hands together with more energy for our esteemed speakers, please. Mr. Sushil Kumar Modi, Executive Director, Finance, Lodha Developers. Please join us on stage. A warm welcome to you too. And Mr. Hardik Debar, President, Finance and Investor Relations, Wellspun Enterprises. A warm welcome to him too. Good morning. Swagat hai aapka bhi. And with that, I hand this over to the Honorable Moderator.
Thank you very much. Well, this is a much-awaited panel, as was the previous, because the corporate bond market has, or the market for corporate borrowing has enlarged over the last few years. We've had more sources of funding of corporate requirements. The latest addition, of course, is that banks have been allowed to fund M&A financing, acquisition financing, although, of course, now capped at 10% of Tier 1 capital, that we have from very reliable sources is a starting point. If the hunger builds, the Reserve Bank stays open to allow the whole hog of acquisition finance coming from banks. We have also seen the first instances of foreign capital getting opened up. ECBs are going to be way more easily available for shorter tenors. It doesn't have to be 5 to 10 years, 3 to 5 year ECBs, even shorter term ECBs are going to be shortly allowed. The draft rules are already with us. And then there is this whole rise of alternate credit, which the anchor just spoke about, which has only matured and grown with time. Then you have organizations like the NABFID, which are available to give hopefully partial credit enhancement very soon. and be a kind of a backstop, a first-class absorber for infrastructure projects. So it looks like the terrain is expanding. But how does a typical corporate think in terms of bank financing and capital market financing? Let me start. I think we should start with the JSW group, simply because I think you'll have seen a lot more of investments. So over there, Kaustubh, how does a typical corporate think, especially a group like yours, which is in the entire space, and now with paints, you are, well, it's not exactly JSW Steel, but you are from consumer goods all the way up to infrastructure in ports. So how do you all apportion? Is it still going back to banks, or is it a lot of attention that you are giving and will give to the capital market?
Thanks, Lata. So I think as a group, we are in most of the capital-intensive industries, right? Whether you look at steel, whether you look at energy, look at ports, cement, so on and so forth. So I think as a capital-intensive group, your first priority, of course, is to ensure availability of capital, right? And thankfully, that has not been a concern, I think, in India today, at least for the higher-rated corporates. Availability of capital is not a concern for growth. So I think that is taken care of. The second most important thing, I would say, is the cost of capital. The third thing that we would look at is looking at capital raising as a pool or a portfolio of liabilities rather than one, and therefore diversification again becomes important because you don't want to be overly reliant on one pool of capital. So I think those three I would categorize as the most strategic objectives that you have when you're looking at fundraising. Now, if you look at the history, right, of the Indian financial system, then I think it's undeniable that the Indian banking system has been the core provider of capital, especially debt funding to the Indian system. So in the context of the title of this panel, which is alternate, right, the word alternate has changed meanings over time, right? If you just look at the common meaning of the word alternate, it's anything which is not the normal. So if you started, 15 years ago, alternate would have meant anything other than bank financing. Then gradually you had, the rupee bond markets, for example, opening. So maybe rupee at one time bonds were alternates. Yes. Then they became mainstream. And then maybe ECBs at some point were alternates. They became mainstream. Dollar bonds were alternates. They became mainstream. But in the context of what is now commonly understood as alternate credit, which is more is private credit, which is outside of the banking system, I think the way I would broadly categorize it as a corporate, everything else outside of private credit is something we would still look at from a diversification point of view. So we would do rupee loans, we would do bonds, we would do dollar bonds, etc. It's all part of the pool. But private credit, I think today is still situational as far as we are concerned, right? So if you have a large M&A, you're taking on a large distressed asset, you need a financing structure which is a bit more bespoke. I think that's where alternates come in. But otherwise, as a corporate, we would always look at diversifying ourselves across fixed and floating rate liabilities. We would always look at diversifying ourselves across foreign currency and Indian rupee, and finally diversifying ourselves across loan markets and capital markets.
Okay. But is there still a partiality towards bank credit?
I would say there certainly is, and to my mind, for a group like ours, it's well-deserved partiality. Mm-hmm. In the sense that India is a growth market, right? And you need growth capital. We do a lot of greenfield projects, whether it's steel or cement or energy, right? And a lot of the other pools of capital that we discuss, they're available for operational projects, but it's not necessarily available when you're doing a greenfield project, right? Something which is greenfield, the 3 or 4 year construction period, where historically you used to have developmental financial institutions, the erstwhile ICICIs, the erstwhile IDBIs, IFCIs, etc. Those financial institutions have shrunk. So that function is now being taken up more by the banking system and even more so by the public sector banking system, where that funding comes from there. Also, for a lot of these projects, for example, if you look at the energy sector, you need really long tenor financing. You have 25-year PPAs, right? We would prefer to just lock into 25-year financing. That kind of tenor is also available from the banking system. But if I were to do a acquisition financing, I were to do a balance sheet level general financing, for that I would look at a rupee bond from a domestic market, or I would look at rupee bonds coming in from foreign portfolio investors, so on and so forth.
Okay. Well, I take your point that there is this partiality towards banks, but banks also have a partiality. On that, Hardik, how would a company like yours approach? Banks also have become risk averse. As you very, put it very delicately, it is banks and only public sector banks which lend. And now that is only 60% of the market, and it is increasingly shrinking. There is a risk aversion from the banks, as we spoke in the previous panel, because of the recency bias. So even bank capital, is it easy to come by? And where banks show risk aversion, are capital markets an option?
So Lata, like Kaustubh rightly said, banks have been the first place to go for any borrower traditionally. But when we look at infrastructure as a space, which is what I represent and I come from, I think, I genuinely believe that infrastructure being the driver of growth for any nation and any economy deserves to be more like a, priority credit. And if that priority credit status is given to infrastructure, then obviously the banks also, it becomes a little lucrative. Because what happens in a typical infrastructure project company like ours, that when we go out and bid for a project, whether it is a HAM or a BOT or any PPP model for that matter, it's a 10-year, 15-year, 25-year concession that we are bidding for, and we bid it, and the costs and the stuff that we bid is basis that tenor. Now the bank obviously at ab initio levels finance me for that tenor, but then for whatever historical reasons or the risk aversion that they have, there are issues like cash traps, cash sweeps that are built into the sanctions, as we call it. Now the moment a cash sweep happens, the 10-year loan or a 15-year loan effectively then shrinks to 5-year, 7-year, 8-year loan. That may not be the right thing from an infrastructure perspective to do. And that basically then changes the outlook on a project-to-project basis.
So even with public sector banks, you see the proclivity to...
Everyone. Okay. And I am not blaming the banking system or the banks per se for that, because like we all know that it's been a sector which has its own share of grievances, both as a lender as a borrower. But I think given the push that the government is looking at from an infrastructure perspective, I think it's time that the regulators and it's time that everybody, got together and saw this as a priority sector, and thereby, giving it that bit of a push and incentive.
I have been witness to the debate of, or to the ask from infrastructure companies that infrastructure be included in the priority sector. I have not seen that bullet being bitten by the Reserve Bank, for sure. I'm less sure of the government because governments keep changing. But there is a lot of resistance to allowing infrastructure to be bracketed as priority. The only concession the Reserve Bank was ready to give was to allow banks to have higher exposure. If for other groups they had, I think, a 25% exposure, they allowed 35% in...
So, Lata, let me also tell you why...
What I'm saying is the rules are not changing from what I hear.
Yeah, and why do I say that this needs to happen is because, the government themselves have now started looking at participants with a more magnifying glass, so to say. They are strengthening the norms of participation. They are coming up with criteria which basically, kind of separate the men from the boys. And, that way, the financier or the lender should take that comfort that, there is a first level, so to say, filtration happening at the NHI level or at the government level itself. by, if you see the recent hybrid annuity model norms that are being proposed, there is a permissible bid capacity kind of a limit.
Yeah,
that
there is a
they are
net
setting.
worth limit that they are
Available
putting
net
in.
worth
Yeah,
criteria.
I agree with you, and that is removing non-serious participants or extremely risky participants. Certainly, I was coming to it, whether infrastructure projects are being better presented by the government, land acquisition already being done by the NHAI, so that the risk is less in road construction. Okay, I'll come to that in just a minute, but I'll come to the buyer last. First, the issuers. How are you looking at, as a real estate player, what is the mix of, banks, as you told me over coffee, that have also had a bit of resistance to real estate development because the risk weights are higher or were higher in real estate development. I guess they change when the rating of the company changes. But how is your mix? And are you all tempted to come into alternates as defined by Trust Mutual Fund in terms of, people who can structure your debt?
So see, as we all know, Lata, the real estate industry as such has its own phase and challenges that the country has seen, and thereby a particular set of perception got created, which automatically, as we see post-COVID era, is perhaps for the right reasons and for the good, is changing dramatically. And the industry itself is changing dramatically for the good, and which automatically is increasing the confidence across institution and stakeholders, be it bank, be it the debt capital market.
Are you seeing it getting reflected in terms of rating agencies, in terms of bond market pricing, and in terms of bank interest rates?
Absolutely. So which is where, as we as LODA, in any case are the pioneer in this industry. That's one in the country. And we are changing the whole contours of the financing for this industry, whereby what it used to be seen more as effectively a construction finance that one has to go and take. We are saying that construction finance, perhaps this industry for a right participant is not even required, because it is something that will be financed by the consumer.
By the buyer.
So you really would, thereby we are making now bank to change how they need to see the financing for the right real estate participant, and which is where more like a corporate borrowing is stepping in, where the end use is being rightfully being seen through. But so long the money is going for the construction, the money need not be now looked at as a specific project-wise funding. It should be seen more as a corporate. So the culture and the governance is all kind of setting in, because that is what is important for any lending fraternity, wherein the projects need not be done on an SPV level, because that's, you do it all at one, and which is what LODA stand for.
Typically the bond market will be able to glean the strength of balance sheet and the evolution of an industry. Accepting that RERA and several other things have already corporatized or at least cleaned up the space. Is the bond market giving you a better year, a better pricing? And are you therefore wanting to tap it more, or are you still waiting to charge it?
No, as I said, we generally, in any sphere of our business or industry, we take the leadership position. And we have, the financing is no different. We took the position that we will make sure potentially 30 to 50% of our book has to come from the debt capital market. Okay. So, and that's just, kind of last 12 months journey. And as you rightly said, even the industry being perceived differently now by the rating agency, and which is where we have already become a AA rated player from a CRISIL or any, ICRA or Fitch. But equally wanting this industry to go into the AAA family at the first place, whereby the confidence level and thereby the depth of the market or willingness to look at different ways of financing steps in. Because that construction finance rates are, so painful, where every individual customer then need to be taken an NOC from the bank. So the transaction kind of leads to how much of non-value add job that is inbuilt, and which is where the debt capital market again comes in. Because that money is coming in, leave aside the fact that the end use is also can be far more flexible, because in our industry, land cannot be financed by a bank, right? Which is fair enough, but then the rest of the alternate market will do. So you are right. So to that extent, we decided a year back that we would gradually go towards anywhere between 25 to 50% of our book to be represented from the debt capital market. From all this standpoint, including what the earlier speaker said, diversification of capital, the tenor, the pricing, all of that kind of balancing through, and then ensure that the capital is always available at the right strength for the business.
Okay. All right. Well, now let us hear from the buyer. Manish, you know, the debt mutual fund, AUM, has challenges on both sides. The source of money or the size of the AUM, which was rapidly growing up until 2023, has kind of stagnated or slowed. I mean, stagnated is a strong word and a wrong word. It is slowed in terms of its own past and in terms of the comparison with equity AUM. Separately, how is the availability of instruments, issuers? Are you able to deploy your money across the tenor chart?
So Lata, let me answer the initial questions you had asked the issuers, and then I'll come to this
Yeah.
question between the banks and the capital markets. And over a period of time, what I've observed is that everybody, whether it is capital market or banks, everybody is oriented towards maximizing or optimizing their profitability. And if you look at the banking system, the cost of fund, and if you add the OPEX over and above that, you ask the bank to lend to a corporate at 7.5%, 8%. The banks may do that to expand their loans and advances, but will that add to your margins? The answer is no. And which is the reason why banks have shifted towards retail assets, because they make large margins on the retail assets. So I don't think the entire shift of the banking system and the capital market is just to do with who's able to take risk, but it is about who's more efficient in terms of pricing it. And I think the capital markets are far more efficient as far as banks are concerned to price the larger corporates or the infrastructure projects now as well. And which is the reason we've seen that there's been a significant shift from banks to capital markets. The second is even...
Because of the resistance of banks, because of the risk aversion of banks, you're saying, and their preference for retail assets.
Yeah, I think it's about the margins more than risk aversion, because I don't think banks are risk averse at this point of time. They're so well capitalized that everybody wants to expand their book, but they're not making adequate margins on what they're lending at.
I agree with you. In fact, as soon as the acquisition finance rules were announced, draft rules were announced, and I asked banks whether the 10% capital market, 10% of your tier 1 cap is too narrow. They said, we don't think we will use even that, because what will I get there, 6-7% when I lend to a corporate? If that capital market exposure I gave to someone who is investing in IPO or any other capital market exposure, I will easily make 12%. So I don't think it's a question of inadequate cap. I will not even use this, was clearly one of the responses. But please go ahead. So you say that you all have a large play.
Right. So effectively what has also happened is, yes, Kaustubh also said the source of capital has also changed. We've got new vehicles and new instruments which have come in. I mean, look at the REITs and InvITs. I think they're excellent instruments where, once the asset is constructed, the way it needs to be financed, if it is well ring-fenced, the cost is so low right now, and there's so many, availability of capital from the capital markets on those instruments. The cost is, very close to where a bank raises its own deposits, right? So I think the cost of funding for these vehicles have gone down. Secondly, as far as, the upper tier risk is concerned, I think the other thing which has happened is doors for alternate credits has opened up. I remember, till 2020, it was only the mutual funds which were taking the larger credit risks in that, non-banking market. Now, the alternate funds performing as well as distressed funds, they've come up, and the size has become very large. While I understand after 2023, the taxation has changed for mutual funds, but at the margin, what it has done is a lot of flows is now getting channelized into these alternate vehicles, and but the ask is high. So effectively, their threshold is anything between 12 to 20%, and which is why cost of fund for them is pretty high. So which is why now we have a tierization in place. If you want a lower cost of funding, mutual funds are the best vehicles for you to get it, or maybe insurance companies or pension funds. They are the most efficient people to subscribe that kind of a capital to you. And if you want a much more riskier capital, then I think the alternate markets have also come alive. So I think there's a big spectrum of capital available from an alternate plus capital market perspective to the entire, corporate industry.
But what is your ask from the issuers? Are you ever in a situation where you have the money, but the issuers are not tempted to come to the capital market?
I think it's always between the price. The price is where, the entire negotiation is. Because I don't think the appetite, is where the problem is. Okay. And which is where, if banks are more efficient at a particular point of time, because they have capital and credit growth is slow, banks will be able to overprice for a short period of time mutual funds. And when, mutual funds or insurance companies, they have larger pools of money, they will be able to underprice. So it's always about the price. I mean, risk always gets priced, and therefore the corporates will look at whether ECB is cheaper for them or the INR markets are cheaper or, banking market is cheaper. So they will always move in terms of price. So price dictates where, money flows.
Fair point. Okay. Now let me come to, since you raised the issue of ECB, it occurred to me, we should be asking you, Kaustubh, that specific point. 2 new doors have been opened, bank financing for acquisitions, and you guys are big in that space, and ECB is becoming easier. Do you see these becoming important sources of debt capital for a group like yours?
No, certainly. I think ECBs and bond markets have both always been very core sources of financing for us. I think the opening up of those sources for M&A is what has now changed, right? For the acquisition financing bit, and I think they're hugely positive.
ECB has been eased even otherwise in terms of
the tenors and the pricing. Yes, I understand that. So they were already very core parts of what we do. I think we are very regularly present in the ECB markets and the dollar bond markets, which are part of the ECB markets in a way. And we'll continue to be. I think the opening of that market only helps us even more. But I think the move which is really, really game-changing or has the ability to be game-changing is allowing banks to do acquisition financing, which for a very, very long period of time has been an ask both from the banking system as well as from the issuers. And finally, I think the Reserve Bank has exceeded. I think it's taking cautious steps. If you look at the draft regulations and some of the restrictions which are there in terms of either only the 10% of tier 1 capital or it being allowed only for listed companies, 3-year profit making, the debt equity, etc. So I think they're a little more prescriptive at this stage. I think as the regulator gets a little more comfortable that the market is developing in an orderly manner, I think this will probably get relaxed in due course and will improve further. But this is definitely a very, very important move because even for a large corporate group like ourselves, which has access to a lot of financing, when it comes to M&A financing, cost-efficient M&A financing is still a very restricted pool of capital, right? So you can go to the...
So the alternates are expensive.
Yeah, so you can go to the mutual fund segment, for example, but if for example, you're doing an acquisition which is an FOCC vehicle, a foreign-owned vehicle, you're doing a joint venture with a foreign partner and then acquiring an Indian asset, domestic institutions are not allowed to finance it. In which case, where do you get that financing from? Then either you go the alternate route.
New ECB rules, I think banks with a lot of foreign branches and therefore a lot of foreign,
so my reading of the draft guidelines of even the ECBs is that ECBs are going to be permitted even for domestic acquisitions, right? So both ECBs
that is
as
the
well
right
as,
reading,
correct.
And that is apparently the intent.
Correct.
So you think that the bouquet of sources
absolutely,
is going to...
yeah, absolutely. I think it's a big move. It's a move in the right direction and will provide a lot of relief for any of the inorganic activities that we
So should we see a lot of consolidation then? I mean, out of syllabus question, but because the money will be available, will we see a...
So I don't know whether just the availability of money will drive the consolidation. I think M&A activity has been at a heightened level if you see over the last couple of years. For this year has been very active on the M&A front as well. I think the cost of doing that M&A will certainly reduce with a larger pool of liquidity available for the financing.
When India's inflation trajectory started declining, the way we saw in the last 2 years, I was naive enough to believe that ECBs will go through the roof simply because the interest rate differential between dollar and rupee was bound to decline. And therefore, my sense was that there will be a greater attraction for foreign capital. Of course, Liberation Day and the events changed the grammar, but that will pass. Do you think that, as this disruption gets over, the combination of easier ECB rules and ECB financing for domestic acquisitions can take center stage as a source of finance?
Yeah, I think they certainly can. If you look at ECBs, right, what stopped you from going for ECBs as the base case? It was restrictions on average maturities, not for the larger rated issuers, but pricing otherwise would have been a restriction for...
was not an issue?
It is an issue, but you can always hedge, right? You can price it and you can always hedge. Tenors is also a restriction because typically if you look at ECBs, 5 to 7 years is a typical tenor for which a majority of the ECB market exists. If you want to do a 10-year ECB even today, it's a small part of the market, right? So I think reducing tenor restrictions, end-use restrictions, allowing them for M&As will certainly see a much higher utilization of the ECB market for even your regular business needs, and not only for capital expenditure, which is where ECBs were otherwise mainly getting utilized.
Fair enough, fair enough.
Lata, just to add to what Kaustubh is saying, while the opening up of ECB is obviously a very positive sign, but I don't think it basically addresses all the sectors. And Sushil would agree with me to some extent that a sector like real estate or a sector like infrastructure, while I may be tempted to explore an ECB kind of an option, but given the inherent risk of the longevity of our projects and the erraticity of the cash flows, it becomes that much more difficult for a company or a corporate like ours, especially in the infrastructure sector. But otherwise, in a normal manufacturing setup, yes, obviously it makes a lot of sense. But somewhere like an infrastructure sector or a real estate sector or something which is more, completely rupee-backed, I don't know whether as a CFO or a corporate, I would want to take that exposure.
No, that's a fair point that this perhaps addresses manufacturing. It doesn't address infrastructure, and certainly not infrastructure in its construction phase. Maybe in its build-out phase.
Well, I don't even think in the build-out phase as well.
So, since you've started that conversation, what would the ask be? It looks like the government has solved several parts of the long-term financing or the debt capital requirements. The ECB, the bank financing, allowing alternates, SEBI giving more encouragement to AIFs, have solved various parts of the debt requirements. The one that apparently is not yet resolved is the construction phase of infrastructure, which even someone like Manish will not be able to finance. What will be the ask there? You did say priority sector for infrastructure would be one way to look at it. I don't know if that will ever come. But what would the other ask be? Would it be, I don't know if Mr. Rajchandra is still there, but partial credit enhancement by a NAB-FID is the way out?
Yeah, so I was just about to, come to that NAB-FID is a step in the right direction. And I think it's recognizing the fact that infrastructure does need partial credit enhancement. It does need funding at various different stages of the project life cycle. So therefore, yes, that is a step in the right direction. And like, the finance world and the banking and the capital markets have evolved over a period of time. Regulations have changed for the better. And I'm sure it's a process of evolution and it's change which is constant. NAB-FID, like I said,
intermediate backstop organizations would be another ask from you.
Yes, and I think a little, like I said, viewing it with a more kind of an open mindset is something that all the participants should look at it, given that there are enough filters now in the system itself.
Okay. Well, I guess the government has also solved some of the problems by cleaning up the way in which they bid out infrastructure projects in terms of land acquisition.
So I would only add to that, Lata. I would say that the country definitely needs more project financing institutions, right? Because you need capital at every stage of a company's growth or every stage of a
and that is the lacuna
project
which is not
cycle,
filled,
right?
you think?
You did have institutions like IDBI, ICICI, IFCI that used to do it. Those have all gone away.
Yeah.
And everybody's moved into that narrow banking phase. So I think you do need, India needs to become the manufacturing hub for the world, India needs to create a lot of infrastructure. You need the risk capital to be available to finance those kind of projects in their developmental phase. I think that is clearly a white space today.
You know,
I think Kaustubh said the right word. It's the risk capital and not the risk aversion that currently we, keep on facing.
Yeah. No, I mean, I think the country tried several ways from the Development Financial Institutions Day, tax-free bonds. They went the entire gamut and then found that the FISC couldn't support beyond a point, and it had to bail out all the DFIs or merge them into their own banks. What would your ask be, Sushil, in terms of raising debt capital? Do you think now the market is available? It's only a question of you tapping the right tenors and the right structures. Is there any ask in terms of what can be done better?
I think with various, call it liberalization or, more conducive framework that has been brought in, including the much awaited, acquisition financing, I think the overall pool of capital perhaps is reasonably available. The newer project will always perhaps can go to the bank, but at the same time, some projects also keep getting completed. So thereby, on a particular company balance sheet, there is a mix of projects. And thereby, there is an opportunity for each pool of capital to coexist. The banking capital can continue to exist for, let's say, the newer, upcoming, under construction project. The completed project can go for REIT, invade the debt capital market. More aggressive, the business aspirations can even go to the more structured, alternate private capital.
So you're saying all parts of your needs are definitely
Yes, to my mind, yes. In our industry, we have certain end-use restrictions from the banking capital, but nonetheless, then immediately the debt capital market exists. So thereby, and even the banks are, to that extent, I see, are willing to forthcoming in understanding and wanting to go beyond the construction financing.
Fair.
So for a change, which was difficult to kind of even comprehend perhaps 18 months back.
Yeah.
But we have seen at least in the
speaks
private
to the
banking
corporatization
space.
of
Yes,
the
private
real estate.
banking space, this has happened. Public sector bank is still perhaps, some more time it will happen. So thereby, I don't think the pool of capital or to cater to individual situations, now we have restrictions. But if we were to grow the debt capital market, which our aspirations as a corporate would be, then we need a reasonable amount of tenure flexibility. Obviously, the rating flexibility, because if that capital exists only for certain specific set, and the secondary market, because I think one of the primary reason perhaps for the debt capital market to kind of grow in depth is also the secondary liquidity, that how much is the secondary trade happens. To my assessment, I think it is very meager.
Yeah.
So this has to kind of change dramatically for both the issuer obviously would like to, but equally the subscriber, the investor, the Manish to come forward.
Manish would definitely want in terms of secondary market liquidity. Manish, there is another person who is on your side. And I want to know if Hani Jalan is there. And there's only about 5-6 minutes for questions from the house. But Hani had a lot of questions. If she can come up and ask some questions. Or is she busy with hospitality? Okay, the question is thrown open. If anybody from the audience wants to ask the panel. Yes, there's someone over there. Can the mic be handed over? You have a mic? No, take this. We have enough mics.
Okay. More than a question, I have an observation. Since this is a seminar on debt, and I am a CFO of a company which was BBB plus and now A minus, but still, most of the commercial banks today are actually, insisting on margin monies for LC, then, this 25% drawing power, which is not a phenomenon globally. I worked in Europe as a CFO, and it doesn't work that way. So, a lot of these fintech companies and the trade credits of the world are actually capturing this space where the traditional debt givers, even including some of our top private sector banks like ICICI also, which is one of my favorite banks, but they also are not, letting go of that margin percentage in the LC, non-fund-based instruments or in the drawing power, whereas international banks like Citibank, HSBC and all are doing exactly the opposite and gaining market share. So what's the opinion that how the Indian commercial banking should prevail going ahead?
Well, I wish you were there in the previous, at least we had Rajkiran Rai as a former banker on the panel. You have a set of people who will be on your side.
Yeah, I was just about to say, we are all in alignment and agreement with you that everything should be free.
So we have to invite a banker to answer your question. Maybe they're thinking on those lines. The nearest we have is an AMC owned by a bank, if he has anything to say.
No, I think, you know, banks from a corporate perspective, I agree, they've become more risk averse than they were in the previous cycle. And of course, you know, it was because of the reason, you know, why the cycle impacted the balance sheets, NPAs. I think risk aversion is reducing now, and you know, in my view, way forward, banks will be more open to get into some of these areas, including working capital financing, because you know, retail segment is something which is maturing as an asset class, and which is why they need to diversify from a balance sheet perspective. So I think as we go ahead, when they want to expand their credit book, they will have to do all of these things.
No,
thanks a lot.
That's extremely well put. Retail is definitely saturating, as you very politely put it, maturing, and therefore banks perhaps will start looking out for corporate credit.
Good afternoon, panelists. My name is Sonia Kumar, and I have a question.
Closer.
Ma'am, I have a question for you, since you are at the helm of current affairs always. So my question is that you have been talking about REITs in which all the infrastructure development, etc. But last week, the government of India has come up with bonds which are called CAT bonds, which is a short form for catastrophe bonds, which has been issued in collaboration with the National Disaster Management Association, ma'am. My question to you is that how well these bonds are going to be accepted by the industry, by the insurance and the banking sector, and how the government should incentivize the public to, you know, subscribe to these bonds, and what do you think should be the interest rates?
Okay. Well, actually, yes. You know, both climate bonds as well as catastrophe bonds would come somewhere in the same degree. And I would be actually on your side asking that question. It's just that it was outside the realm of this panel. But Manish, you may want to take that. What kind of pricing will work, you think?
Lata, I have not gone through, you know, the details of the CAT bonds. But broadly, you know, the way I look at it is even for green bonds, for that perspective, you know, for the issuer as well as for the, you know, investor, the idea is what do you benefit out of investing? Yes. Definitely in green bonds, you know, we've seen that the global investor community wants to get into greener areas. So you generally get a diversified source of financing when you get into greener areas. From government's perspective, it does help in terms of broader objective of, you know, making the entire industry environmental friendly. Similarly, you'll have to create use cases on both sides for catastrophe bonds as well. I'm sure, you know, from a issuer's perspective, they have to cover their risks, and therefore catastrophe bonds does help. From an investor's perspective, the investors also will have to sense what is the advantage they have. And if it does, then I think the industry will grow.
So it will be a higher pricing, a more expensive yield than other bonds. But
so if the risk levels are high, then definitely that has to be priced differently in the catastrophe bonds.
I think it's too small right now for anyone to be able to price it. I think it will be experimental.
Lata, I think, you know, this only gives us a hope that if there could be a catastrophe bond, I'm sure there could be better ways of better instruments and better ways of financing for at least real estate infrastructure projects.
Okay. I feel your pain, Hardik. I feel your pain.
I think the insurance industry is better suited for catastrophe
That's what I thought.
situations.
It's more an insurance and maybe pension, but definitely an insurance industry product. But they will be better placed to price it. It's not something which I think a capital market person will be able to price so much.
And maybe just to add on the pricing, right? I think international experience has also shown us, if you look at the experience of green bonds, yes. Everybody started with the expectation of what people call greenium, right? Which is you should get a premium for green bonds. But until there are pools of capital or conscious capital which are willing to live with lower returns, at the end of the day, if you look at the entire green bond issuance across the world, you do get access to new pools of liquidity.
Yes.
But I don't think it has been demonstrated that there's any significant pricing benefit that anybody is really getting out of it.
Yes.
Well, thank you very much. We are clearly out of time. It's screaming time's up. I think the key takeaways clearly is that debt capital market is able to service a whole range of requirements of manufacturing, real estate and industry. The place where the gap still remains is how to finance initial or construction infrastructure. Developed after post-construction infrastructure is still, the takeout financing is there, and you have got InvITs and REITs to be able to churn the constructed asset, but there is a problem with infrastructure financing. Thank you very much. Okay. They've been kind to us and said that we are allowed to take more questions. So if there are more questions, yeah. Oh, Honey, you're back here, then I think you will have to ask your question. We were missing you in the audience. The mic is there.
Thanks, Lata. I think I'll leave a question up to everyone, and I think we asked this in the speaker room also. What I think the issuers would like from markets for them to come to debt markets. So what is it that you would need that will bring you to markets? I'll leave that as a question.
Okay. As a buyer of bonds, you are asking the issuers,
yes,
what do you want to come to the market?
Yes.
Well, the complaint is that you are not issuing enough bonds. What incentive would you want?
No, I think it's not a question of any special incentives, right? I think anybody does anything if it makes business sense, right? That's the fundamental.
Is the lack of secondary market one of the disincentives?
I wouldn't say that, because see, I think if you look at this year, if you look at Manisha's market, the way the mutual fund market, right? The market has grown significantly in terms of scale, right? If you look at some of the most recent acquisitions, a large chunk of those acquisitions have been financed through the mutual fund markets. If you look at some of the deals in the high yield space, right, 19-20% deals, we know that there was a very large refinancing that happened. There were credit funds at a cost, but credit funds were able to provide you with that liquidity. So I think it's purely the whatever makes business sense, right? So the way we look at it is, we are a large company, but always in a growth phase. So for whatever we need for greenfield, we would go to a bank. Whatever we need after the project becomes operational, we would go to the mutual fund market, the ECB market, to a dollar bond market, so on and so forth. And in limited situations where we are looking at very, very bespoke, structured deals that don't fit into your conventional space, is when we would go to the alternate market. So I think there's a role for everybody. I think what Hani is referring to is that if you look at the traditional rupee debt capital markets 10 years ago and today, the market has grown in size, but at least my view is that in terms of composition, right, in terms of what tenors that market gives you, in terms of the category of issuers that is able to tap the market, it's pretty much remained similar. So when you ask any corporate about accessibility of funds, you might get two very different answers depending on whether you're talking to somebody who's a AAA or a AA rated versus if you're talking to somebody who's a MSME, right? And where the issues related to availability of capital are very, very different.
No, actually, I sympathize with Hani's point of view, because when I look at the nature of issuance, the maximum is public sector NBFCs. So it will be your PFCs, RECs, which will dominate. Next will be public sector non-financials. And then will be private sector financials. And practically the list ends there. Then there is a trickle that comes from, manufacturing. Am I right, Hani? That's your complaint. The issuance from non-financial private is still
so I think,
few and far between.
I think...
Sushil, that complaint is there for you also.
No, in fact, perhaps, as I said, we are honoring what Hani wants, because we said that we are wanting to have the composition from the debt capital market going more in the range of 30 to 40, 50%. So I think the bigger issue will always remain, because even from a cost of balance sheet standpoint, or any business for that sake, so long the operational assets starts looking into the next pool of capital, which is going beyond bank, I think there is a space for everyone. It's just the, the cost parameters, if it's not getting delivered or a tenor doesn't get delivered, by default, it will end up in restricting to the same traditional Indian banking system. So which is where a thought process need to change both sides perhaps.
No,
And
I think this
they
will
will
not
come.
be resolved on the dais. It'll be resolved if Honey has a coffee with Manish and Sushil and Hardik after the discussion. There's only one person who is full scale willing to come to the corporate bond market. Thank you very much, gentlemen. It was an enlightening conversation, and I think we've more than made up for our time. Thanks a lot.
Thank you all. I'm going to request Abhishek Kedia and Sujal Desai from the Trust Group to join us on the dais to present mementos to the esteemed panelists of this session. Please stay with us on stage. And yes, please do come together for a group photograph of the session. Please, आइए. Mr. Kaustubh Kulkarni, thank you very much for joining us at IDCMS. For the second business panel of the day, we thank you for taking up the time, for your presence. Mr. Kaustubh Kulkarni, we'd like to present you with a memento, a token of our appreciation. Mr. Manish Banthia, thank you, sir, very much for your time and your presence here this morning. Mr. Sushil Kumar Modi, thank you to you too. All the panelists, please stay on stage for a group photograph. And Mr. Hardik Debar, thank you very much to you too for your presence here this morning. Have our photographers got their shot? Thank you. Once again, thank you to the Honorable Moderator, Latha Venkatesh, for steering proceedings in as able a manner as she does always. And thank you once again to the esteemed panelists. Thank you all. Ladies and gentlemen, once again, reminding all of you here that you can scan the QR codes that are across tables in the audience seating area. We have projected the QR code a little while back on the screen, if we can have it on screen again. You can access the knowledge vaults that we've so painstakingly put together after every session. Scan the QR code and there it is, right there for you to access and gain knowledge from. And now, ladies and gentlemen, we are going to play for you 2 short films, after which we will straight deep dive into the next business session coming up. For now, please remain seated. Please keep those mobile phones and gadgets in silent mode, please. And please give us your attention on the screens. And with that, once again, ladies and gentlemen, settle down, take your seats, please. We at the Trust Group are blessed to see the kind of growth that we have seen as an organization over the last few years. This can only come from that one belief that we stand by: what goes around comes around, the basis of which is our service-oriented approach to our clientele and the market. And I hope we continue to walk in the same stead in the years ahead. Time to head into the next business panel of the day. Once again, please do settle down, take your seats. Over the past decade, esteemed delegates, India's bond market has undergone a significant transformation, especially in the period following 2015. Evolving from a space primarily dominated by central government and large corporate issuances to a more diversified platform that includes state entities and infrastructure-linked projects. The market has deepened with increasing ticket sizes, wider investor participation, and greater acceptance of long-term instruments. This conversation is now going to take stage at IDCMS 2025. Navigating towards the next session, here we are with state-level financing pathways, potential, and challenges. To lead us through this conversation, please welcome on stage Mr. Anindya Sen, Head Structure Finance, the Trust Group. Welcome on stage, sir. Good afternoon. Honorable Moderator, welcome. Do take your seat on the dais. The esteemed panelists of this session, ladies and gentlemen, please welcome them on stage with a round of applause. Dr. Sanjay Mukherjee, IAS Metropolitan Commissioner, MMRDA. Namaste, sir. On behalf of the Trust Group and all of us here in the team, we thank you for your gracious presence, for taking the time out and joining us here this morning. A very warm welcome to you, Dr. Sanjay Mukherjee, ladies and gentlemen. Shri Pankaj Kumar, IAS, Managing Director, UPPCL. Namaste, sir. A very warm welcome to you. Thank you for taking the time out and joining us here this morning. Dr. Devendra Kumar Pant, Chief Economist and Head of Public Finance Ratings, India Ratings and Research Private Limited. Namaste, sir, and good morning, and a very, very warm welcome to you on behalf of the Trust Group and all of us at IDCMS. Also, ladies and gentlemen, please welcome Mr. Deepak Sood, Partner and Head Fixed Income Alpha Alternatives. Ladies and gentlemen, I urge you all to put your hands together for our panelists here, please. One after the other, we are bringing to you from the IDCMS stage power-packed sessions Please welcome them with a round of applause, a token of your appreciation and ours too. I now hand this over to the Honorable Moderator.
Good afternoon, friends. I take with pleasure the privilege of welcoming the distinguished panel members and all of you to this session on state-level financing, pathways, potential, and challenge. This is a topic which is extremely relevant in the context of the socio-economic development and resilience of the nation. In India, it is the states and the development authorities like MMRDA who shoulders the responsibilities of translating fiscal policies into tangible development assets. Financial soundness and timely implementation of critical infrastructure projects by states as well as large development authorities are therefore extremely crucial for us to achieve our vision of having a Viksit Bharat by 2047. The health of the states have improved significantly in the post-pandemic period. The fiscal deficit of the combined all the states is expected in the current financial year to be around 2.9% of the state GSDP, which is within the prudential limit. However, the fiscal health varies across the state. One of the main or the major concern is that 50% of the aggregate revenue of the state is utilized for payment of salaries, pension, and interest. Another substantial portion goes towards funding subsidies. So this pressure has forced the states over the last few years to curtail capital expenditure, which is detrimental to the long-term development. To remedy the situation, central government has started providing fund support to the state under special assistance to states for capital expenditure scheme and capex, and particularly infrastructure assets built up has shown significant growth in the last 1 year. States, almost all the Indian states in this fiscal has been bit more aggressive in raising debt through SDLs. The aggregate SDL issuance in the current fiscal till date is to the tune of around INR 6.25 lakh crores, which is higher by about 20% compared to the corresponding period of the last year. This has put pressure on the SDL pricing, and as a result, the spread between the SDL and that of the sovereign securities have increased from 40 bips in the previous year to the present level of 65 to 70 bips. It is understood that states are taking adequate corrective measures to remedy the situation to the extent possible. Indian states as a whole have achieved significant fiscal consolidation during the post-pandemic period. However, the path to fiscal prudence is still long and more needs to be done. This can be achieved by following a multifaceted approach of enhancement of revenue, rationalizing expenditure, and implementing institutional reforms for more stringent accountability and transparency. Today, our distinguished panel members bring with them a wealth of expertise and experience. They represent diverse perspectives from policymakers to economists, financial, credit, and investment expert. We eagerly wait to get ourselves enlightened with their views on the critical aspects of today's discussion. I would first like to go to Dr. Mukherjee and hear his views about the best possible roadmap for monetization of assets which are revenue generating or which could be generating that a large development authority like MMRDA has, and they can generate incremental revenue for deployment in further asset build-up.
Thank you so much. The issue of money is something which is very important and something which is highly debated. I think more important than that is the issue of skill, of procuring the money, using the money, or rather managing the money, and ensuring that an adequate return comes out of that. I think that is a very, very precious skill, and that is something which is very, very short. And in the government sector, that is something that we really, really need to look into. Now, as far as this state of Maharashtra is concerned, we have been monetizing assets for a very long time. For instance, I'll tell you that there is a place where there's an Nagpur Improvement Trust where I had the good fortune of being the chairman. It was established way back in 1937. And in 1937, NIT has developed almost 2/3 of the city, and therefore the city is a planned city. And this thing has been done by its own resources. I was told so they invented these things like, development premium when nobody else thought of development premium. They invented something called as a betterment charge, that when I bring in infrastructure, then there is some betterment that happens. And when you sell your property, then everything comes on the property. So when you sell your property, you have to do that. Later on, when entire Maharashtra got the Town Planning Act, so we had, land was essentially the asset. So first is development charge. Second was additional FSI, so sale of additional FSI, the development charge on the additional FSI. Then we invented something called as a transferable development right. A transferable development right essentially is giving us the ability to print notes. Because when I allow in any space TDR to be, or FSI, to be shifted from one plot of land to another plot of land, essentially I'm selling that plot of land, that much land to the other party. But there is no cash which is being used. So we started acquiring land using TDR. So for instance, if it is a DP reservation, so we acquire that land using TDR. So that is one mode of asset monetization. Then as things moved on further, then we started this practice. As we acquire the land, you develop the land, so your own land becomes expensive, and then you sell the land. So when you sell the land, we started this practice that you cannot hoard land. In Maharashtra, development authorities, government land you can take and you can build when you want. But land which comes to the development authorities, whether it is MMRDA, whether it is CITCO, whether it is PMRDA, NIT, or any such organization, you have to build it within a particular time period. Generally, it is 3 years and then 1 more year. So the land is auctioned as a lease. You raise money out of that. You get a lease rent. That is another thing. Third is that if you don't build in a particular time period, 3 years, then you have to pay an additional lease premium. So there is an inbuilt fine. So there is no advantage of hoarding land, because if you buy land from these agencies and you hoard it, then very soon the cost of your, or rather the additional lease premium shall be more than the cost of the land, So various mechanisms like this have been thought of for raising lands. Then we found that we are having encroached lands, and we found that we are having things for redevelopment. So then we gave, again, FSI, whereby the private sector came in. The private sector got in money from the market, and they were given additional FSI to construct saleable components. And by means of the saleable component, they would fund the redevelopment, and they would be able to generate a profit for themselves. Just cut one step further, we brought in the Slum Rehabilitation Act. In the Slum Rehabilitation Act, you are essentially giving land with a defective title. The land is encroached. The land has a reservation. So here, the slum dweller is getting rehabilitated, but in return, the developer is getting a substantial portion of absolutely clear title, vacant possession, unencumbered land, and he's getting a lot of FSI, you know. So all these mechanisms of land monetization have been brought in. And finally, when we started developing these, because Mumbai is a linear city, and essentially there was an eastern way and the western way. So we developed two expressways, you know, the Eastern Express Highway and the Western Highway. Now, along these highways, the FSI was decided to increase. We brought in what we call as a transport-oriented development. Later on, we have brought in this whole metro network. Now we are building a network of 7 ring roads around Mumbai city. So all these things, we are bringing in a concept of transport-oriented development, two-pronged action. The societal benefit is this, that when there is higher FSI near the transit corridor, then people can walk to work. So you are having a societal benefit out of that. The other benefit is that this this extra FSI that you get as a result of this, you are able to, monetize it, and you are able to fund the infrastructure. There was an issue that how do you value this additional FSI, how do you value it? And there were various problems of lack of transparency, lack of, various other problems. So that was resolved because you have a transparent mechanism whereby you decide the ready reckoner price or the circle rate as it is called in North India. So everything now is indexed to the circle rate. Therefore, the formula is very clear. And in these ways, several mechanisms in Maharashtra has been built by, of monetization of the existing limited scarce resource of land has been worked out. And I would like to tell you that Mumbai and MMR region is perhaps the only region in India which actually organizations here, the BMC, the MMRDA, SIDCO, MHADA, we do not look at the government as our primary source of revenue. We look into ways and means whereby we can raise our own resources. For instance, last year, we have been able to raise an infrastructure pipeline which will be executed over the next 10 years, which overall works up to $100 billion. So this is something which we have done without involving the government of Maharashtra, and later on we involved them. And as the government of Maharashtra got, of course, the chief minister, the deputy chief minister, they are all chairman of our authority. So that way, the urban development secretary is a part of our authority. The finance secretary is a part of our authority. So all these people are involved. But as a government, as an entity, we did not involve them. We went to them for certain things, like multilateral loans when you take, so for government guarantee. So in this way, that's what I said. The most important thing is money has to be available. But I think today money is available. What is missing, and I think I'm very happy that such events are happening, is the skill set to acquire that money, manage that money, use the money, and not use the money in a project which does not pay for itself, so that you are able to maintain the fiscal discipline.
Sir, very enlightening update which you have given. It is extremely interesting to know how MMRDA has not only monetizing assets through sale, but also optimizing return on land, which is available, and through development fees, then impact fees, and other mechanisms, which only recently some few other development authority have started following. Thank you, sir, for your insights. I would now like to, in the same vein, go to Mr. Pankaj Kumar. Sir, what do you think are the prospects and challenges for monetizing state-owned transmission assets? Since we have couple of InvITs housing such assets, there is understanding and probably incremental appetite for buying such assets. Sir, what are your views on the subject?
Thank you, Singh Saab. Transmission assets have been identified as one of the critical infrastructure which needs to be monetized over a period of time. we need to understand that transmission anyway is a very profitable business. Amongst the power sector, you have three very distinct verticals. One is generation, the other is transmission, third is distribution. Generation and transmission by the inherent nature are profitable because there is no public interaction per se involved. The procurement is done by a distribution company. Transmission is done by a company which is between generator and the distribution. The entire public interface, collection of money from the consumers, doing the entire hard work of maintaining the network at the local level, the LT level, is all comes to the distribution side. So asset monetization is a very easy thing. Even listing, which is now being recommended even by the Ministry of Power, is something that most of the transmission companies are looking at. So I think asset monetization or listing or InvITs are something which these companies will go into in future. They have to see how much will their privatization or the profit increase by this, because they're already profiting. They have a almost assured ROE of 14.5%, which comes through tariff and which they do not have to collect, which is collected by the distribution companies given to you through them. So asset monetization in these two sectors is something which is going to happen. Generation becomes more of critical infrastructure from other points of views as well. So that's less there. But in transmission side, you have a huge scope for that. In a way, with TBCB coming in, tariff-based competitive bidding coming in, that is already happening in a different way. So asset monetization is more or less something which will happen in those sectors.
Thank you, sir. I think the InvIT housing transmission assets are quite aggressively looking to buy state transmission. And so this is a very enlightening input from you. Thank you, sir. I now go to Dr. Pant. Sir, in the light of what we have discussed about asset monetization and monetization of transmission assets, and what Dr. Mukherjee has emphasized, that whatever revenue comes out of it is to be deployed in profitable asset creations for future. Sir, what would be your view as a rating agency on these developments?
Thanks. Look, these are additional revenues for these companies like institutions like MMRDA or the UPPCL. Ultimately, end of the day, we have to see the liquidity, how liquid that asset is. And sir, please don't mind, you may be having 1,000 crore of land bank, but if the payment is to be made within 10 days' time, whether that 100 crore can be utilized or not. Yes, as long as there is a strong pipeline, there is a visibility, revenue visibility that this revenue will keep on coming. Yes, it will add to the cash flows, it will add to the profitability, but as a rating agency, we look more for the liquid asset. Now, what happens is, these liquid assets, they are not a regular source of income, right? If I go more in the pure EBITDA terms, they are the other income. So we have to rely more on the regular source of income. Yes, these will support. Now, most of the new transactions which has taken place in state space is most of the escrowing of these revenues, structure of securitization of those revenues. In that, what Mr. Mukherjee has said, like, it's the issue of how you will manage that money. Is it the manpower issue? Are these institutions financially so savvy? Are they in the line? Are they able to know the finer aspect or nitty-gritties of the financial world, right? Because as a rater, if anything due today, if it is paid, it's timely. Even if it is 10:01 tomorrow morning, it's a default, right? Because as the regulators prescribe, single rupee, single day. So if there is a proper pipeline and there are demonstration, it is demonstrated that they are able to do it, right? UPPCL was first example way back in 2017, right? Where RBI as a banker to the state government, full support of the cash flows of the state government, was able to raise money in the market. So these are new developments. Shouldn't be saying new developments, 7-8 years this has happened. So we look at those very closely, how the pipeline of those, how they are being the monetization plan, but we should be mindful of that asset monetization even at the sovereign level, right, was able to give what they are not able to achieve fully what they every year they target for. Yes, it's another source of revenue for them.
Thank you, sir. I think what you pointed out is very relevant, and Dr. Mukherjee, I'm sure, has this in mind, because when he talks about asset monetization, the servicing part he would definitely take care of, and adequate revenue from either such monetization or alternate sources would be provided in the escrow to ensure timely servicing of the debt.
I'll make a very quick response to the point. It's a very, very valid point. I mean, it doesn't matter if I've got, 1 lakh crore in landed assets. What matters is what is the cash, and cash is king.
Yeah.
So I think, see, in governments, and I will be talking from the government perspective, because even if I worked in a company, it was a government company, so I'll talk from that government perspective. Government thinks, so in the government we think कि भाई budget क्या है, और budget में पैसा है क्या, and revenue and expenditure are totally divorced. So I plan my thinking, there is 100 rupees in the expenditure side in my budget, so I plan for this. So that is where I said the skill set comes in. The thinking has to change from a budgetary thinking way to a cash flow way. We have to see what is the cash available. What can we spend in that particular way? And great strides have been made. For instance, in 2004, Maharashtra introduced the budget distribution system, whereby though we have a budget, there is a cash flow which comes in. And so every department gets a particular amount of the budget to spend, And so they spend accordingly. And if you don't spend it, then that lapses. Then you have to again ask. So that is a very simple cash flow. As far as MMRDA is concerned, we do make a budget because the Act requires it. But we manage by looking into what you said, the cash in the bank. And when you take debt, the first thing is that you cannot default. And in government, we are ultra conservative, so we would like to pay the debt a few days before it matures, Because for us, it is not just a default. There are several other spin-offs which happen, which are very difficult to manage once the default does happen. So we have, therefore, we need to change our thinking from the budgetary point of view to a cash flow perspective.
Just adding on to it, sorry. In fact, whenever there is a debt instrument we raise, like we have raised the bonds in 2022 as well, the repayment mechanism or the servicing mechanism has to be not only robust, not only that the cash should be available, it has to be extremely SOP, has to be followed to the last letter T. Because one slippage, even innocuous or bona fide, leads to a huge effect on your rating as well as the entire spiral, new spiral which comes about of that. So apart from having money, having a protocol, ensuring the people are there to follow the protocol, and ensuring that it's done is very, very important. Because that ability, if it's missed even slightest, has a huge domino effect otherwise.
Thank you, sir. I would now like to go to Mr. Sood. Sir, you have heard from Dr. Mukherjee, Mr. Pankaj Kumar, Dr. Pant, that how the PSUs view the sanctity of providing adequate resources, cash flows for servicing their bond, not in time, but they are ready few days in advance. And that point has also been highlighted by Dr. Pant when he considers giving good or high investment grade credit rating. Having said so, sir, with all these features, we have seen bonds coming in the market. Like, for example, UPPCL was the first one in this structure to come somewhere in 2017. We are seeing good traction from the investors. And considering the kind of governance we have, the credit quality is very similar to SDLs. However, though there is exponential increase in the number of the investors, certain category of investors are still fence setters. Now, what do you think could be done from investor perspective to assure them about the quality of these instruments and broad-base the investor universe?
Thanks, Anita. So from investors' lens, if we look at the newly introduced structures you mentioned about UPPCL way back in 2017 and some of the recent issuances that we have seen, those are very well structured bonds compared to the early generation bare guarantee kind of structures. So if there is a proper structure backed by cash flows trapped into a proper escrow mechanism, then there are various investors who would be looking at these kind of investments. So the issue is investors want simplicity and clear understanding of the structure. For example, if you are talking about a guarantee in a particular structure, the guarantee has to be vanilla, irrevocable, unconditional guarantee towards servicing of both principal as well as repayment, as well as interest. Now, if you looking at some of the documents, investors feel uncomfortable because there is vague language used, or before enforcing the guarantee, the trustee has to get involved into a lot of enforceability related issues. So one foremost, very simple standardized template to be used by all the borrowers, all the state, irrespective of state, about the guarantee. Second, about having a proper escrow mechanism to trap all the cash flows. Third would be having a proper DSRA. DSRA not just for the namesake, DSRA to be in liquid form or treasury bills. That gives comfort to the investors. And one other aspect that most of the investors have been asking for is post-issuance surveillance. So how the trustee is monitoring it, what sort of mechanism is available in order to remit funds from the state government directly to the investors? Does it require too much of administrative hassle? So these kind of things need to be streamlined so that investors look at these kind of investment as high quality credit bonds. You mentioned about SDLs. I mean, SDLs are typically on balance sheet obligations of the state government, gets backing from Reserve Bank of India, gets qualified as SLR as well as HQLA for bank investments. So they trade at a much thinner spread compared to these borrowings. If we look at these state government borrowings, these are a step lower than SDLs. Typically, the borrowing entity is a PSU or a special purpose vehicle, in, for example, DISCOM or a GENCO or these kind of entities. In a normal scenario, these would be sub-investment grade rating, and the credit enhancement is in the form of guarantee as well as cash flows. These structures bring the credit rating up to single A or AA CE kind of a level. So investors look at these products as a spread product. I mean, my experience of last 20 years in investing in all sort of bonds, starting from the vanilla bonds, bare guarantee bonds, which were issued earlier, to these structure bonds. If you put a proper structure around it, if you document it well, investors are there. We have seen investors coming in the domestic market. We have seen, I mean, recently we have seen a lot of offshore investors also investing in these kind of bonds. The 200, 250 basis point kind of spread is reasonable enough to bring investors' interest in these kind of products, provided these meet certain thresholds like proper guarantee structure, DSRA, cash flow, escrowed in a proper structure.
Thank you, Deepak ji. Really appreciate your views and insight. About the credit quality, I think there is one inbuilt clause nowadays in guarantee document that if guarantee is invoked till it is paid, it ranks as on the state balance sheet, and it is equivalent to that of all the senior debt. So it gives that kind of a flavor. But I take your point about post-issue compliance. I will like to go to Dr. Pant. Sir, what do you think how the post-issue monitoring and compliance, it is already there, how it can be fine-tuned so that we can get rating stability barring unforeseen circumstances?
Well, I'll answer this question keeping in mind the regulation, right? So because it can't be straight away the advisory. What has happened is SEBI has tightened these norms in past few years. So it is the trustee, the days are gone, and please don't mind if any of the trustees are sitting here, that mere a sleeping trustee to an active trustee, right? There were the days when you try to reach a trustee, we used to get the answer, samosa kha raha tha, आगे के दरवाजे से आया, पीछे के दरवाजे से चला गया, और default हो गया. Right now, there is regulations as such that within 2 days of debt repayment, whether it's the principal or the interest, it's the responsibility of both the issuer, that is the borrower, and the trustee to confirm both to the stock exchanges if it is a listed bond and to the rating agency. Because as a rating agency, if we don't get a confirmation either from the issuer or from the trustee, or it is on the stock exchanges that the debt has been paid on time, we had just the 2 days of time from the event taking place and move that rating all the way, even if it is AAA to D.
Thank you, sir.
Now, that is where both the role of the issuer, role of the intermediaries, like the trustee, because trustee is there for the bondholders. It is, instead of, say, 1,000 or 10,000, depending on the size of the issue, bondholders interacting with the issuer, interacting with the SEBI, it is the trustee who is interacting. So the trustee's role is very important, and we had seen in last few years, the trustees have become an active trustee. And they have been, because now we have started seeing when the second day the mail is going to the issuer and coming to us also, please, your payment was due, please give us the payment confirmation. So that makes, and when this market is new, right? SDL market is there, but when you talk about the state public sector enterprises or state public sector undertakings borrowing through the bond routes, that market is still at an nascent stage. And if the existing issuers are showing a credit history, like they are delivering, making payments on time without default and all those, then it will give more comfort to the investors, and it is good for the issuer community in general from the public utility space.
Thank you, sir. It's heartening to hear from you that the trustees are becoming active. But in case of at least bonds which we handle, we do not wash our hands after placement is done. We continue to keep giving service to the issuer and the investors and monitor hand in hand with the trustees so that the compliance is honored and followed. Sir, I would now go to Dr. Mukherjee. Now what we see that there are a lot of developmental activities are taking place in the Mumbai metropolitan region. So we understand that MMRDA is currently implementing one of India's largest urban infrastructure pipeline, and you have more than 100 projects, including multiple metro corridors. Now, how do you structure financing models for a program of this scale and diversity while ensuring long-term viability? So secondly, how do you prioritize your capital allocation for various different kind of projects, keeping in view the socio-economic impacts? And lastly, how do you take care of challenges like delay resulting from land acquisitions or getting environmental clearance and consequential cost escalations? So these are multiple areas to be managed, and how do you manage to implement so many projects simultaneously and in a very efficient manner?
So if you have to manage a lot of projects, or if you have to manage a large organization, the essential thing is that it doesn't remain individual driven, it has to be systems driven. And you have to create systems, and in MMRDA we have very, very clear-cut, well laid down systems. It's a very professional organization. It's a very lean organization. In fact, only 450, 500 people are on our rolls. Everything else is somebody else is doing it for us. Some expert agency is doing for us. And when you choose partners, then the partners should be among the best that you get. So I'm happy to tell you that we are working with the best in the world and the best in the country, and in every sector, whether it is engineering, whether it is planning, whether it is transport connectivity or whether it is fundraising. So we are working with the best. So systems driven is the way to do. Second is the issue of prioritization of projects. How do you prioritize project? So as organizations are concerned, see the government, all these things are governed by an act. And the act gives you the statement of purpose. And that is the essential purpose under which you have to prioritize. So as far as MMRDA is concerned, we are a regional development agency. A regional development agency essentially has to prepare a regional plan. And after it prepares a regional plan, it has to prepare a regional connectivity plan. And it has to ensure balanced development across the region. Now in the MMR region, we have got the country's largest municipal corporation, the BMC. And we have got 9 other small municipal corporations and several other small townships that are there. So we are creating a connectivity plan. And when you create connectivity plan, see the country is a socialist country and we are guided by the fundamental principle of equity. So when you talk about equity, that time you have to ensure that the level playing field has to be made available to everyone. If I am fortunate to be born in some place, and this is very fundamental to government thinking, where I have an advantage, then the person who did not have that advantage should, in the course of his life, get that advantage in an equal way. In urban sphere, we do it by connecting. Because land is an asset which is available to many places. And therefore, the huge urban transformation plan that we are doing. Today, we are constructing 337 kilometers of metro lines. This is the largest single metro line network ever attempted at one given point of time by any given agency, single agency. Across agencies, we have taken larger thing, but by a single agency, it's the largest thing. Why metros? Number one, public transport. Number two, the obvious environmental spin-offs. But number three, it connects. And thereby, I don't need to have a house in South Bombay or in BKC to work in BKC or South Bombay. That is the fundamental connectivity. Look at the connectivity. We have given land worth 10,000 crores for the bullet train station free. Of course, why? Because this will connect Thane 10 minutes, Palghar 20 minutes, the Vapi 30 minutes, Gujarat, I think Ahmedabad 1.5 hours. So this is the type of connectivity and this is the type of equity that we are doing. We have built the Atal Setu. We have put in 17,000 crores into that. Now the Atal Setu has connected the hinterland. See, Mumbai, way back we have been thinking of decongesting and this question. Now Mumbai, we had South Bombay, then we thought we'll have BKC, but it's all within the island of Mumbai, you know, the island city and the suburban city. But by connecting, making the Airoli Bridge and the Vashi Bridge, we connected the northern part of that side. Again, we remain starved of land. Now by the Mumbai Trans-Harbour Link or the Atal Setu, you have opened that whole big corridor. And in that whole big corridor, now we are building what we call as Mumbai 3.0 or Tisri Mumbai, which is going to be a 4th generation city. Again, build on the principles of, you know, inclusion, equity. Of course, all the best altas would be included. But look at the price advantage. Now, we are building a bridge connecting the, so I'll just take the coastal road. Connects South Mumbai to Bandra through the Bandra-Worli Sea Link. Beyond that, we are building the Bandra to Warsaw Sea Link. This will connect it to Warsaw. There will be 3 interchanges. So now today we are seeing that the entire South Mumbai is decongested and people can travel to South Mumbai. They'll be able to travel north. Beyond that, we are taking this link from Warsaw to Dahisar, which is the edge of the city of Mumbai. Beyond that, we are taking this from Dahisar to Bhainder, which is again going into the new upcoming city of Mira Bhainder. From there, we are taking a sea link, which will go all the way up to Virar. So that is a Uttan Virar sea link. Then beyond that, we are connecting this Uttan Virar sea link to the Delhi-Mumbai Expressway. The Delhi-Mumbai Expressway, the Ahmedabad Road and the Baroda Road, they will go further on where NHAI is constructing a road which will connect it to the Vadhavan thing. So this is the Mumbai-Vadhavan connectivity. On the south, very soon we will be connecting Nariman Point to Kaf Parade. So as we connect Nariman Point to Kaf Parade, the congestion that people are facing at that part, because again, when I talk about equity, then the city has to be good for everybody, rich or poor, black or white. So it has to be, so Dariban Point to Kapparet, that is connectivity. Further north, we are building a tunnel from Orange Gate, that is the Eastern Freeway. From the Eastern Freeway, we are connecting that to the Mumbai Coastal Road, so this is one ring. Further north, we are connecting Worli to Shivdi. This will be done by 1 year. So from Worli and Shivdi, which are today totally different places, they will become accessible within a few minutes. This will connect to the MTHL, and then you are straight down to Shivaji Nagar in Navi Mumbai and down to the Palm Beach Road in 4 minutes. So 20 minutes on the MTHL, 4 minutes to the Palm Beach Road. That's the time that it will take. Further north, if we see, the Eastern Freeway ends at Cheda Nagar. From Cheda Nagar, we are connecting to Anand Nagar in Thane. From Anand Nagar, we are going ahead and we are connecting to, Saket. From Saket, the Saket-Amne corridor, the tenders will be out very soon. So that is another connectivity. Amne connects to the Samruddhi Mahamarg. The Vadodara-Mumbai Expressway will connect at Morbe, and from there it will connect to the MTHL. So this is a kind of connectivity which we are doing, and thereby people in the hinterland who were hitherto deprived of their access to the facilities of the city, say use of this mall and this convention center, this convention center will also benefit. But the person there who wants to see a show here, he will also benefit by coming faster. So the concept of equity, public transport, and public good is how we, prioritize our projects. And the third, earlier MMRDA used to do a lot of, works which were not generating return. Now we have put a substantial break to that, and we are doing only bankable projects. So that is one way. And when the banks step in, then I don't need to tell you that they see everything, and they see that we do only those things that they are sure that they will get their money back. So that is another check that we are having. So this way, as infrastructure grows, the multiplier is 1.5, and the Prime Minister has given the signal that there should be infrastructure-led development. Now, economists say that the multiplier is 1.5. Somehow I think that for places which did not have basic infrastructure, I'm not talking about the superstructure, and I'm not talking about the soft things. I'm talking about basic infrastructure, roads, water supply, public transport, sewerage, etc. So when you provide these things, I think the multiple is far, far more than that, because the time and the facility it gives to a person, and therefore he is able to focus on his core competence, rather than worrying कि भाई मैं ये बस पकड़ के वो बस कैसे पकड़ूं. I think this is what is going to make Mumbai and MMR leapfrog in the days to come.
Sir, hearing you, we really feel that we are fortunate to be in Mumbai. The time is running out, but I can't resist the temptation of asking one last question to Mr. Pankaj Kumar. Sir, what do you think are the key challenges that the state discoms face in their path of achieving financial viability, and how you think this can be best addressed, given that we had 3 earlier schemes which could only deliver partially but not fully?
Look, discoms get money only from 2 sources. So one is tariff, and the other is government giving the subsidies or whatever their bills are. So what was envisaged way back at 2000 when the unbundling happened, or the entire country we changed from the government department to a corporation or a company, was that regulatory authorities were set up. It's extremely strongly regulated sector. My tariff is determined by the regulator. Whatever I'm purchasing or whatever I'm spending in the capital expenditure is also regulated by the commission or the ERCs. Expectation was that since politicians are very, very easily manipulated or affected by public sentiments, you will have a body which will be looking after the financial viabilities of discoms. So tariffs would be something called cost reflective. And if the tariffs are cost reflective, most of the discoms will survive pretty well. That is number one. Number two is the subsidies which government has promised should be paid in time. So there is always a question, is power sector is an economic sector or financial sector, or is it a social sector? So the economy was to be taken care of by the ERCs, and the social part was to be taken care of by the government. Now, what has happened over a period of time is that regulators have become their own government-centered socialists. So they want to give, they have a bleeding heart, they are becoming vigilantes. States like UP, we have not increased tariff for last 7 years. Delhi has not increased tariff for 8 years. Bombay had a regulator who issued a tariff that was rescinded and it's been issued again. So the problem with DISCOMs is not the structure, but the regulator gradually, because they need to give us cost-reflective tariff, which was their mandate in the beginning itself. That is number one. Number two, as we are moving into this green energy sector, which is a must, we need to balance the two. Because when you talk about green open access, we talk about C&I consumers, which are commercial or industrial. Moving on open access or green energy, the consumer which was supposed to be cross-subsidized by these big segments gradually will start bearing the brunt of the tariff. Or government will have to take over the tariff burden for that. So in my opinion, the biggest challenge for most of the DISCOMs is to ensure that they get the cost-reflective tariffs. And what the government is gradually trying to do is that by enforcement from the Government of India level, Honorable PM, most of the chief ministers now, subsidies are being paid on time. Departmental dues are being paid on time. The only one thing which still we are grappling with is the cost-reflective tariff. So in my opinion, that is why most of the DISCOMs don't need the capital debt, but they need the working capital debt, and which is extremely expensive. For example, most of the banks will not give you a working capital debt. It ultimately goes back to REC or PFC, and who are very high interest rate. So there are challenges which are being surmounted by different means, like the latest EA Act draft which has come out. It has also envisaged a few things on those lines. In a nutshell, till we do not start getting a cost-reflective tariff, this is going to be a challenge. And your market, bond market, will always have a good chance where DISCOMs will keep coming to you for more, borrowing more and more money. So for you, you should keep managing the regulator the way you are. They should keep us starved and you will have a good market for us.
No, sir, we want the DISCOMs
to
stand on their feet and have the viability. We look forward to that. And thank you, sir, for this enlightening discussion. We really gained a lot of insights on the critical aspects. And I thank all of you once again for being with us. Thank you.
And thank you, Honorable Moderator, for steering the proceedings so ably. May I request Nipa Sheth and Pranav Inamdar to please join us on the dais and present the mementos to the Honorable Moderator and the esteemed panelists. Once again, ladies and gentlemen, esteemed delegates, all of you seated in the audience, please put your hands together as a round of appreciation for all our panelists here this afternoon on stage. Each one of them is a very, very busy man, but they've taken time out and joined us here at IDCMS. We are grateful and thankful. Dr. Sanjay Mukherjee, thank you very much for joining us at IDCMS 2025. Shri Pankaj Kumar, thank you very much. We appreciate you taking out the time and joining us here this afternoon. Dr. Devendra Kumar Pant, thank you. Thank you very, very much. Appreciate your presence here on this panel. And Mr. Deepak Sood, thank you very, very much for joining us here for this panel. I request you all to please come together for a photograph. And once again, thank you from Team IDCMS for all these esteemed panelists here on the dais, along with the Honorable Moderator. An impactful panel, one after the other, coming your way at the summit in its 5th edition. And thank you all. And of course, thanking the Honorable Moderator for steering the session so ably. Ladies and gentlemen, all our moderators since the morning, since we began, are running each and every session on time, and I think that's such a great thing for a conference of this scale. All right, once again, reminding all of you to scan the QR code. Will be shown on the screen there to my left and right, and ladies and gentlemen, also on the tables across the audience seating area. Please do scan this QR code and access the knowledge vault we are sharing with you after each session. And while the team sets the stage for the next session, let me preempt you into the next business session now, coming your way at IDCMS 2025. Esteemed delegates, over the next few years, India is expected to see millions of new investors enter fixed income, not through complicated processes, but through digital journeys that feel as simple as buying equity or making a UPI payment could be. Today, we stand at an inflection point where markets, platforms, payments, and regulation are lining up to make bonds truly retail-friendly. If this momentum is steered well, retail participation won't just add numbers, it could redefine liquidity, transparency, and long-term savings behavior in our country. To explore where this transformation is heading and what it demands from every stakeholder, we have an exceptional panel featuring the key institutions shaping the future of retail fixed income access in India. And to lead us through this conversation, I welcome once again on stage Mr. Pranav Inamdar, Director, Debt Capital Market Broking and Non-Institutional Sales, the Trust Group. Please, sir, join me on stage once again. Aye, please. And as he takes stage, I'm delighted to invite the next set of panelists, esteemed and how. Ms. Richa Goyal Agarwal, Chief General Manager, Securities and Exchange Board of India. Good afternoon. A warm welcome to you. Aye, please. Ladies and gentlemen, let's keep the energy going at the conference and welcome each of our panelists with a round of applause, please. Mr. Sunil Ram Rakhiani, Chief Business Officer, Bombay Stock Exchange. Good afternoon. Very warm welcome to you. Mr. Vijay Krishnamurthy, Managing Director and CEO, India International Exchange. Good afternoon. Very warm welcome to you. And please welcome on stage Mr. Vivek Manchanda, Head Alliances and Partnerships, NPCI Beam. Can we have you on stage, please, sir? Good afternoon and a very warm welcome. And Mr. Mohit Jain, Chief Analytical Officer, Acute Ratings and Research. Can we please have you on stage too, sir? Good afternoon and a very warm welcome to you too. And with that, ladies and gentlemen, I hand it over to the Honorable Moderator to take this next business session forward. Stay engaged. You are at IDCMS 2025.
Good afternoon, everyone. Good afternoon, panelists. First of all, a warm welcome from the Trust Group. It has been a very enlightening morning, and we hope the same to continue in our afternoon session. And we have been assigned a very relevant and a very interesting topic of retailization through technology. So I'm just putting a context setting here that traditionally, it has always been an institutional-driven ecosystem that we were all involved or working in. Slowly now, retail has, as a segment has come up and is becoming an important pillar for us, especially for the market. Given this context, with regulator, with payment rails, with exchanges, etc., we are trying to discover here that what is it in it for the retail and what is the way forward for all of us. So with this, I'll start the session. I'll start with a generic question, which is open for all. Of course, any retail endeavor is very time
and cumbersome. So technology is an important rail for us. So I'll start with that question on the same. Technology has begun to reshape how individual investors discover, evaluate, and access corporate bonds. From your vantage point, what do you see as the most meaningful shift that is making fixed income investing feel more intuitive, and accessible for retail participants? And why is this moment different from all our previous attempts? I'll start with ma'am, if you can give a perspective and we all can share our thoughts.
Good afternoon. Very happy to be here. Thank you for the trust group for inviting me. So I think it's a very pertinent question. So when I think about it, the journey of bond market has been very long and stretched, playing a second fiddle, but now it's started coming in the mainstream. So I think market also has recognized the value of things being put in place, whether it is electronic book platform for private market or RFQ platform, which ultimately OBPP puts in. So I guess awareness is something which is very important, and because of awareness, we see a lot of people accessing it, lot of disclosures, lot of information being in public domain, lot of apps being there, lot of work being done by all, including exchanges, and I would say depositories, and also the brokers and the intermediaries. That has helped it to get where it is. And that's why I would say it is important to start.
Would you like to add, Sunil?
Yeah, surely. Thanks for giving us opportunity to talk about the very, very relevant subject in the today's context in terms of retail participation, and the topic itself is retailization of the corporate bond markets. And I will wear the hat of a couple of things which are done in my past career as a wealth management firm I was running in the past. And way back in 2010, one of the important barriers to entry was the large ticket size of the corporate bonds. And that's something regulator has done a tremendous job in terms of, I will not use the word sachetization, but reducing the size from 1 lakh to 10,000 rupees. That's one of the important product design which has really helped the overall interest in the corporate bond market by the OBPPs. And interestingly, you look at the behavior of how the change is happening on the Indian equity markets, and what is that we have to learn from that is going to bring it to the corporate bond market. One of the important ingredients for that has been the ease of access, which is the technology. That's where the OBPPs are playing an extremely good role once they became regulated entities. The kind of innovation what they are doing in terms of the UI UX what they're bringing in. So when you open that apps of this kind of stuff, display of yields, display of the I can say the ratings, and this earlier the corporate bond, the bond market was always construed as a very complex instrument to invest. So there is a real change in the behavior which these kind of OBPPs are bringing in terms of how to invest with ease, and with the KYC onboarding, dematerialization you're getting, next day you're getting that security into your demat account. So there are multiple things which are happening in the market which we need to learn, and which we already seen the learnings in the capital markets on the equity side. So I will say there's a combination of technology, regulatory market infrastructure, and the product design which is actually increasing the interest and retailization of the bond market in India.
Very well said, sir. What about Vivek ji?
So I also believe what sir has touched about, anything that has to bring in depth today with the kind of population that we have, retailization is the most important factor, right? That is where you will get in the volumes, you will get in, people basically investing their monies, and scale will happen in the bond market only when you have every retail investor having the confidence to invest in a product which was always perceived to be very complex, at the same time, not very transparent. It was very opaque as a product. So that change over the last few years has made a big difference, right? Also the fact that, regulators like, sir and madam, and also, what NPCI has done in terms of making the access to these bonds easier is something which has helped over a period of time.
Vijay sir?
Thank you firstly for having me here.
And this is one event that the debt market now looks forward to. It's become an, an annual calendar event. So thank you for having me here, firstly. It's quite, I'm very happy to having discussed retailization in debt market, because having been part of for more than 2 decades in the debt market and seen the evolution of it, very glad that actually it has really started taking fruit. Thanks to, as Sunil ji mentioned, a combination of policy level changes enabled by the regulators, technology, which has played a very, very key role in ensuring that it's very easy for somebody to buy a bond. The other thing being product design, by ensuring that things are made very simple, and ultimately, what really somebody wants is, I just need to sit in my comfort of my home, select a bond, click it, and the transaction is done. So I think so this entire journey over the last 3 to 5 years has been extremely encouraging for retail participation to come in. And very important aspect which Richaji really touched upon was education. And there has been a lot of effort which is really now being happening through, and thanks to social media, I think so it is being used very responsibly by a lot of the debt brokers around and the debt intermediaries, including the stock exchanges, to make aware of what exactly this product is, right? So that is going to be very important from a retail perspective, and that started happening because we've always been sitting into the meeting rooms internally with rating agencies, with the regulators, with brokers and everybody, and always been talking about, education, education, education. But, the reach was very difficult, right? How do you really create that? How many physical sessions do you have? But right now, the technology has really enabled this to fructify in a very, very simple, easy, and a very effective way. And I think so all of these put together has helped retailization. I really do not have numbers with me in my hand. But I guess last year or a year before that, I have really seen the number of retail investors come in some higher tens of thousands, if not crossed lakh by now. And this is all thanks to the technology and the fintech-driven platforms by the online bond platform providers, who have really helped scale this and reach to the retail participants. So I think so it's come a long way from where we started.
Perfect. What about you, Mohitji?
Yeah, first of all, thanks for having me here. And as a part of a rating agency, to add to all what points we have discussed, definitely support of a regulator, a technology-driven effort, and ease of doing the transactions and awareness. So all these things definitely put together a very conducive environment for this utilization. But one thing I want to add here is the array of the products. Up till now, the fixed market and bond was considered to be a product with very low yields. But now with this different, across different rating categories, we provide different yields. So it's not only about 8 to 9%. There are products which provide a yield of 8 to 14%, and which suffice the appetite of a lot of investors. So I guess this is also one of the valid dimension which is added to the lot of the retail investors. And if we go about the risk perception, because of the institutional investors and their own challenges, their participation on slightly lower rated papers was not there, and it was all part of their own guidelines. Now with this platform, all these constraints are removed, and as a retail investors, you are free. However, understanding the risk, which is very important part of it, you can always invest in these kind of platforms. Yeah.
Thank you so much. So, Sunil ji, and of course, I'm happy if others pitch in. One question to you is that as corporate bonds move toward mainstream retail participation, what is the single biggest shift in technology or a product design or a market infrastructure that is finally making fixed income investing an initiative and dependable for individuals?
So the interesting, I was trying to tell you about so I'll just give you some background to this is, I strongly believe in the behavior of the individuals while they make investment. And the behavior starts from risk-taking to non-risk-taking. And interesting part has been, we need to do a lot of learnings from how the other markets, other asset classes have been actually getting adopted by the financialization of savings, which is coming from the banking deposits to the equity markets right now. An interesting part has been last 4 or 5 years when we see the real J curve. While I say the J curve in the equity happened, post-COVID, the J curve happened on the equity markets because of the ease of opening accounts. So there was a very, very strong technological stack which was built by the regulatory framework using the Aadhaar as a base benchmark, which helped in opening the accounts very fast. And that's where a lot of broking platforms came out with the multiple ease of opening the accounts, ease of doing transactions, confirmations happening fast, and particularly thanks to the UPI system, which was one of the most important backbone. I think globally we are the benchmark there in terms of the fastest transaction which happens through in terms of transferring money from one account to other. So these are something which are the big learning what we saw there in terms of growth of the retail participation on the equity market. Some numbers, Richa madam can actually confirm on those numbers. Pre-COVID numbers were something like 3.9 crore individual accounts based on the PAN based on the Indian markets. And post-COVID, what we saw the latest numbers is 13 crores. So you can see the numbers growing by almost 3 times in the span of 5 years. And this happened because of nothing but a parallel to this, what you call as a OBB. Ka parallel kya tha? Stock brokers providing that kind of ease of opening the accounts, ease of opening the transactions, and that's where the real change happened. That's what we are also going to see in case of the adaptability of the bond markets in the OBB platforms. So why I'm talking to behavior, one thing is equity markets are given the one-way returns till 2024, and what we saw in the last 1 year is a consolidation which happened in the markets. So during this consolidation phase, what everyone learns in that case, let me diversify. Where should I diversify? Some will diversify into the gold, silver, which gave the big kind of returns in the last 1 year. But they also diversify into something fixed income bearing instrument. The new generation which comes in, they don't want the fixed deposits and all. They want something slightly above the fixed deposit returns. And where does you get the above the fixed deposit returns? Are these corporate bonds. Earlier, corporate bonds was not accessible to them because they didn't know they are coming first time to the markets. For them, they know only equities investment either through SIPs. They don't even invest in debt. So one of the classic numbers, what we do analysis in terms of the demographics of the new people who are coming to the markets for the first time. What are the demographics? Between the age of 20 and 30 years. So every month we get something like 2 million new accounts. 20 lakh new accounts get opened in the exchanges right now. Out of this 20 lakh people who are opening the new accounts, I'm talking about the equities to start with, the age bracket is between 20 to 30 years is something like a 25% of the accounts are in the age bracket of 20 and 30 years. Between the age bracket of 30 and 40 years, so you can think about the risk appetite of that guy. 30 to 40 years, 50% of new accounts are getting opened in that age bracket. And above 40 years, around 20% kind of stuff which is there. So the risk appetite of the above 40 years will be different than the risk appetite of 30 and 40 years. And below that will be much more risk appetite. So the people who can be targeted in terms of educating as a diversifier of their portfolio, because debt as a part of as a part of your wealth portfolio is, I will say, the compulsory. Because markets move in cycles, and these new people who are coming in, once they know that the corporate bond is same like equity to me, except it gives me fixed income returns, and particularly in the interest rate falling market scenario, they get the capital appreciation also. So there are a lot of education which is required in terms of penetration which happens, where I see that a lot of these broking platforms have started integrating along with that, and they are actually backing all these OBPs. That gives a lot of confidence in terms of the counterparty risk, which is getting managed partly, and since they get executed on the exchange, they are already regulated entities, this gives much more comfort to the market. So this host of combination learning from the equities, which is we need to really replicate onto the corporate bond market in the long run. That's what we feel.
So Vivekji, I will take your view on this, but I will add one more thing on this, is that, you know, real-time payments and interoperable digital rails are reshaping how investors are transacting these days. Okay, so how far an instant settlement or a frictionless onboarding change the user experience for retail bond investing? And what do national payment platform play a role in enabling the shift? So that is, I mean, it's an ancillary question to you.
So it's, you know, it is always proven that when onboarding is simplified, you would have retail participation which would happen, right? So if you look at it, you have 60 crore customers today using UPI. And these are predominantly tier 1 and tier 2 city people using UPI. These are people who have access to the funds and they have access to digital ways of investing today. They've all gone through the mechanism of making mutual fund investments and seeing how equities work. This is the market which is now shifting towards the debt market. They are focusing more towards having a regular second income or a third income, which ensures that you have a, you know, amount which is coming into your account on a regular basis. Now you have SIPs which have been set up for MFs. You also have SIPs which have been set up for bonds. That is ensuring that, you know, the depth and the scale is available over there. The bigger factor that is shaping this entire, you know, investment pattern today is that you have TPAPs who are working with a lot of these OBBs, with the regulators, to have products which are, you know, like Sir's mentioned, you know, earlier debt was seen to be a unidimensional product. You had only one product type which you could invest in. Now you have, you know, corporate bonds which are structured bonds, wherein investment becomes a little more seamless and people are interested in investing those because you have the scale which is available. Earlier it was perceived that, you know, you would have bonds which would be giving you only 6% returns. Now you have mechanisms and tools which give you about 16%, 18% returns. And that is where the entire, you know, segment, which is the 30 to 40 year age group, which is turning towards and investing.
Very well said, sir. Vijay, sir, along with this, I would want to ask one thing to you, is that how you as a regulator on your regulatory part and authority contribute to building a globally benchmark liquidity architecture that supports seamless retail participation. So in short, what we are trying to understand is how can we increase the retail participation globally through, of course, your channel.
Yeah, so I think so. I'll just give a leaf of what we are doing right now in IFSC, even as India INX. So predominantly, it's a primary driven market right now. Right, so we have, just to throw some numbers, we have more than 65 billion USD bonds, worth bonds listed at IFSC, of which 61 billion or more than 90%, 93% are listed with India INX as an exchange, right? And they are all largely from Indian issuers who come there and list their bonds, and the reason being that they get a benefit of the withholding tax, right? So that is the primary reason why these issuances are happening there right now. Correct. Having said that, very recently we have also seen an international bank come and do a secondary market listing there. So that's a very encouraging step, because when we get into the reason as to why are they coming there, it is saying that, you know, because it is India, an international jurisdiction within India, there's a lot of visibility that they're going to get from the global investors that such an insurer exists, and so it's in the future when they go to raise capital, it's going to be helpful to them. Right? So right now what we're talking about in IFSC is predominantly a market which is primary driven. We have more than 59 unique issuers, 160 issuance that has already taken place at India INX. Coming to the question of, you know, how do you develop a secondary market? Globally, if we see, and I think so I'm very proud in saying that, you know, India, we are far ahead in terms of the secondary markets and the infrastructure that we've given as compared to globally, because even today globally, it is OTC that is predominantly which is there. It is all, you know, over-the-counter transactions which takes place, which is more bilateral. The settlement also happens bilaterally between each of the counterparties. So from that aspect, we, you know, from the domestic market, we have moved significantly ahead. Our payment systems are far better. So for me, the way that I envisage, or our regulator also envisages, because they have also worked in the domestic market here, a lot of them, and, you know, are taking a leave out of this. And for us, the benefit is, we have seen it, we have done it in the domestic market. right? So we know what are the challenges, what could be the pitfalls that could be there, so that we also blend it with a global practice, right? So our endeavor right now is to see how we can leverage on what we have learned in the domestic market and adopt it there. But of course, it has to have a global blend. We can't say that, because for example, on the primary market side, we had the EBPs coming here, which is your, electronic bidding platform coming here in 2016 because the markets were well developed. And then we said, no, everything needs to happen through this platform only. Earlier it was 200 crores worth of bonds, and it came to 100, now it is 50. And now most of these things happen there, so there's a lot more transparency. But today, if I was to implement it there right away at the initial stages, it won't work. People will say, okay, thank you very much, I don't want so much transparency, because globally there is no transparency. Even in the equity secondary market trading, everything works on an omnibus basis, right? So only the custody's name who's known that he or she is buying a bond. Behind who's the investor, nobody knows, right? But in India, and even when I'm saying in India and as an international jurisdiction, people, as a country, we would like to know who the end investor is for various reasons, right? FIU has our own set of things. So how do we blend these two things, right? How are we going to get the best practices from the domestic side, as well as then say that, okay, these are the global practices, how we get to blend both of these and come out with that is going to be something that we are working towards. Other important thing is the product and the product design. So earlier it was only, typical the plain vanilla bonds or the foreign currency bonds. But very recently we've had one of the foreign currency convertible bonds having listed there, right? So that's the first one, and the regulator also, issued a circular and enabled such bonds to get listed there. We are looking for a lot more innovative structures to come there, get listed there. And as I said, right now, very recently, we had an international bank from Sri Lanka come and, do their secondary market listing in IFSC. There has been a lot of interest among the SAARC countries in and around, India, our bordering countries, who are very keen on seeing that how they can come there, how this platform can be used to raise capital, how can get the visibility into the global markets. So right now, because there's a lot of buzz around this, and of course the Europeans and the Americas are a little far-fetched because they have their own developed markets. So the key is going to be to cater to these markets, get these guys come and list their bonds there, make IFSC a truly international jurisdiction where we have both a blend of Indian issuers as well as global issuers coming there and listing their bonds and raising capital, because this was one of the vision of the Honorable Prime Minister when he inaugurated our exchange, saying that IFSC needs to be a price setter for one of the most liquid or any one of the most liquid assets in the country. So be it equity, commodity, debt. So I think so we are slowly trying to move in that direction, and there has to be an ease of global issuers to come to IFSC to raise capital. So with the first step happening with a Sri Lankan bank coming, I think so slowly we are, trying to realize that dream of us. It is of course a long way to go, but the baby steps are being taken, and I'm sure we'll start running now. With the baby steps now turning out to be long strides, I think so we'll soon start running.
That's a very, very good and fantastic perspective that we have got. Well, we have covered the regulator, we have covered the exchanges, we have payment gateway, market rails. Now I feel it's the turn of rating agencies. So from our discussion, we realized that, all these retail, or rather from our experience also, that retail has grown from more from FD, which is getting converted into a bond. So we feel that being converted from a FD to a bond, suddenly the rating trajectory and the rating environment will be one of the most significant things that will be a guidance or a benchmark for a retail investors to come in. So in that scenario, Mohitji, what is your view on the role of a rating agency, and how can rating communication evolve through digital indicators, platform integration, or clear risk gradation to help retail investors interpret credit risk with confidence?
Sure, very important thing. While we talk about the opportunities, the growth, the risk always remains, and as a rating agency, we are there to highlight that. Okay, so let me give some perspective on the numbers on the bond market very quickly. Current size of bond market is roughly 53 trillion. And the bond issuances for FY25 is roughly 10 trillion. And if we talk about this quarter, it's roughly around 3.4 trillion against 2.6 trillion. So why am I saying this? While we talk about the investors, there has to be the issuers who come through for these bonds so that investors can participate. And within this 3.6 trillion, around 53 to 60% remains from the NBFC space. And they remain one of the major source of, say, channel which are raising these bonds. And what is happening maybe for a couple of years or 2-3 years, what I say is a structural shift of or rebalancing of the balance sheet. Up till now, their debt requirement was mostly met by the banking channels. Surprisingly, collectively, the percent for upper layer NBFCs and for the middle layer NBFCs, their debt from the bank has come from 43 to 42%, while their balance sheets are increasing. So they have also understood the importance of diversification of their financial resources. And within this diversification, the bond market or NCD remains one of the most important thing. And that is where they are coming with these issues and getting them listed and on various platforms. Now it is very important for the investors to understand these companies, okay, and particularly in the space of NBFCs. And there, the role of rating agencies, or what we suggest, that while these platforms are there, the dissemination of the information, highlighting the risk categories or the risk band has to be very proper. Putting the definitions and the relative benchmarking of this particular rating in the entire rating has to be compulsorily put, that once the investor knows that where they are putting their money. Second part is ratings are not static. Ratings are dynamic. And and as a rating agency, we also have our responsibility towards the investors. So any movement or any action in the rating has to be captured, okay, with virtual zero time lag. I will say on real time basis, and the implication of these to the investors. And while they invest on these, see, other reason maybe for the investors to invest, this is the assured cash flow. The cash flow in terms of the principal and the interest. And so a proper cash flow, okay, maybe in a small form, but should be part of certain kind of document, okay, or the pitch when these papers are put on the platform. So to summarize, the dissemination of the information, the changes in any of the rating action has to be captured on a real-time basis, and the understanding of the rating scale has to be properly reflected.
Thank you. Richa ma'am, I'll ask you one question. That's with momentum building, what aspects of regulatory roadmap will matter most for scaling retail participation responsibly?
I'll divide it into two. So for scaling retail participation, while we see a lot of activity in primary market side, and secondary market also of late, from last 2 years, if I see the data, thanks to all the access people have given OBPP and everything, so we see a large number of participation. But I would also reflect on something different other than what has already been covered, is the derivative product. So when we see the success of the repo corporation, and it has tremendously succeeded in terms of where we were and where we are, I also feel the products, derivative products, say index derivative products, will also get more participants in the market. So I think we are actively engaging with Reserve Bank, and you should see some product on corporate bond index derivative kind of product which will come out hopefully soon. And there is a dialogue on that. So I guess that will also move the market towards how equity market is grown a lot in the index derivative space. So I think that is one factor. Other responsibility, I think like we put it and other people also put it, Vijay put it and Mr. Sunil also put it, we have a number of disclosures. The rating agencies are doing robust jobs. The debenture trustees are doing a good job. So, and the market infrastructure, including brokers, etc., are doing a phenomenal job. So, responsibility, it has come in terms of disclosures, in terms of transparency, in terms of getting investors where they are. So we are moving in the right direction for responsibility. Probably we need to see a little more product so we get a lot more interest given the generation and the interest and the number of demat account which you rightly put as 13 crores. We need to see a number of investors come in and expanding the boutique of the products in debt market. I think that will help scale up the entire debt market infrastructure and ecosystem.
I would just like to add what Richa ma'am said just now. So interesting about the product because we have been very passionate about creating new things. While she just touched upon the index derivative product on the corporate bond or index of the sometimes G-SEX which can be created and traded. That's what I was trying to look at what has happened in the other markets, where you look at the negative interest rates and still people were putting money in the debts. So there's a classic story about the real need of the product. So the markets are becoming more and more mature. While I talked about my wealth management background in the past, we always used to look at about what are the new products which clients want. And the interesting part has been, you see how the maturity of the Indian investors is now getting into shape. Earlier, AIFs were launched only as a leverage product on the CAT 3 side for certain segment of the market because leverage was being understood only by them. That has now been brought into the SIF category without leverage. So these are new innovation which regulator has been always trying to come out, seeing the maturity of the investors in Indian markets. And with the corporate bonds now catching up onto through the retail side, through the OBP platforms, and where you see the demographics of the Indian investors right now, they want slightly higher return products. And without derivatives coming onto that. And interesting part, we talked about OBP platforms. I was just scrapping through because I'm always keen to know about what is happening onto which side of the industry. Curated portfolios of the bonds. And you try to draw a parallel between them and the equity markets. I don't want to name the platforms which come out with a lot of curated marketplace platforms. Innovation is happening in terms of beyond the money management which is happening through the AIFs, AIFs, mutual funds or PMSs. Now, independent guy wants to take a decision on his own. So you want something which is he wants to understand the risk part of that, which we are the very transparent. Earlier in early days when we used to invest, we always look at where is the rating. We used to find out different places, Bond Central, which is an amazing thing. You get everything over there in one platform. So you are seeing the real shift in terms of analytics which is being provided for each of the instrument. There are companies which are coming out and focusing on very single niche segment. And that's what is a new emerged market of India is going to become more and more mature. And as ma'am rightly touched about the new product like index derivatives onto the corporate bonds or onto the including G-SEX in that case, curated portfolios, that is going to make the market more and more mature. People are going to shift from one segment to other segment at much more ease based on the risk appetite what they carry. That's what I wanted to add there.
Would you like to add something here?
So it's, trust brings scale, right? And it is not only trust in the product, it is also trust in the ecosystem. How the brokers behave, how the regulator behaves, how we facilitate the payment. That is very important. I don't know, most of the people would have read in the newspapers last week, there was an attack which happened on the AWS servers and you had Google also down. The only payment server which did not go out in the world was a UPI payment system. We were resilient, which is a system which is inbuilt, which is in-house, right? And it remained alive, it remained active without, there were about 1,500 attempts made to basically breach the walls of UPI and it did not happen, right? So that is what the trust factor brings into the system. Now, with regards to the bonds, the most important factor that will remain is obviously going to be the ease with which people can invest, how they can scale, and at the same time be able to redeem those investments that they've made. That remains most important. I think the facility of having SIPs enabled through e-mandates, which are now available on the TPAPs, is something which is going to always accelerate that facility. But yeah, that needs to be obviously augmented as we go along.
Thank you so much. Unfortunately, we are running short on time, and this discussion, I feel we would need another hour because it's a very relevant and a very ongoing topic. But one thing is for sure, we can clearly summarize that retail as a segment is definitely here to stay. For issuers, it is one more, including government of India, it's one of the sources of financing. For investors, it's one of the categories or one of the options that they are getting. And of course, with proper exchange guidance, proper regulatory guidance environment, and of course, technological environment, market rails, and payment environment, and of course, rating environment, which is guiding everyone and making them more educative. I feel retail has more than that, I feel it is today's our topic or our tagline today, which is we are about to explode, is what retail is at the cusp point of that. And we are all looking forward to have more further discussions on this. Thank you.
Thank you.
And thank you. As I said when we began the session, our moderators, each and every one of them, are on time with every session. I'm going to request Neha Masalia and Anil Ranka from the Tusk Group to join us on stage and felicitate the Honorable Moderator and the esteemed panelists of this business session, please. Thank you. Thank you for joining us. And we'd like to begin by honoring Mr. Pranav Inamdar, Director, Debt Capital Market Broking and Non-Institutional Sales, the Trust Group. Thank you for moderating this session. Keeping an audience engaged in a pre-lunch session is not an easy task, but as usual, you did well. Thank you very much. Ms. Richa Goyal Agarwal, thank you for your presence here this afternoon. Ladies and gentlemen, chaliye na, hamare panelists ke liye to you have to put your hands together. Mr. Sunil Ram Rakhiani, thank you for being here with us. Mr. Vijay Krishnamurthy, thank you for joining us here at the IDCMS. Mr. Vivek Manchanda, thank you very much for joining us for this panel. And Mr. Mohit Jain, thank you very, very much. All of you, please come together for a photograph. And thank you. And while that picture there is being clicked, ladies and gentlemen, 2:15 p.m. is the time when we want all of you back, please, in your seats. Post-lunch, we have a wonderful buffet served for you in the lunch area outside of this hall. Please enjoy your lunch and trust that you'll be back in your seats at 2:15 p.m. sharp for the next business session. afternoon, esteemed delegates. It's so good to see at least some of you back in your seats on time. We are awaiting a few more of our esteemed delegates to join us here. Meanwhile, I'll take you through a few highlights that we have this year at IDCMS 2025. And I hope you all are refreshed for the sessions ahead. IDCMS this year has rolled out some super initiatives, the Experts Forum being one. The Experts Forum is a series of 8 panel discussions throughout the day. It commenced with debt markets covering key drivers, transitioning to sector landscapes, touching upon quasi-equity, and ultimately will culminate in an insightful exploration of the equity markets. Industry stalwarts participating in various panels are adding depth and richness to the discussions and enhancing the understanding of the sector for the audience. The other initiative I'd like to highlight for all of you present here in this hall is the Issuer-Investor Interface. Now, this is something we're really excited about, the Issuer-Investor Interface. This platform provides a unique opportunity for investors to engage directly with issuers, offering insights into the business and credit profiles of participating companies. Running parallel to the panel discussions, the Issuer-Investor Interface is taking place in designated meeting rooms where pre-scheduled meetings will allow issuers and investors to interact one-on-one. The interface will feature issuers from select company as outlined in the compendium, along with investors from institutions such as banks, mutual funds, corporates, FIIs, pension and provident funds, insurance companies, family offices, and more. Ladies and gentlemen, we would have liked to wait for more of our audience, many more of our esteemed delegates to join us, but I think we're going to choose to be on time, so we're going to begin. Navigating towards the next business session at hand. The composition of balance sheet management within the BFSI sector is undergoing a marked transformation. Securitization is entering a decisive phase in India's balance sheet architecture, evolving from a tactical liquidity lever into a structural pillar of capital efficiency across the BFSI ecosystem. Lenders are increasingly using granular retail vehicle and mortgage pools to recycle capital while transferring risk to a more diversified investor base, spanning mutual funds, insurers, AIFs, and banks. Now, as the financial system matures and liquidity cycles turn more dynamic, securitization is emerging as the cornerstone of how risk, capital, and liquidity are managed, shaping the next phase of India's balance sheet transformation. Let's start this next conversation at IDCMS 2025. To lead us through this conversation, I welcome on stage Mr. Vinod Kothari, Director, Vinod Kothari Consultants. Good afternoon, sir. Join us on stage, please. Ladies and gentlemen, though the energy from the grains hasn't started breaking down within the body, but lunch always makes everyone happy, so let's put our hands together for our moderator, please, there. Thank you for joining us. The esteemed speakers of this session are Mr. Parag Sharma, Managing Director and CFO, Shri Ram Finance. Good afternoon. Namaste, sir. Aye, please. Dr. Harshavardhan, Senior Advisor, Bain & Co. A very good afternoon to you. Warm welcome on behalf of Team Trust. Mr. Amit Tripathi, President and CIO, Fixed Income Investments, Nippon India Mutual Fund. Good afternoon and a very warm welcome to you. Mr. Jairam Sridharan, Managing Director and CEO, Piramal Finance Limited. Namaste, good afternoon, sir, and a very warm welcome to you. Mr. Dio Shankar Tripathi, Executive Vice Chairman, Aadhar Housing Finance Limited. Namaste, sir, and a very warm welcome to you. And Mr. Krishnan Sitaraman, Chief Ratings Officer, CRISIL Ratings Limited. Good afternoon, and a very warm welcome to you too. I'm so happy to see more of our esteemed delegates in the hall. Please settle down, take your seats and place on silent your mobile phones. We straight deep dive into this first business session after lunch. You are at IDCMS 2025.
Hi, good afternoon all of you. If you all had a good lunch, then I'm hoping the temperature settings in the room are too uncomfortable for you to doze off. This is a session dedicated to securitization, and I have, starting from my extreme right, Dev Tripathi sir, who is a potential issuer, Amit Tripathi ji, a big time investor, Parag ji, who is also one largest issuer in the country, Dr. Harshvardhan, who is an advisor, consultant, and then I have Jairam ji, who is also an issuer, and Krishnan Sitaraman, a rating agency. So basically we have three issuers, one investor, one advisor, and one rating agency. If I were to therefore say we have तीन दूल्हे, एक दुल्हन, एक advisor और एक काजी. If I am able to make them fight, then my job is done. I straight get started with a very quick intro on what is securitization for you all to capture the context, and then we will be shooting questions to each of the panelists here. This is an instrument which is looking similar to bonds, but is not a bond. It has a fixed rate of interest, kind of rate of interest, call it pass-through rate or coupon rates, mostly referred to as pass-through certificates in India. The instrument is responsible for funding at least about 40% of houses in US. In India, the proportion of mortgage lending securitization is much, much lesser, but world over it's responsible for a very large part of housing finance. Roughly about 1/3 of cars in the US are funded by securitization. Roughly about 1/5 of credit card debt is funded by securitization. The volumes in India have also grown up tremendously over the past few years. Last year, we clocked roughly about 2,45,000 crores of volume, which is still less than a percentage point of GDP. But when you look at the bond size, roughly about 15% of the bond market, depending on the way you define a corporate bond. So it's significant. It's coming, assuming larger significance over time. And as the session title says, it's a tool of balance sheet transformation. I'm not meaning balance sheet in accounting sense, balance sheet meaning basically the way the country funds its assets. And from that perspective, securitization surpasses financial entities, because currently we would have seen even a remarkable entry of non-financial institutions also using securitization to fund assets. So that's the context broadly. In India, the composition of assets which are securitized includes car loans largely, includes microfinance loans, includes LAP loans, personal loans. Now this year, some extent of gold loans as well. I think an increasing remarkable proportion of gold loans too. Home loan securitization is still quite low in the country, but we will like to talk about why not. And in terms of numbers, like I said, the numbers are growing at a decent pace till 2025. 25-26 is a question that I'll probably be asking the panelists here. So that's the larger story of securitization. From point of view of investors, as of now, it seems to be giving higher returns than comparable corporate bonds of same rating. And investors, particularly mutual funds, I'm sure are very eagerly on the lookout for a good issuer's asset-backed securities. We would have heard the chief economic advisor in the morning saying that the question mark in our country is not the size of the debt market, the question is concentricity. And I think the same question we are largely facing in securitization as well. To best of my understanding, like the top 10 issuers would constitute roughly about 80% of the securitization volumes in the country, which is a huge extent of concentricity. So let me straight get first started by asking investor Amit Tripathi ji. And the question that I have is that most of the people in the room are so comfortable, so conversant with bonds. A straight, simple instrument, the prefix coupon rate, a prefix maturity. Unlike that, in case of pass-through certificates or securitization, we have uneven cash flows. We have something called a pass-through rate. We have a prepayment cash flow also going to the investor. We have an information load to understand and analyze every month. Despite all this, why would an investor be still willing to invest in securitization? Amitji.
So first of all, to start on a lighter note, हाल ये है कि दुल्हन दूल्हों के पीछे दौड़ रही है. At least that's the case as of today. So very frankly, I think the industry is very keen to increase this piece as far as their overall allocations are concerned. But I guess there are a lot of dynamics that are playing out in the ecosystem, which actually kind of it does not stop it, but it kind of lessens the amount that is available generally to the industry from the appetite perspective. The appetite is actually much larger, so to say. To go back, I don't think this is a new product. This is an old product which has taken a lot of, seen a lot of cycles, taken a lot of new avatars over the years. And in a nutshell, I think from a mutual fund standpoint, especially from an open-ended fund standpoint, I think the best thing going as far as securitization is concerned is self-liquidation. In a market which is notorious for poor liquidity in the secondary market, especially during iffy market environments, in each of the episodes where we have actually seen the markets go illiquid from a bond liquidity standpoint, securitization has actually come to the rescue of a lot of investors in terms of its self-liquidating structure. Very frankly, the architecture on our liability side allows us to deal with some of the complexities that you mentioned, whether it is prepayments, whether it is the structure of the instrument, which very frankly, while on face of it looks slightly structured or more difficult, but I think everyone who has done it once or twice or three times is pretty much used to it, and it's not rocket science in that sense. It's a very fairly simple thing to understand. The challenge to my mind, if you want to actually permeate this across the ecosystem in line with how you do with bonds, is to actually make this information availability much more democratic than what it is right now. Simple things like performance of the pool itself, simple things like cash flow updation happening in time at the exchange level. These are simple things that need to be solved for to make a good secondary market also evolve for this product. But as far as we are concerned, honestly, we are not looking at the secondary market to create liquidity in this product. To our mind, this is one of the best counter-cyclical exposure that we can have in the financial services space, because this is the only self-liquidating structure that we have.
Excellent point. And you picked up an extremely important point to which I'm coming back to separately later, which is number one, data availability and data efficiency, understandability of the data. Number two, you also mentioned about the relevance of secondary market, because currently the market seems to be almost completely hold to maturity. And both these points are very important. I'll come back to that. Parag sir, over to you. You are obviously the largest issuer in the country even if we were to take banks as issuers. And once again, the question from issuers' perspective also is that you could have gone for bonds because your own ratings will still come under AAA rating. You could have therefore kept it quite simple, less opacity, less complexity, less of legal opinions to seek, and therefore you could have gone straight for a bond issuance. Thereafter, year on year, you prefer to choose securitization as well as a part of your overall funding strategy. So what are the motivators which motivate you to do an issuance?
Yeah, thank you. Congrats to Trust for this 5th edition, and Mr. Kothari has spoken about everyone. He is, I think, specialist on securitization. Whatever industry knows about securitization is only because of him.
Thank you. Thank you very much.
I think when it comes to different originators doing securitization, it largely started with banks for priority sector needs rather than anything else. The entrants, the market entrants by like funds, insurance companies have been much, much later. And prime driver was fulfilling a need and getting the right pricing. Unfortunate will be if it is linked to the bond market. It will be very unfortunate because though we may call it a covered bond, we may call it by a different name. But this instrument is very, very different. It is bankruptcy remoteness. It is de-alienated from the originator. You have servicer, they can be any originator. If you, as an investor, are able to see through the end borrower and his performance, That will be the credibility of this instrument rather than linking it to a bond, which is a corporate liability, corporate call. Here you are taking a call on the underlying retail investor with sufficient cushion. It should not be linked to a bond at all. Then only this instrument can get more prominence, I feel. I think enough data is available. This instrument has been in place for very long. Enough peer data, enough of issuers data is available. And thanks to digitization, see-through of payments of all the originators, this instrument should be looked very, very differently, wherein you have full cover, full security.
बैंक आप उसमें ऐड कर दोगे, बहुत ही बड़ा हो गया मार्केट। 2 लाख करोड़ क्या होता है? कुछ भी नहीं। तो रियलिटी ये है कि ये बिजनेस आज भी हम लोगों के लिए इट फॉल्स इन द कैटेगरी ऑफ इंटरेस्टिंग बट नॉट इंपॉर्टेंट। मतलब हो गया तो अच्छी बात है, नहीं हुआ नहीं हुआ। तो I know it might be an unpopular opinion in this group where a lot of people might have stake in this game, but the fact of the matter is कि यार ये important नहीं है लोगों के लिए। जब तक ये मार्केट मच डीपर नहीं जाएगा, स्ट्रक्चरल रिफॉर्म्स नहीं होंगे यहाँ पे जिससे कि this can become a core and dependable source. Till that time, we issuers will keep using it occasionally when we feel some need, but really अगर कल को ये मार्केट खत्म हो जाएगी तो मुझे तो 2-3 महीने पता भी नहीं चलेगा कि मार्केट खत्म हो गई। So reality ये है, so if we really care about creating a vibrant environment for securitization, we need to first acknowledge the fact that this market is today too small and almost irrelevant. We need to make structural and deep reforms for it to get to a point where for issuers it becomes a first line thing and a part of core balanced diet rather than just medicine.
Good point. You talked about structural reforms that might be needed to make this from a remedial to a regular diet. And let me come straight to Dr. Harshvardhan, who headed a committee which is responsible for a whole lot of reforms in securitization over the last, I think, 3 years or so. So Dr. Harsh, looking at from your perspective, you've seen the markets globally, you've seen the markets in India, you did a fantastic work in terms of leading a group of RBI. What are the structural reforms which you think are still needed? A lot of reforms have been done post your report, but what are the reforms that you are still thinking are still lacking, which need to be done? He talked about some structural reforms. Yeah.
So the holy grail of securitization would be when mortgages start coming. Total mortgage outstanding is 41.5 trillion, 41.5 lakh crore as of September. My sense is about 25 lakhs of that is in banking system. Now look at the problem of the banking system. You have average deposit maturity of 1 to 2 years. Your average mortgage maturity is 15 to 20 years. You run humongous ALM mismatch. So it makes sense for banks, even more than NBFCs, to start securitizing. I think the issue to my mind is primarily on the investor side. the more reliable investor pools, namely insurance and pension, which should actually love these securities, which are long-term securities, seem to not have either understood it or have developed appetite for it. So one area is to develop, and that requires really classical business development. You know, issuers and arrangers have to go to these pools of capital and say, look, this is an attractive security, given your own liability structure. So that's number one. As our committee report came out, there were recommendations for example, tax authority on issues like stamp duties and so on, which honestly I am not particularly hopeful, because it is a state government subject. State governments, for them, securitization is priority number 187 on their list, so it will not come down. But I don't think that's an impediment. If you ask me, the biggest impediment right now, and as Mr. Sharma mentioned, that the vehicle pools have proved to us that there is appetite for this product from the investor pools. We need to get to the bigger price, which is mortgages, as is everywhere else in the world. And there my issue is really on the investor appetite, investor understanding. And I don't think so far serious efforts have been made. But my own view is that given the structural deposit problem in banking system, this is going to happen in the next 2-3 years. So we will see dramatic growth. The other interesting issue is, and Mr. Sharma can comment on that, which is that in NBFCs, you have gotten the investor base, the equity investors, accustomed to a certain AUM growth. The whole underpinning of securitization is that you originate to distribute. Now under Ind AS, you can show that as AUM, but it's not true AUM, because you have taken out your growth, packaged it and sold it to somebody else. So there is a little bit of investor education on how NBFCs grow, so they can grow profits without growing AUM, is also an issue I think which will show up soon. Most NBFCs today want to show 20% plus growth. If you start securitizing half of that 20%, your AUM growth will look weaker. So I think all of these are institutional issues. They are not really, I think the regulations are in place now. And they are very robust, they are quite modern, the guidelines that RBI issued, and they are across asset classes, right up to single asset securitization. Remember now it can be a replacement for loan syndication. So the regulatory framework is in place. I think we need business development now.
You talked about investor appetite, which is a very important point. We have an investor who says, I have a lot of appetite already. But let me just straight first move to Krishnan sir. The volumes till 2025 were showing a decent upward growth. If you look at the data for first half of 2026, if it's showing marginal decline on year-on-year basis, and if you were to exclude the outlier transaction, which is Reliance Industries ka transaction, 21,000 crores or so, then I think we are down by roughly about 18%. Are you expecting the year therefore to end with a negative number for the entire year? Because if this is so, then probably it would be first year after 2019, or probably after the COVID. If you exclude COVID, then probably in the past we haven't seen negative growth. So number one, what's your expectation for 26?
Vinodji, thank you for the question. Good afternoon, everyone, and thanks very much to the trust team to invite me. Just coming to your question, I think there is a saying that statistics sometimes hides more than what it reveals. I think I would apply that to these numbers which Mr. Vinodji just talked about. See, if you look at last year, securitizations did benefit from banks coming into the industry. We had 1/4 of the issuances last year being contributed by banks. Many of them had credit deposit issues, especially one large bank was trying to work out means by which they can address it. So 1/4 of the volumes came from them. Now, this fiscal, the first 6 months, the numbers that Vinodji pointed out, banks have not been there. 3% of the volumes have come from banks. That's true from small finance banks. So if I look at NBFCs or HFCs, who are the fundamental players or the main players in the securitization space, as per our assessment, their volumes have gone up by 15%, H1 of this year versus H1 of last year. There were some corporate players in this H1, so that also I think those are maybe one-off players, they may not be there. If you look at NBFCs and HFCs, there has been an uptick in their issuances. And when I say securitization, I also include direct assignments in this framework. Now, looking ahead, next 6 months or so, We believe that because of the recent policy measures, the GST cut, interest rates are low, inflation is benign, we had decent monsoons that helps rural demand, tax cuts at the beginning of the year. So all this we believe will translate into better consumption demand in the second half of the year. That will translate into better retail credit. And overall, we believe NBFC AUMs for this fiscal will grow at around 18 to 19% vis-a-vis last year. And that would mean some part of it needs to be financed by securitization. So we do believe that there will be a decent traction in securitization, maybe some growth vis-a-vis last year. I'm not talking about exponential growth, but as compared to last year, our numbers are around 2.35 lakh crores for the full year. We do expect the numbers to be a little bit better than that, especially from the NBFC HFC point of view, because the way I look at it, they do get a number of benefits, especially the smaller and mid-sized entities, whether it's capital management, an alternative funding source, profit management tool, asset liability maturity management tool. So a number of benefits are there, and we have seen mid-sized and smaller NBFCs look at it as a key alternative funding tool. So I do hope, I do believe there will be some traction in the second half.
Thank you for that, optimism. You talked about the numbers for the year still, let's say, if not, largely exceeding, at least meeting up to the last year's benchmark. You are, I'm sure, still including gold loans as well, because they are,
yes,
and there the numbers could be driven by prices of gold rather than transaction volumes. But I think overall you're still...
Yes, it's a combination of the two. When we see gold loan AUMs today, while you're right, the price appreciation has contributed a significant portion to the increase. But the number of additional numbers, quantity in terms of customer accretion, that has also gone up by around 10%. So it's a combination of both.
Right, that's extremely important. I think both the commentators earlier talked about residential mortgage-backed transaction, and Dr. Harshvardhan also mentioned that world over, it's residential mortgages which constitute a significant part of securitization volumes. In India, Tripathi Saab, moving over to you, mortgage lenders have not looked at securitization to any large extent. SDFC was doing, but now it's anyway not needed because folded up into a bank itself. So for residential home loan transactions, what are the inhibiting factors which are inhibiting an issuer, such as, let's say, your company from securitizing? You're still on the direct assignment mode and never looked at PTCs. Can you explain what could be the regions?
See, that milestone was achieved when RDCL was established about a few months back, but they have done only one transaction, and thereafter they have not been able to move many transactions. There are many impediments in that. Home loan market, the entire home loan market is having hardly 10% of securitization last year, and I think same is going to happen in the last 6 months. So home loan market, the banks are always having hunger to increase their loan book, and banks are not preferring to go for securitization, excepting foreign banks. Foreign bank does prefer securitization, but most of the banks, they always say, through direct assignment, you deliver the papers to us, and we will take in the books for us. For the housing finance company also, it works very well because upfront profit booking is allowed. This is very important factor. When Ind AS was implemented in 17-18, at that point of time, it was made mandatory that unrealized gain has to be booked in advance, and thereafter unwinding has to take place. So now, even if we stop doing the DA, unwinding loss will be there in our books, and that will disturb the profitability management. The unfortunate problem is that many times we thought that we should reduce the DA or we should find the securitization alternative, because in securitization, we can get about 0.25 or 0.5% lower interest rate. It is beneficial for us. But unfortunately, in DA, the capital is released, risk is transferred, all these benefits are there, and upfront profit booking, that is now creating a problem. At any point of time, if we decide to stop, we will have to see that YOY, there will be a dent in the profit. Even if we do not want to increase the gain from this, at least loss which we will have unwinding, that has to be covered. That's one point. I think RDCL will play a very important role, why I'm telling you, because there are about 50, 60 small companies, they hardly do disbursement of 25, 50 crore rupees. For them, either selling the pool or doing securitization, nobody is there, no buyer is there to take this small pool. So RDCL has a plan to warehouse these small pools with them, restructure them, and then sell through the PTC route to the buyers. So I think that is going to be a great support. That was the whole thought of the Reserve Bank of India. I think the Baines committee of Harshvardhan, a committee that also recommended the same way. So this is going to help liquidity management to have the small HFCs so that they can survive. They do not have capital, they do not have too much of borrowing from because the rating is very low, triple BRA. So that is going to help them very much. Another point is that even if we go for PTC route, the mutual funds are not interested to buy those PTC because of longer tenure. The tenure is 15 years, 20 years. Door it is 8, 9 years only. So RDCL has a plan to restructure in the same fashion so that mutual fund, if they have appetite for 5 years, they will sell to them. Thereafter, they will take this and they will sell to some other buyer. So there are plans with RDCL are there. And once the RDCL becomes the fully manned, another infrastructure is to be created. Being government company, it takes some long time. And I think something the Reserve Bank of India should also tweak that. If NCD is listed, no TDS is deducted. If the PT is listed, TDS is deducted. So I think secondary market for PTC has to be developed, and some policy alignment is required to be done. That is what my thought about the securitization is concerned.
Good point, sir. You're making quite a few important observations. Number one, you're saying that given the long tenure, it may not be exactly suitable for a mutual fund. And therefore, the right investors would probably be the likes of insurance companies and pension funds. But they would be more than inclined to come only when there is a backing of someone like RDCL. And you refer to RDCL as a very important player in the entire system. You mentioned that that is, as of now, a slow mover because only one transaction was done. There are 2 points that come from here. I'll pick up 1 point for Amitji and 1 point for Mr. Krishnan Sitaraman. The point in, the feedback that we get is that most investors currently ask for a plain vanilla structure where you have a cash collateral. RDCL structure, the cash collateral is 0 because they want the cash collateral to be built up over a period of time rather than putting upfront. And the feedback we get is that investors are not comfortable with cash collateral being 0 from the beginning and built up over time. Point 1. The second point is that even the level of credit enhancements, and that's the point that going to Mr. Krishnan Sitaraman, the level of credit enhancement as of now being insisted upon by rating agencies is significantly higher than the past loss history. So how do we resolve this point? Investors being comfortable with no cash collateral to begin with, but being built over time, though with a backing of someone like RDCL, which is largely sovereign backed. If investors were to accept those asset classes, I think then there is nothing that stops, residential mortgage housing lenders also to come for securitization. Amitji.
You see, I just take a minute.
Yeah, good.
RDCL is open to provide guarantee for that in lieu of cash collateral. It is not that the enhancement is a problem. RDCL is prepared to provide 5-7% guarantee because cash collateral will be a drain on the originator.
Absolutely.
So I think the guarantee will serve the same purpose what the cash collateral is going to.
I completely see cash collateral is a huge demotivator for anyone to issue. And therefore, if I'm able to make it cashless to begin with, no cash collateral, the cash could build up over time from the excess spread. And that's replaced by a guarantee of someone like RDCF. Investors were comfortable with that. Nothing stopped the second transaction also to come from the market. So Amitji, as an investor, you are accustomed to something with a cash collateral, but would you be prepared to accept something which is a guarantee rather than a cash collateral?
There is another issue. I'll talk about that.
So, if I remember correctly, there have been similar structures way back in the past. Having said that, I think as investors, we would not have a problem if a quasi-sovereign entity were to come in lieu of cash collateral. But that does not take away the basic question that you asked, which is that, is cash collateral relevant for investors and rating agencies? I think from that side also you will see here, yes. Although the quantum has come down over the years, you need to have some buffer in terms of at least 1 to 2 months of payments. which would be preferred in the form of cash collateral by all investors in case anything happens which would make the servicing of the pool difficult. Even
Kind
for
of a DESRA.
Even for a limited period of time. So cash collateral is relevant, but can that be replaced by a quasi-sovereign guarantee? The answer is yes. So I don't think there is any problem with that.
Dr. Harsh, you wanted to add?
Yeah, so I think rating agencies have to be more sophisticated. I'll tell you what the issue with cash collateral is. If you have an underlying vehicle pool, which is a 3-5 year maturity pool, your collateral stays for, let's say, 2-3 years. In mortgage pool, you can't put cash collateral for 8 years. So that becomes, and look, that is not the only way of enhancing, right? You can do tranching, you can do excess interest spread, and you can do guarantees. I think the rating mechanism needs to be more sophisticated to understand these differences across asset classes. And the other point I have to make, look, we have two ways of deploying credit in our country or any country. There is an institutional credit through banks and NBFC, and there is market through bonds. Securitization is the one which is a cord that connects the two. If you make it stronger, both would improve. So from a macro policy sense, that's how you need to see this. And that's why in our committee report, we said RDCL will not only do enhancement, but also do market making, to Tripathi-ji's point, which takes away the secondary market liquidity issue. So I think there are many ways of making this more attractive.
Now, you're making a very important point because cash collateral is a hard form of collateral, and if I provide 5% today, as the pool amortizes, 5 becomes 10. After some time, it becomes 20. So it continues to go up. So,
Vinodji, this is clearly a topic that is passionate. Everybody is passionate about. So you know, as issuers, I'll tell you, we are deeply distressed by the whole cash collateral situation. I have no interest. Half my interest dies the moment somebody comes and tells me that you've got to give so much cash collateral. Because I'm keeping that money aside. I'm doing some negative carry. I'm just sitting around something. Plus, that money is getting deducted from my capital calculations. So it is, from a balance sheet perspective, it's super suboptimal for us. So when you load that suboptimality, and capital costs are very kind of, if you add a certain cost of capital onto this, it becomes very clear that the numbers just don't stack up. So whenever the team comes to me and makes a proposal for PDC, I inevitably end up asking them, add kiya kya? Cash collateral का cost add किया क्या? Capital deduction जो होने वाला है उसको cost लगाई कोई कि नहीं लगाई? वो सब hand wave करना पड़ता है, नहीं तो ये math कभी नहीं बैठेगी किसी की. So as issuers, we hate what is happening right now. And it is going to be a severe stumbling block in this ever scaling in our minds as a big important thing. I do not want to keep setting aside money which is being deducted from my capital adequacy ratios, you know, when I have many other ways in which I can go raise the same money.
You know, I think the capital adequacy impact would still be there, be it cash collateral or credit collateral for that matter. The impact is still the same. That's probably a guarantee also. If the originator takes any exposure in transaction, the capital implication is still the same. But that's probably not the point that you're making. The point over to Mr. Krishnan is, I mean, no one has any doubt about level of sophistication of rating. The methodologies are completely par international standards. And I know rating agencies are not advisors, they are simply rating. But the level of enhancement and the extent of cash collateral as of now is still much higher than in global transactions. So is that something that we can do about it?
No, thank you for the question. I think it's a good point that you raised. Now, the way we look at these ratings is the credit enhancement is linked to the target rating which is required for. And in most of these cases, if not all of these cases, the requirement is of a AAA rating. So the AAA rating is not an average of the past. So if I look at an average of the past, that will be a BBB rating. If you need a AAA rating, there has to be some stress tests which are run, and the numbers have to satisfy that. And my AAA default rate is 0 or very close to 0. So even in this any transaction, it has to look at a 0% default rate. Now, if I go back in the past, there have been 1 or 2 mortgage-backed transactions which have failed, and there were certain reasons for that. And if I look at globally, if you go back to 2008 and the financial crisis which happened, most of these were mortgage-backed, may not be most of them retail, but some of them definitely were retail. And the extent of credit enhancement was very, very thin there, and those defaulted. So the point that we are trying to make here is that the amount of enhancement will be linked to the rating, and the more the data which is available, the more stress tests we can run, we can definitely relook at those enhancement levels. And in certain cases, Shriram Finance would be a typical example where in the past the enhancements would have been higher. And as we have more cycles and more data coming into the picture, the numbers did come down. So that is there, and it's a function of amount of data and amount of stress tests and the target rating that we can achieve.
Excellent, fair point. Coming to Parag sir, you have experience of issuing to overseas investors as well. So I have two questions to ask. The number one, the familiarity and the comfort of international investors to invest in India, whether by way of a direct overseas issuance or through the FPI route or through IFSC route. That part one. Part two, because you did international transactions, is the level of credit support required by global investors is anyway different from that required in Indian investors? Parag, over to you.
Yeah, I think one, the India focus for most of the investors is very much there. We have been regular issuers for bonds, ECB route, and also loans. Now close to 20% of our liability rest on the offshore debt. We did try this ABS transaction in the offshore market, took a lot of effort, a lot of time. I will say the investor interest was very positive. The challenges are twofold. One, it gets benchmarked to the regular bond issuance what we do, and the sovereign rating. The sovereign rating being at BBB plus level, most of the ABS transactions are done at A plus rating. That is one of the challenges of doing this transaction. It will not be one-off transaction what we have done.
Okay.
Like other instruments, we will continue to pursue this instrument. We did find a lot of interest. It has challenges. I'm not saying it is easy because it has to run for a particular maturity, and most of the assets what we have is short-term in nature.
But you had a replenishing structure too.
That's what we did. So that is how to make it slightly longer. And we also ensure to the investor a fixed, timely principal payout.
Which means repayment is absorbed.
Repayment is absorbed. So that was something which was built in, that has structure has run through a lot of tests and interest from the investors. We'll pursue this. As of now, because of benchmarking it to the bond market, it is working out, the landed cost is working out to be slightly costlier. We have not done even ECB bonds for last 1.5 years. Loans are much cheaper, and that is what we are pursuing. But yes, we will, as and when the markets are slightly better, we will definitely be there in the market because we have to set the benchmark in place.
What about FPIs and IFSC route into local transactions?
So that they keep doing. The bilateral transactions are always there. But to see a wider ABS investors is what we will be looking at. We are in touch with many of them, but let us see how it shapes up.
Amit, you made a very significant point about secondary market. As of now, most of the transactions, I think almost all transactions in the country are mostly hold to maturity. There's, other than distress situation where people are forced to sell, there are hardly any secondary market transactions. There's a view that if secondary markets existed and investors could exit by booking a profit on a transaction, the yield expectations of investors would be actually lower, and that would improve the pricing of transactions also. Do you therefore see anything which is holding back the secondary markets from happening today? There is no market maker. I don't think we need market makers. For bonds, we don't have a market maker. So what is it that's stopping secondary markets from developing?
So I think so 2-3 things. So first of all, I just touched upon the fact that data is there, but data is not democratized right now. You need to democratize it. I don't think if I as a layman investor just looked at the ISIN number of a PTC, I would get all the data of that PTC in the details that are required for me to take a decision, because the regular reports that are available, the cash flow updation that needs to happen at a real-time basis for all investors at large, rather than only for investors who are holding the pool. Data is available, but for those guys who hold the pool, not for those guys who don't hold the pool, especially real-time data. Secondary market, you have seen episodic events of secondary market liquidity. I think the the need for secondary market liquidity, to be very honest, post-COVID has not arisen. Okay. First of all, the issuances themselves have been so far and so few in between that, like I said, we are actually looking to do more securitization and we don't get assets. It's the other way around. And second is it is a self-liquidating structure unlike a bond. So by the time you realize in a 3-year pool, in the first 1 year, more than 50% of the principal is any which ways back to you. So that's the reason. But I guess standardization and information democratization is key. You need to get information real time, both cash flow updation as well as pool performance available to each investor uniformly, not only to the guys who is holding the bond.
No, you're
if
making
solve for that, that would be very, I don't think it's a difficult instrument to trade. That's not difficult.
It's not difficult, correct.
Par pools are not difficult to trade at all.
Absolutely. No, I think you made a very important point that currently the need for downselling has not arisen. But I think there is also a viewpoint that secondary markets are not necessarily need-based. It's a question of opportunity. If I can reap a profit by secondary...
So I can tell you for sure that each pool that I do, if I have done any pool in the last 5 years, if I were to sell it down 3 months or 6 months down the line, I would have invariably sold it at a profit.
So it's mark-to-market profit that you could have got.
No, I could have generated mark-to-market profit both because A, the pool performance of 6 months is available to me, which is very important from an investor standpoint. B, there is a dearth of genuine good quality spread assets in the market. C, securitization portfolios itself are not available in the market. So that's the main reason why secondary, I don't think secondary market would be non-existent because of lack of buyers. I don't think that's going to happen. In the worst of times, again, going back to the COVID period, some of the easiest assets that were there to sell were securitization pools.
Correct.
We have done that ourselves, so I know that it is much easier to sell them in bad markets than it is to sell on balance sheet exposure. Just one point, although unrelated, I think on the MBS point that you asked earlier, one of the things that also you need to solve for is the fixed versus floating thing, because these are very, very long tenor instruments. You really don't have investor sets today which are actually willing to take longer tenor floating rate exposures, which is the most critical thing to solve.
Right. Swaps probably could work. Okay.
Somebody is going to take the risk.
On the interest rate is to someone like inverse floater kind of a transaction, but that's I think quite complicated. It works in the US market. Everything that works elsewhere can work here as well, but little complicated because US markets it's a prepayment risk. I mean prepayment risk is connected with interest rates. In India, because most mortgages are actually floating rate, so it's not prepayment linked interest rate. But that's a very interesting point still. Looking at the time that we still have, I just have a couple of minutes to go, so I'll just spark one question for Mr. Krishnan Sitharaman, which is, I think everyone here has talked about data availability, data transparency, and a data repository. Europe has done something important. They have set up what you call European data warehouse. Every transaction which is listed, the performance data month on month goes into an EDW, which is a centralized place where all the pool information of all listed transactions are stored. Obviously, we don't have anything similar in India, but do you think availability of information in a centralized data repository would help secondary market transactions? Mr. Krishnan?
No, undoubtedly. I think democratization of data will be very important. Many of the investors, bankers we talk to are having questions around the performance of these transactions, because the most, I would say, reliable port of call for them is our monthly servicer report, the monthly servicer report. And some of them don't look at that as well. They wait for the rating agency's actions or our reaffirmations. So we have a publication report which we put out every 6 months on all the transactions that we rate. So that is one such data point. But if the real-time data is available or usage of cash collateral in a much frequent manner is available, that can help assuage some of the concerns that investors or other stakeholders may have. Because at the end of the day, if I look at default statistics, the default statistics on my securitization ratings are actually better than my normal ratings for a like-to-like rating category. So, but somehow that comfort is not there across the stakeholders. And if you still look at the same rated paper, securitization will go at a 25-30 bips premium over the corresponding same rated plain vanilla bond. So that some novelty risks, some innovation kind of concern is built into that. So if there is more information available, more real-time information available, that should help in assuaging some of these concerns.
Thank you very much. I've got a message saying time's up, so I'll just taking 30 seconds for each speaker, 30 seconds only to all of you. Is there any ask that you have from the regulator? Any demand, just one single demand from a regulator? Any regulatory change that you're expecting? You mentioned about TDS, anything else?
GST, no, I mentioned about the TDS.
GST, there's, what's the issue? You're saying servicing fees to be exposed to GST?
Regarding?
My question was, are you having any demand from a regulator? And regulatory ask, ऐसा होगा तो ठीक हो जाएगा. ऐसा कर दें तो ठीक होगा.
You see, I think there has to be, the market has to be developed first. One thing will not happen. There has to be complete regulatory environment to be changed. We need to ensure that secondary market is developed properly. If secondary market is not developed, then probably the retail investor will not come and large section of investors will not come. Suppose if we want to go for securitization, we would like that our paper should be subscribed by a large number of investors.
Right.
Secondly, another thing that profit is one of the important things. I do not have any right to exempt that for any moment of time being a listed company. So there are certain problems which we are confronting, so these have to be taken care of. Another thing, I think time is not there. In co-lending, new guidelines which have come, unfortunately, these guidelines require 5% FLDG. And that will not allow profit booking. That's what I'm telling.
Got a point. Amit ji, any ask from the regulator at all? You happy or any ask?
No, I think data availability, this has by the way already been recommended by some of the groups formed. So that is hopefully going to be see the light of the day within the next few months. Having said that, I think the only small issue would be that the recent guidelines have actually brought back or restricted single loan securitizations to happen. There is a 25% cap now that has been put for issuer concentration. I think that is something that could have been.
Okay. Parag sir, any quick regulatory ask?
I think on the offshore transactions only, there is clarity regarding withholding tax on bonds. There is no clarity on the ABS transactions.
194 LC kind of clarity. Dr.
Harsh? Nothing on regulation. I think they have CRELIC database, which gives database on corporate loans. It can be very easily extended to include on a monthly basis pool performances, which will democratize information.
Jairam.
I think creation of a mortgage guarantee type framework, a Fannie Freddie equivalent where you can create kind of approved assets or stamped assets which can then be easily traded. I think it can be a game changer to create an MBS market.
Thank you. Krishna.
I was going to say the same thing that Jairam said, but now I'll move to a different one. I think permitting covered bond transactions to take place, I think that will be very important. For a period of 2 to 3 years, number of entities use that, but then RBI's transfer of standard loans transactions came in, and that stopped it. I think that is important.
Extremely important. Thank you very much, all of you. It's been wonderful. Over to you, ma'am.
Thank you, sir. May I request Anand Jami and Homi Tarapur from the Trust Group to please join us on stage and felicitate the Honorable Moderator and the panelists of this business session. Good afternoon, welcome. And with a round of applause, let's say thank you to the moderator, Mr. Vinod Kothari, Director Vinod Kothari Consultants, for steering this session on point and also staying on time like every moderator today has. Once they get the photograph done, we'd like to say thank you to our moderator and the panelists with tokens of our appreciation. Mr. Parag Sharma, thank you very much for your participation and presence in this panel. Dr. Harshvardhan, thank you very much for your presence. Mr. Amit Tripathi. Delighted with your presence, sir. Mr. Jairam Sridharan, thank you very much for your presence on this panel. Mr. Dio Shankar Tripathi, thank you for your presence, for your time this afternoon. And Mr. Krishnan Sitaraman, thank you very, very much for joining this panel. And that, ladies and gentlemen, was the last business panel that you witnessed, moving straight on into the next one coming your way: infrastructure, inevitable catalyst of India. But first, we'll give them a moment to click that photograph. So we have a memory, and so do they. Thank you, gentlemen. Esteemed delegates, another initiative at IDCMS 2025 that I'd like to highlight is the Knowledge Vault, which many of you have seen since the morning. The Knowledge Vault on the Indian debt market. This vault encompasses market trends, bond market outlook and sector reports powered by CRISIL, focusing on the BFSI and securitization sector, infrastructure, InvITs and state finances. In addition, we are unveiling a compilation of issuer profiles. Once again, I'll say that. We are unveiling a compilation of issuer profiles, highlighting companies from various sectors across India. Now, this compilation includes a peer comparison snapshot of these companies. Lots happening here at IDCMS 2025 in the 5th edition. And now, let's head into the next session, infrastructure. Friends is a key pillar of India's growth story. The sector is propelling India's overall development and enjoys intense focus from the government of India and all state governments for initiating policies to reach the Viksit Bharat 2047 goal. Over the last decade, this sector has seen world-class asset development, whether roads, airports, ports, power, renewable energy, data centers, logistics, warehousing, and allied sectors, enabling the country to support connectivity and achieve India's GDP targets. But to finance these various infrastructure projects, investors are reassessing risks through the lens of sustainability, cash flow stability, and long-term sectoral visibility. New instruments are expanding the infrastructure financing toolkit. Development finance institutions, global impact investors, and corporate issuers together are shaping this multi-layered ecosystem. As India stands at an inflection point, this panel examines how these channels can align to fund the infrastructure momentum essential to realizing that dream of Viksit Bharat 2047. And to lead us through this conversation, may I please welcome on stage Mr. Sachin Gupta, Chief Rating Officer and ED, Care Edge Ratings. Please, sir. Ladies and gentlemen, please put your hands together and welcome each and every one of our moderators on stage. Good evening, Sachin, and a very warm welcome. The esteemed panelists of this session, Mr. Raj Kumar Ralhan, Chief Credit Officer, India Infrastructure Finance Company. Good evening and a very warm welcome to you. Mr. Virender Pankaj, Chief Executive Officer, Asim Infrastructure Finance. Good evening, namaste, and a very warm welcome. Mr. Vineet Mittal, Founder and Chairman, Avada Group. Good evening and a very warm welcome to you too. Ladies and gentlemen, that's it. I'm stopping right here if you don't clap for each and every one of our panelists. And yeah, thank you. Ms. Malavika Pillai, Principal Investment Officer, International Finance Corporation. Good evening and a very warm welcome to you.
Mr. Sharad Agarwal, Chief Executive Officer, SIFI Infinite Spaces Limited. Good evening. Warm welcome to you too. Mr. Nishant Kumar, Managing Director, Asia Investments, Garant Co. Very warm welcome, good evening to you too. And Mr. Dilip Jha, Chief Financial Officer, Adani Power Limited. And that there, ladies and gentlemen, is a power-packed panel, yet another at IDCMS 2025. The moderator will now take the proceedings over.
Thank you so much. Great, so after securitization, I think we come down absolutely to brick and mortar business, which is the infrastructure. Let me first commend the trust group on gathering together a very illustrious panel today. We have a good mix. We have people from renewable energy, thermal power, data centers, also from financing entities, who are looking at more innovative instruments, both domestically and internationally. In the context setting, the compare did talk about how infrastructure is doing. Is there an echo, or can you guys hear me clearly? It's okay? Thank you. Yeah, so infrastructure very clearly, and I've been an infrastructure analyst for nearly 25 years now, and very clearly what we see today is possibly the best ever that infrastructure sector has seen. There was a time when no bank would really touch infrastructure assets because of the high defaults that have happened. But now very clearly we are seeing kind of a perfect storm. The risks in infra across the segments are significantly lower. I think thermal was one sector which was the last one to kind of come out of it, and now with many of you would have been seeing the merchant rate tariffs, so even the thermal is doing very well, and so are the other sectors, renewable, roads, pretty much very, very strong performance. So overall, if we see in the current geopolitical uncertainty that we have supply chain disruptions, we have tariff wars going through, and then we see infrastructure. I think one sector which is more or less, while there will be challenges to some extent from supply chain, but it's one of the sectors which is quite immune to these risks, which otherwise are hampering the overall corporate India or even the corporates across the world. So in that sense, infrastructure, where the country has invested over the last many years, at least the last 8 to 10 years, it's kind of paying us good dividends. And also from a growth perspective, there are opportunities, while say a road sector within infra may be kind of maturing as a sector, or say the more traditional renewable energy may be maturing, but then there are innovation in new segments coming through, whether it is data centers, smart metering, or even within renewable energy, more reliance on batteries, etc., which is keeping us all very active. So, very clearly, to summarize my opening points, it is low risk, it is high growth, it has shown consistency, and overall, I think the heading of this particular session of the inevitable catalyst of growth, I think it is quite fair. Let me start my first question with Mr. Vineet Mittal, who's of the Avada Group. And this is in terms of, and you've been really one of the pallbearers of the renewable energy sector in the whole country. My question is in terms of the new RTC structure, where we're talking about, instead of just selling 200 megawatt, 400 megawatt solar energy power, must-run status, kind of a safe business. And now it is coming to, most of the concessions now that the DISCOMs want is of the nature of give me power around the clock or, some hours. So the risk of battery, the risk of energy storage pretty much comes on your account. So how well prepared do you think the Indian renewable energy sector is to really graduate from the more traditional, simple, straight projects of wind and solar, and now kind of combining with battery and, giving full solution to the DISCOMs?
Thank you, Sachin, for the great question. If you look at the way Indian sector is evolving, every state had their unique requirements. Some states have power purchase agreement in thermal, where the variable cost is much higher than even the cost of solar power. So they are coming out with a pure vanilla solar bids. There are smart buyers who are looking at peaking power requirements. So they are coming out with solar and wind, because wind patterns in most of the states are matching peaking hours also. And then there are utilities which are saying, you give me round the clock green power, which can replace and substitute any form of power. And so they are going for more complex, where they are saying, I need this month this much of power, and this day this much of power. And fortunately, now the technology is advancing a lot, and with a lot of reliability of data, what is happening is that using AI, your ability to predict how much you would generate using which channel, and when to send the power to grid, and when to store, has become far, far superior. And you can now compete and give RTC power at the rate of 5 rupees or 5 rupees 50 paisa. And when you look at the NPV of that, even at 8%, you are talking about 3 rupees. So the reason utilities are asking more RTC, because with the capex cost of thermal going so high, and chances of compliance carbon market coming up, they want to go more greener, because electron is a electron, and they want to source the electron at the most cheapest cost. Plus batteries are, or pumped hydro is solving for another problem. Most of the states have a peaking hour from 6 p.m. to 11 p.m., where they are buying power at 10 to 12 rupees also. So to replace that power in a faster, expedited way, solar and battery is the best solution, because it's competitive, it can come fast within 2 years, and they are able to manage the grid better. So we are seeing a growing tender where all sorts of tenders are coming, like recently 2 states came with the pumped storage, where they are looking at entire 8-hour solution to supply them power, because their peak hour has changed from 6 p.m. to 1 a.m.
Okay.
And they want it till 3, because their thermal power is super expensive.
Okay, thank you. Let me get in the other, the power professional here on the panel, Mr. Jha from Adani Power, who looks after the thermal power. But the question that I have for you is, in terms of nuclear power, that is something which is again being spoken of as one of the new areas of, which India could be looking at in our overall energy mix. So where do you think, or what role do you think nuclear power, especially with the technology issues and the past issues with, accidents, etc., how important and relevant do you think nuclear power will be in the India's energy mix?
Thank you, Sachin. This is a really very important question. But before, giving any comment, let's understand how nuclear fission has evolved over the period of last 1 decade, or 1 century. So initially, nuclear fission was, mainly for military application. But then, after World War II, in 1950s, then shifted for civil utilization. The first plant in 1950. Then, 70, 80, 90s, then massive expansion. What is total capacity? 380 gigawatt across the globe. But 70% is still by 5 countries. US, France, China, Russia, and South Korea. Where is India? Out of 380 gigawatt developed over the period of last 1 century, India is 8 gigawatt. So 2%. What US has developed over last 1 century, 100 gigawatt. We as a country are projecting that from 8 gigawatt, we will be in a position to 100 gigawatt by 2047. So now 100 gigawatt addition in 25 years or 20 years, which US has added in 1 century. So really, we will have to increase our speed 10 times more than US. So there is complete reformation required. So 2 main acts, so one Atomic Energy Act 1962 and one, Civil Liability for Nuclear Damage Act 2010. And I am confident that there will be huge reform. There will be, the ordinance, and it will be moved from the non-core area to core area. And it is going to be one of the very, very, the basic, the base load for the country.
Okay, that's very optimistic. I mean, yeah, obviously this sector has its own challenges, but you're right. Globally also we are seeing, small modular nuclear reactor, etc., is kind of finding favor. So yes, let me bring in Mr. Pankaj, who's from Asim Infra, is specializing on infrastructure financing. In my opening remarks, I said, it seems to be like a perfect storm. Everything is going well. If you see defaults in infra are very low. Most of the sectors are doing well with high growth. Since you sit at the top of an infra company, infra financing company, where do you see the risks are there? Because are we missing some risks in the sector which, we should be cautious of, especially what, we saw 15 years back in the sector?
No, I think one thing we must acknowledge that a lot has changed in India, and it has changed in favor of infrastructure sector simply because country has no choice. If we have to become a developed country, the GDP multiple of infra is about 2.5. Some people say even more. So the only route is via infrastructure. Initially, yes, we had problems because all of us, lenders, developers, regulators, even judiciary, government, everybody made mistakes. But I think as a country, we have learned our lessons very well. So what you see over last decade or a little more than that is not a chance. It's not that there is a lucky, timing which has happened, because during this period, we have had COVID, we have had all sorts of possible supply chain challenges. I mean, there's no geopolitical, disturbances of the order which even my generation has not seen in the last 30 years. But with all that, it has not just withstood, it's standing very well. So I would give probably half the credit to government for recognizing and also, removing the challenges which keep coming. See, challenges come, they're still coming, they'll keep on coming. We have to keep responding. And balance 50% credit is to the rest of all of us, lenders, investors, developers, who have learned their lessons and who have now, figured out that if we have to do well, this is how we do. The beauty is that most of the assets are very long term. So you have assets with 25 to 50 airports or even 60-year lifespan. So, eminently suited for long-term investors. So, and once it is operational, market risk is very, very low. So I think I would say that next 10 years are going to be even better than what we have seen. But yes, I mean, the fundamentals, as long as we don't lose sight of, the mistakes we made collectively, and we assume that nothing will be challenging in assumption. No, that's not true. So sometimes, my brothers also in the lending community go a bit overboard. So do on the client side. But directionally, secularly, I see further doubling of the pace compared to where we are.
Got it. Great. Thanks, Virender.
Sachin, if permitted, I would like to add to what he said, because I belong to the same fraternity, and by way of experience, I have seen the entire life cycle of India's infrastructure and project financing and NPA, etc. I think what has changed in last decade is what he said, it is not by chance, it's a strong will on the part of government to provide resolutions very quickly, put in place the forward-looking policies, taking recognition of the fundamental issues in the infrastructure growth and providing resolutions in the policy measures. The dispute resolution mechanism is strengthened quite a lot, and it is happening very quickly. That's one part. And obviously, infrastructure development is majorly PPP, where one of the major constituents and stakeholder is government, either central or state. Everywhere, I mean, there is an awareness that infrastructure growth has to happen because it is the growth engine of the entire economy, 2.5x or 3x, everybody's guess. So that is one part. The other is we have got very strong sponsors. After this NPS cycle, what has changed is those who are left in the fray, they have got strong resources. Even if there is a stress in a particular project, they are strong enough resources-wise to get a resolution around it. And most of them, and global capital has also played a very vital role. You look at all the renewable energy platforms today. They are either directly controlled by private equity funds or the Indian sponsors. Because of their governance standards and their execution capabilities, they are supported by such funds. So there is global capital, and within the country also, there is capital chasing good assets. And on the lighter side, I think Indian sponsors have tasted the blood of wealth creation. They'll not let anything go wrong if everything else works well.
I think Mr. Mittal is sitting next to you. I think he's getting inspired by that. Let me get an international focus on this, Malvika. IFC has been a traditional supporter and investor in many of these, either at the sponsor level or at the project level. But then, as we see, the traditional infra, the traditional finance is kind of, we have to move on to the new things. So from an IFC perspective, how are you looking at, mobilizing new ways, new avenues of capital for the infrastructure sector?
Thank you, Sachin. So we've been long on India probably since the 1950s, with traditional project finance and equity. But the last 2 or 3 years have really seen a sea change in our portfolio. We've grown 4 times, and we have a $1 billion portfolio just in listed bonds, which is something that we never contemplated 5 years ago. So now we're the only IFI with an FPI license, and we're using it quite actively. As you said, we've moved on for project finance. Obviously, there is still a huge need for project finance and a need for projects, but I'll come to that. But I think what encourages us right now is that the clients we're working with have a long-term operator mindset. It's not just about taking project finance, completing the project, and moving on to the next project. So we've seen platforms like REITs and InvITs. We've seen the private equity mindset as well, that your job is not done once you've commissioned or once you've cut the ribbon on your new road. Where we see, and we're happy to be part of that through equity, through mezzanine investments, and through listed bonds. The other encouraging thing for us is we're seeing a lot of opportunities in newer sectors. So renewables was always the bread and butter sector, I think, for a lot of us, renewables and roads. But there are great opportunities right now in smart metering, in data centers, in warehousing. And as a DFI, we really appreciate these opportunities because they are generating jobs. And I think that's what all our stakeholders, the governments of India and the government of India, see these as the backbone that will generate jobs for us. There's still a lot to be done in terms of the number of projects and the number of players that come to the market, though.
Got it. Great, thanks. I think you mentioned about data centers, and on that cue, let me get Mr. Sharad Agarwal from SIFI. Right now there is a lot of talk in the global media about AI bubble, right? And data centers is kind of strongly connected to the whole AI boom. Now, Indian market in data centers is obviously seeing a lot of growth, as we have seen in the last many years. The capacities are increasing, investments are happening. Where do you see Indian data centers market going forward in terms of size? And also, is there any truth to this whole AI bubble thing? And do you think India is any which ways exposed in that sense?
Yeah, so India has to first play the catch-up game on the data center infrastructure side, and then ride the growth. Take it as a measurement
that for a per million population, India has 1 megawatt of data center. In comparison to the US, where for every million population, there is a 23 megawatt of the data centers. India produces more than 20% of world's data, but it hosts only 3% of the data center capacity.
Did you say India produces 20% of the world data?
Yes. India,
20?
Yes. India produces 20% of world's data, but hosts only 3% of the data centers. So that is the gap catch-up. Catch-up game to make sure that we are hosting what we are producing. We are processing what we are producing. We are transacting in the country, not somewhere else. So that is the catch-up game first. And then the second part is the growth. At the time of COVID, India had the total data center capacity of 0.4 gigawatt. It has grown to 1.4 gigawatt as of today. So to the average, it does look like it has become 4 times, but it's still not enough. If it had to go to the level of the US, it should have been in the tens of gigawatts. But let's not go to those exuberance that we have to go and grow to that level. Even if we continue to ride the organic demand, or if we continue to address the secular demands coming from the different sectors, it is expected that the Indian data center capacity should grow to close to 4.7 to 5.7 gigawatt by 2030. And then there are accelerators around artificial intelligence. If that comes, and if that happens in a proper manner, then that capacity could be anywhere close to 7, 8, or 10 gigawatt.
So which is basically we're saying 5 times to 6 times in the next 5 years.
Exactly, exactly. With the accelerators. Now, even if you can discount the bubble question of AI, even with the organic growth of cloud adoption, digital transformation, all the content consumption that is happening across the country, even then it's a minimum of 4 times of growth. And with the AI, it is much more. Now, whether the AI is a bubble, obviously that question keeps coming. See, the bubble comes when there is an oversupply. If there is a contained, logical supply that is coming from the data center world, then it's not a bubble.
Got it. So
AI
India
is
is
really that transformative. We are really in that car-to-car kind of a transformative way with the AI technologies coming in. So there is AI is not a bubble.
Just
the exuberance.
A quick follow-up question. Is there any, from a regulation perspective, there's a lot of things that if I generate the data, because I got intrigued by that 20% number, the assumptions that you're saying growing 4 to 5 times, does it assume that the data has to necessarily be stored within India, or is there any requirement for any regulation to change on that bit?
So that 20% data is a lot of that social media content, correct, which does not necessarily need to be in India. Sure. But the user-specific data that is in the transaction and then the any other pieces, that has to be in India. But irrespective of Data Protection Act or any kind of a regulatory support comes from, it is important for us to host the data in India.
Correct.
And then there are certain accelerators or certain positives in India that makes India suitable for not just hosting its own content and transaction, but the others' content and transaction also. Because I believe we are good on energy side. We are doing a lot of good work on the energy that puts us in a strong position on the energy infrastructure-wise. Government is supportive. Regulatory supports are there. There are no blockers to the data center growth. So there is a real scenario where we will not just host India's data, but the regional data also. Right?
Great. Thank you, Sharath. Let me get in Nishant. He is the MD of a guarantee company. It's a unique thing. We don't have too many guarantee companies per se in India. So very interesting thing. What's happening in the infrastructure space in India is the whole concept of partial credit enhancement, as we call it, that is kind of catching the flavor of the day. How do you see, what role can PCE play? Because we had something similar to partial credit guarantee many years back. It didn't really fly off the handle. So where do you see the opportunity now that the sector has, kind of matured in a lot of ways? What do you think is the opportunity for India fundraising within the infrastructure space through the PCE instrument?
Sure. Thanks. Good. In fact, a great question. Look, why do you think the moot question is, why do you think partial credit guarantee or guarantees are even important, right? There is something called actual risk, and there is something called perceived risk. And guarantees, to me, cater more towards perceived risk. Because, you would, let's say one of the top tier companies developing renewable energy power plant, and tier 2 or 3 companies developing similar power plants, right? The perceived risk with regards to tier 2 or tier 3 amongst the financiers would be much more than a tier 1 company, right? Which is where, we have seen globally, guarantees play a very big role in terms of managing or addressing that perceived risk. And then creating innovative financing solutions to ensure that those sort of companies or those sort of opportunities get that financing package, which otherwise is not really available. Right? So, and I'll give you an example of Malaysia, for example, right? There is an entity called Dana Jamin there, which is the national guarantee company. And Malaysia's project bond market is arguably the most advanced in Asia. Outside of China or Korea and all those, Japan, right? And that's possible because what Malaysia has been doing for decades is, you have banks financing construction, 1 or 2 year COD, flipping it into the bond market, Dana Jamin coming in and guaranteeing, and then you have pension funds and all those coming in and picking up the paper, or even the Hajj fund, picking up the paper, which is, has really transformed. You see the infrastructure there has really transformed there. Even you have countries like Vietnam and Indonesia, that has really worked wonders. In India, it may not have taken off, and in fact, Raj Kiran sir, his company was the first one to do the PCE, right? In my most humble opinion, I would say that when you have an institution which does lending and guarantees also as a business, then there's always a perverse incentive to lend than to guarantee.
Well said.
Yeah?
But it means we haven't learned from it, because this time also the focus is on the same entity who's doing lending and guaranteeing.
I think you must have heard of something called this time it's different, right? So I hope and I believe this time it's different, because the mechanism, and without going into details, the mechanism through which it is being done, because there is also an intention to do or house it under a separate vehicle, right, or an entity, rather than the same credit manager looking into guarantee and loan. And guarantees require a different sort of mindset.
Got it.
Right? So that's how I see it.
Great. Thanks, Nishant. Let me come to Mr. Mittal. We talked about, I said about the geopolitical risk which is there. Now solar is, I think, one industry where I think India is as a government of India is taking a strategic shift to make it completely self-reliant. We started with modules, then with cells, and then we're going into wafers and polysilicon and all that. And obviously there is China, which is extremely, of a scale, even with our scale is maybe 5 times, 10 times of our scale. How do you think this strategy is playing out from a developer perspective? While I know you're also setting up a backward integration into, wafers and cells, etc., of the solar modules. But because this is, to my mind, a test case of whether we can be completely Atmanirbhar, as we call it, because this is a big supply chain, and we are kind of taking a step to slowly and gradually, we put in tariff barriers, non-tariff barriers, and all that. But in the overall scheme of things, if you look at 10, 20 years down the line, or 2047 as we call it, is this the right strategy for us to go? Because we can get cheaper module cells, everything from China.
So let's look at from the lens of government and from the lens of sovereignty. For every country, it is very important to have as much as of physical security is energy security. So what solar is solving for is India's energy security problem. And so the government does not look it in the isolation. There are cases where during the COVID, when the supply chain got disrupted, so countries got started prioritizing over each other. And second challenge is that India is planning to have 500 gigawatt today by 2030. But if you look at resource adequacy plan of CA, they have forecasted 2.8 terawatt of green energy sources by 2047, which obviously includes nuclear, pumped storage, battery, wind and solar. But solar is going to be the larger part of it. And if you look at the foreign exchange outgoing, it is going to be of immense current account deficit adder. So when government looks at it in the holistic fashion. As a developer, our biggest advantage of localization of supply chain comes from one aspect, that due to policy consistency, we now know that what we are bidding per and what returns we will have when we commission the project. Now we are not taking dollar risk, we are not taking the market risk. If you tie up with a credible player, then they are locking the price for 6 months forward. So your risk becomes significantly addressed, and that gives the higher comfort to the equity provider as well as the debt provider. And but if you look at in the real sense, in the solar space or wind or storage, true Atmanirbharta has not come yet. Solar is panel production, which is all largely automation. We have sufficient quantity now, but the bigger challenge is solar cells, solar wafer, solar ingot. There we don't even have 10 to 15% of capacity of what we are already ordering and consuming. So we are dependent on that. If you look at the entire glass for solar which India produces, my own manufacturing team needs it fully. So India doesn't even produce the glass which is needed by a single manufacturer, and we have 20 odd players who have come into this sectors. Similarly, you look at other bill of material, there is still dependence on Southeast Asian countries. So the crux is that true Atmanirbharta will come when the entire value chain is vertically integrated, and you can actually get everything from India within 100-kilometer boundary. Then you will be able to compete with anyone. So the biggest three cost is the cost of electricity, your supply chain transportation cost, and electricity cost. So it's, if you are supplying green power, you are cheaper than any other country in Southeast Asia. Your manpower cost is almost half of other countries in Southeast Asia. And if your manufacturing ecosystem is co-located, then you would be very competitive. So I think from the long-term perspective, not only you will produce for India, but you will export successfully and be able to compete with the other countries reliably. But the quality is the key, and innovation, that you have to keep remaining ahead of the curve in terms of innovation. So you have to keep building the patents, you have to keep innovating so that your quality does not suffer.
Yeah, thanks. I think this indeed will be one of the big industry where A, we are going completely backward integrated, and B, maybe after 5 years or so, when there will be intense competition between India and China, and we will see that maybe we are able to beat them at their game in some ways.
Actually, the biggest advantage is that you are creating millions of quality jobs, and you are not sending your foreign exchange outside, and the reliability of the whole contract with the government has got
Got it.
further strengthened.
Got it. Great, thank you. Let me get Mr. Ralhan. In infrastructure financing, the most standard thing is, first the developer gets the project finance, puts up the project in maybe 2-3 years, and then he does refinancing, right? And this whole what Nishan spoke about, partial credit guarantee or bonds, these are some of the key things for refinancing, because that is where reduction of interest cost becomes the key, I would say, value addition for the promoter or the sponsor. So at IFCL, how are you playing that role of refinancing? Because that is really the crux of the longevity of, the profitable longevity of infrastructure assets.
Thank you, Sachin. Very relevant. I'll first delve upon why refinancing is important for the sector and to get the investors in. Refinancing does two things. One, it frees up the construction capital. Secondly, because of the efficiency in interest rates and the cost of capital, the returns, investors' returns obviously get enhanced. That encourages entry of more players into the sector. So, as a very responsible development bank in the country, right from beginning, we have always encouraged refinancing during the life cycle of the infrastructure projects. By nature, these infrastructure projects are of longer tenure. So it's very important at different stages of maturity of the infrastructure project, the refinancing should keep happening, because it's then able to tap the capitals of various natures, whether it is domestic or global. So I'll first take up what we do at IFCL. So we have products to match the requirement of the entire project life cycle of any long tenure infrastructure project. At the first stage, we provide funding for the under construction projects. And we have a typical scheme called takeout scheme. On completion of the project, the moment it goes brownfield and revenue visibility is there, we are statutorily permitted to enhance our own share in the consortium and go up to 50%. And the pricing is absolutely linked to the rating of the company. So it is risk-based pricing. And that pricing metric is quite competitive as compared to what we have given during the construction along with the consortium. So that's the first stage of refinancing that we encourage. Second is once the revenues get more matured and the rating gets enhanced, we have a product of bonds for infrastructure SPVs, operational SPVs, where we can take up to 50% of the bond issuance. So I think in last 3 years, ever since we became active in the market, we have become the largest player in the infrastructure financing bond market, along with the other players. Thirdly, in a different format, we refinance at a much cheaper price than even the first stage of takeout. That's at InvIT level. You will see that we are one of the most prominent lenders to the entire InvIT community of the country. So once the monetization into the InvIT happens and you are more secure, because essentially all the InvITs are sort of AAA, we fund at the InvIT level and then take out the SPV level funding. That's what we have contributed as far as the refinancing is concerned.
Got it. Great. Thanks. Let me get Mr. Pankaj in it. Now, the infra is we spoke about a lot of growth. Data centers, we are saying they will become 4 times, I'm renewable energy, backward integration and all that. The question is, do we have enough capital? Also I'm saying in this context of many of the large banks, they have decided to go on the retail side of the segment because maybe they had high defaults and whatever, and there are these specialized institutions like yourself, IFCL, NAPFID and all that. Where do you see there could be challenge both say for project financing and for the, once the project is commissioned, refinancing in terms of the capital? And do you see that's a challenge that we could face in the near future?
So capital, we need much more capital than what we have been deploying. So maybe last 5 years we have doubled the investment rates, we need to double again. So if we have to go anywhere near our goals. So it's very obvious that two things we will have to do on whether it's equity or debt capital, we will need new pools of capital. One thing is very clear that the existing, it's not about capital availability, it's about direction of that capital towards infrastructure. So for example, on the equity side, if you see, and there is very interesting, and I'll not say a very good development which has happened in India, is on the equity capital side, today we have literally everyone present in India. We have multilaterals, we have sovereign funds, we have pension funds, we have utilities which are investing in India, we have private equity, we have everybody. And now even domestic private equity is taking off. So there is a diversified pool of equity available, but when it comes to debt capital, where you typically need 3x of equity capital, Indian market is very, very concentrated due to various reasons, historical, structural, preference of the banking system to go more for better yield products. On the debt capital side, 58% of the lending is done by 9 players only who are specialist infra players. And out of 9, 8 are public sector
banks,
entities.
Banks
Not
and financial institutions. Both banks and institutions.
So 42% is actually all banks put together, including public, private, foreign. So 58 is non-banks. Among non-banks is 8 are government-owned institution, and the 9th one is speaking to you. So there is nobody else in the country on the private sector side other than us. Now that's a major gap and a challenge. As a country, I think we need to have sharper clarity of role between public money and private capital. And when I say private capital, I include global capital, I include, retail money, pension money, newer and newer sources of capital.
One follow-up, is the problem that when project financing happens, and maybe it is a large public sector bank which traditionally does the initial project when it's a high risk, then they don't let go of those assets and they kind of keep holding on to it? Because the point is, unless they let go of them, it has to go. And so maybe the original lending is at maybe 10%, 10.5%. But then finally, when it is at a 7.5%, 8% kind of a thing, then it should come to maybe InvITs or public bonds or those kind of things. Is that something that needs to get tweaked? Because
it's beginning to happen. See, one of the, to some extent, it will come from innovation. So like you mentioned, InvITs. Now, InvIT, what is happening? Equity capital is also getting recycled and debt capital is also getting refinanced. So yes, you are right. I mean, Indian banks are like Indian parents. They, even when children grow up, they don't want to let go of them. Whereas, everywhere else, they let them go once they're adults.
That's a very good analogy.
So,
yeah.
It happens. But I think it's now inevitable. The pace will have to ensure that. But what happens is if public money and private money is chasing the same transaction, then obviously sovereign will have a cost advantage, right? So purely on the cost front, we cannot compete with a sovereign player. So I think that's where maybe sovereign money being used for something like credit enhancement or being used for newer sectors which are not yet stable. But bread and butter sectors, I feel it should be increasingly led by private capital.
Private markets. Agreed. Let me get Malvika in here. You spoke about international capital and all that. So where is IFC looking for, because, a lot of sectors in India have matured. I spoke about roads or maybe even power transmission and all that. When you look at, at IFC, multiple countries and all that, what are the new segments within India which kind of catch your fancy in terms of either equity investments or debt investments?
Yeah, thank you, Sachin. I think there are some sectors that are well understood and very well banked, maybe too well banked, as Virendraji was saying, where the same bankers, where 20 bankers are chasing the same project. Where we see the gaps in the market, I think there are some sectors where there is just the amount of investment that needs to happen is just not going in there. So urban infrastructure is one of them. I think all of us as citizens of the country can look around us and see that massive amounts of investment are needed. I think there have been several experiments with PPPs and some models are clearly working. But at the same time, there's a lot of investment that needs to be done by subnational entities. I think all of us sitting in India have been tracking mayor elections in New York, and we all know all the gossip about what's happening in New York. But when it comes to local government and local spending here, we don't have that level of awareness. So after many years of looking at the sector, we've just done our first direct municipal finance transaction with the city of Visakhapatnam for urban infrastructure. And that's a space that we're very excited about because while we can say everything should be a PPP, some sectors maybe cannot be PPPs. And subnational entities are actually the best place to do them. So we are lending directly to munis now without a sovereign guarantee. So we're doing the same kind of assessment that we do on commercial borrowers as far as management systems and capacity go. But we also work to get them up to that level for priority sectors. Yeah. The other sectors that are really of interest to us and where we've been desperately looking for players is on water and waste management and also in transmission. I think the renewable energy capacity will come up one way or the other, but transmission is now the bottleneck, transmission and land. We can't do much about land, but on transmission, we're trying to channel some capital over there.
Thanks. I think the point that you mentioned about capacity building in the urban space, I think that is clearly the need of that. I mean, I've been a municipal analyst, and I think the problem in urban infrastructure is the whole project development stage. It's not really financing. It's that they have to first understand that they need to build something, whatever that could be, a parking slot or whatever, and then kind of raise funding for that. I think at the first stage itself, there is a big gap.
That's right. No, I think, speaking for IFC and also for other DFIs, there is a lot of capital waiting to be channelized into this sector.
Correct.
It's a bit of a tragedy that if you look at China, there are several, multi-billion-dollar companies working on river cleanup, on waste processing. And in India, if you look around, there are very few companies.
Correct.
And again, the project preparation is where things suffer. You can announce a project, but if it's badly designed, it's doomed to fail.
Very true. Very true. Thanks. Let me get to Mr. Jha. And I think on the power sector, one taking on from what Mr. Mittal said, when we were talking about RTC. I mean, and I have a very genuine question here. If the RTC, and he spoke about 5.5 rupees, if there could be around the clock power, green power at 5.5 rupees or maybe 6 rupees or in that ballpark, do you think thermal power will have a sunset? Because you spoke about nuclear, which is a different thing that is still, but could there be a serious risk? Because thermal power was in a bit of challenge, but then we are seeing a revival. But then if renewable is available at 5.5 or say even 6, then do you think thermal power will survive? I know it's a thought-provoking question, but I want to put you in a spot.
First of all, let break the myth that, the both are, so adjusting with each other. It is not. Actually, both are complementing each other. This is actually Jai Biro ki jodi, you can say. The power demand is increasing like anything. So from the peak demand of 120, 160, 200, 220, now 250, it is projected that it will be 400, then 700. So capacity. Definitely capacity of renewable energy will increase exponentially. But at the same time, there is resource adequacy plan. Every state has to ensure that there is proper resource available to supply energy 24/7. And base load will come from thermal. So this is reactor basis, the energy sources. Let's take the peak demand of 400. It is expected that 100 will be from other sources, but 300 definitely will have to come from thermal base load. And the present capacity is 200 gigawatt net. So there will be additional of 100 gigawatt. From where it will come? Not see base load as a energy because this is a capacity charges. over and above capacity charges, there will be either energy charges from fossil base or from nuclear or from energy sources. So this base load presently, so it will be from thermal, and definitely, maybe after decade, as the government of India, Central Electricity Authority, they have projected that there will be addition of nuclear plant, maybe 100 gigawatt by 2047. As my group CFO, our group CFO Robbie is there, what he used to say, that what US has achieved so far economy is concerned, India will have to achieve in next 20 years. So what US has achieved in nuclear, India will have to achieve in next 20 years. So base load will always remain be there. This is complementary to each other.
I like the way your comparisons both on nuclear and thermal with US. I think that's a right way, in terms of the growth and the size, because both of
absolutely. Your peak capacity will be 700 gigawatt. So 700 gigawatt will come from where? There must be the base load. And base load will come from thermal, fossil based presently, and in future it will be a mix of nuclear.
Got it.
Thank you.
How much time do we have? Sorry, Oh, time's up. I thought it was times now. Same color. Okay, I could see that. So I had a few more questions, but I think I will have to, in the spirit of kind of, controlling the overall agenda. So I will, but overall, thanks a lot to my fellow panelists. I think it was really a big panel and a diverse panel to really handle. But I think we did maybe a good job. So great, thanks, and over to you.
And yes, you did do a good job, and the time is now for me to move into the next panel. But meanwhile, may I please request Sujal Desai and Parag Kothari of the Trust Group to step on stage and thank all of them for their time and their participation in this panel. Good evening. Are you please? We'd like to felicitate the moderator, Mr. Sachin Gupta, Chief Rating Officer and ED, Care Edge Ratings. Thank you for moderating this session so ably. We appreciate your presence. We'd also like to thank Mr. Raj Kumar Ralhan, Mr. Virender Pankaj, Mr. Vineet Mittal, Ms. Malavika Pillai, Mr. Sharad Agarwal, Mr. Nishant Kumar, and Mr. Dilip Jha. All of you esteemed panelists, thank you very much from all of us at the Trust Group for taking the time out and joining us here and adding value to this summit. I'll request you all to come together for a photograph, after which we'll move straight into the next session. All of you who just entered the hall, if you want to settle down, take your seats. It'll be great. And while they're taking that photograph, ladies and gentlemen, once again reminding you that you can scan the QR code that will now be visible on the screens to my left and right here behind me to my right. The Knowledge Vault will be accessible if you scan this QR code. Do take a look at it. A lot of effort has gone in creating Knowledge Vaults for different sessions across the day. Thank you all. Any day the photographers will have their way. They're not going to let them go until they get the perfect shot. Thank you. Thank you all. And now, ladies and gentlemen, it is time to invite on IDCMS stage Robbie Singh, Mr. Jakshinder Robbie Singh, Group Chief Financial Officer, the Adani Group. Now, Mr. Singh has been with the Adani Group for just over 12 years, of which the last 6 years he spent as the group CFO. Prior to this, he's worked for over 17 years in investment banking in Australia, New Zealand, North America, Europe, and Asia, with a focus on infrastructure, regulated assets, and structured finance. Mr. Singh's vast and rich experience includes all the aspects of mergers, acquisitions, strategy, finance, and risk, with a particular focus on listed and unlisted infrastructure bonds. Let's not waste a minute more and dive straight into this next high-powered session at IDCMS 2025. He will first share his thoughts with us, which will be followed by Hani Jalan, President, Investment Banking and Credit Solutions Trust Group, taking stage for a conversation that we all have been waiting for. Ladies and gentlemen, please put your hands together and welcome on IDCMS stage, Mr. Robbie Singh.
So guys, can you hear me? Yeah, okay. I'll just take a few minutes to, because I was just asked the other day, 2 days back in Singapore as to, why this is different this time for India, because every time people say that it's India's growth period, but it doesn't eventuate. So I just thought that there I didn't have this with me, so I answered the question, but I just thought I'll show you why it's very different this time around for the country. And that difference is based on the microeconomic change that has occurred over the last 10 or so years. And so, in Punjabi, there's a very simple saying, so I can translate to you in English. In Punjabi, we have something that which says that it goes something like this: "Desh tarakki te chalya, aime na gaddi rok deo," which basically means the country is finally moving to progress. Don't do anything to stop it. And so we have to be careful that what we do in the next 10 to 20 years is consistent with where the country is going. Just to give you some snippets of what I mean by this. We are here, but just to give you an idea, in 2012, equity market cap was around 1.4 trillion. Now it is roughly 5 trillion. The AUM held in India was about 153 billion. Now it is 886 billion. Tax as percentage of GDP, we used to collect about 10% of our GDP in tax. Now we collect 12. We are more in line with mid-income countries now. India's household wealth was around 4 trillion. Now it is around 20 trillion. PSU market cap was around 15 lakh crore in 2012. Now it is about 69 lakh crore. SIP accounts were less than 30 lakhs, now 9 crore. GST registrations, about 66 lakhs, now 1.5 crore. Railway electrification, 2012, 33%, now 98%. Cities with metro, 3 in 2012, 23 now. Digital transaction, 162 crore. Today, 22,000 crore, and we are number 1 in the world. Universities in top 20 in Asia, 0 in 2012, now 20 in 2025. People with health insurance, 10 to 12%, now 50%. Income equality in consumption, lower the number, better it is. 36 in 2012, 25 now. Income equality in income, 54 to 41. Income equality in wealth, 81 to 74. 70 was still too high, but it's coming down. Employment, worker participation rate from 48 to 58. Think of it this way, in 2012, half of our people didn't even participate in work. Once the number reaches about 65, we'll be the same as OECD countries. Employment for females, doubled. Participation rate from 21 to 41%. Labor force participation rate from 22 to 42%. Sometimes it's difficult to assess why the elections are. This is the vote chori. Those of you want to know. When that many women get a job for the first time, they will vote for who's giving them the jobs. Type of employment, informal sector down from 30 to 20%. Total employed people from 47 crore to 64 crore. This has been a change beyond comprehension in the last 10 to 12 years. Something we could not achieve in 65 years before has been achieved in the last 10 years. This change cannot be unwound. You cannot take 20 crore people out of workforce again. You can't take women's participation rate to 20% again. Employee Provident Fund numbers in the last 4 years increased by 7.4 crore. I can keep going. This is no big, this is not in the media, this is not in big headlines. These are changes on the ground that no new government can unwind. This is now baked into India's growth story. Okay. And our numbers for Adani are just a reflection of what is happening. We primarily invest in the core infrastructure, energy and utilities, plus transport and logistics, which in our average Indian consumer use. Indian consumers' participation in workforce is rising, incomes are rising, household wealth is rising, so consequently, utility participation is rising. Like everything else that has happened in the last 12 years, we at Adani are also very simple productivity investment model. We invest in the productivity of the country like the government has done for the last 12 years to improve fundamental economic aspects of productivity, health insurance, education, uplifting the university standards, and so on and so forth. I can go, like I could have had 100 slides like that of issues of importance to people that are not covered in mainstream media. Consequently, when you invest in productivity like the country has done for the last 12 years, whatever happens, be it COVID, supply chain disruption, Ukraine war, absolutely nothing makes any difference. Over the last now 7 years, we've grown roughly 22% odd. And this is on a rising asset base, which I'll come to. The growth resilience, the only thing we have to assure here is to maintain a level of discipline. So we've 4 times the asset base, from 1.5 lakh crore to over 6.7 odd lakh crore. Now this asset base, 4 times, but the rate of return broadly has remained around 15%. So at 4 times the size, we are earning exactly the same what we were earning in 2019. The leverage has reduced over this period. So we are growing at 22%, and the leverage is still reducing. Why? Because of the stability of the investment in productivity, the credit ratings keep rising. And the increasing quality of credit across Adani portfolio results in the lower cost of funds, as you saw. And the change, we have one of the largest long duration portfolio in India, even longer duration debt than government. Even then, our cost of funds have gone from about 10 to about 8.7 on a much, much larger asset base. And across the board, what this means is that our continuing ability to diversify the sources of funds. So today we are around 6% in domestic capital markets. This number will become close to 18% over the next 3 years. And it span across insurance, mutual funds, and etc. And one of the things that we did want to achieve when we set out on this journey in 2017 was to reduce or eliminate refinance risk completely. So which means that including even if there's no refinancing, majority of what we want to do, which is around about 100 billion or just over 100 billion, about 9 lakh crore of investments over the next 5 to 6 years, virtually all of that we can do from our own internal generated cash flow. And that is why we'll keep investing. Now, funnily enough, when you don't need the money, everybody wants to give you the money. So we'll borrow. But even if we were not to, the same thing will happen. But in summary, what I want to convey is that there's a fundamental change that has happened in India. It is not obvious today, but when you see the underlying things, that till 2012, including IITs, IIMs, etc., there was not a single university in top 200 in Asia. Today, there are over 20. Only 3 big cities have metro. Today, there are 23. So you can imagine the change in lifestyle of the average Indian person. When the Ayushman insurance program spreads out over the country, people don't realize what health insurance means. Health insurance means one of the fundamental inputs into productivity, which means that people will take risks. And you will see the risk capital in India rise. And because the households have over $19 trillion worth of assets, all of our capital is going to come from internally generated funds. And that will give India the stability for the first time. The foreign institutional investors can be zero, it will make no difference. So Honey has some questions for me, so I thought we'll do Q&A answer rather than just me talk about presentations. Just very quickly before you come, which is not a good statistic, but I'm just showing it to you, which is that at Adani, we on average, we do about 33% of private sector capex in the country, which should not be the case. It should be, a number should be, others should also do it, but 1/3 of all capex done by Nifty 50 is done by us. Which means that the PAT growth, the market cap growth, leverage puts us in a position where a massive fundamental re-rating like will happen for India is going to happen for Adani portfolio.
Great, thank you, Robbie. And I'm just going to, thank you for being here for the 4th year. And on behalf of everyone, we've actually tried to summarize and put together our assessment of Adani's growth journey in the debt capital markets. If we can have the slide up, please. It's a lot of what you said, right? I'm just going to summarize. I think over 3 years, we've seen more than 20,000 crores of issuance in the Indian debt markets. You've borrowed right from a 1 year to a 19.4 years, which I think shows the depth of the debt markets. You've got a diversified investor debt base of more than 40,000 investors and a presence in both private markets and public placement markets. Your rating spread also has been from A+ to AAA when you started, but I think in 3 years we've seen the companies that you brought to markets also seen an upgrade across 4 of them, which is Adani Enterprise, Adani Ports, Adani Airports, and Adani Power. I think you've already covered the spread of investors, and I don't see a single investor in the debt markets participation that you have actually left behind, and multiple different kind of structures that we have seen. So what is it that now, if we take it forward from here further, with the sizable capex plans that Adani has, how do you plan to balance the new fundraising and refinance of existing obligations? I understand you've already showed me something that you may not need to borrow. You've managed everything. But where do you see that balance coming and how?
I think it's just from the risk perspective, we want to be in a position where our growth plan is not dependent on us accessing any capital. Now, that doesn't mean that we will not access capital. Yes. It just simply means that when we do our planning, because of the scale of our plan, so roughly, give or take, we will invest new assets, about 1.5 lakh crore a year over the next 6 years. So when you're investing 1.5 lakh crore as it is, so you paying hard 3,000 crore literally on a weekly basis. So last thing you want to have is something happening and somebody saying, no, I will look at it, or later, today's election, tomorrow is, somebody's marriage comes up and the whole market stops. So we don't want that to occur. So we plan in the manner that we can do it ourselves. But I've been very clear, I've said this over the years, that we are of the opinion, both our founder, Gautam Adani, myself, that Indian infrastructure must be owned primarily by Indians. Okay, so consequently, every type of instrument which goes to finally pays a fellow Indian as an investor has to be taken care of. Today, for example, terms beyond 20 years are not there. We want to introduce terms beyond 20 years in the Indian market so that life insurance and life companies, which will become a big part of the portfolio, they can match their liability. So that will come. Indian infrastructure has not seen fractional asset-backed financing. So now we are in the position to do that. So that will come as well, because what I mean by that is you have an asset that comes quickly online for 5-6 weeks, which is say smart meters. they don't need to be funded in a traditional way. They can be funded as a quote-unquote an asset-backed type paper. So those kind of products will come. They're highly rated. They will be AA+ to AAA rated papers. So you'll have wide gamut of papers that can be issued anywhere from 1 year to 10 years to 30 years, giving a much wider scope. And because we don't borrow, as Adani, we don't borrow generally for corporate purposes. We borrow at asset only. So which means that we can always give the asset covers that insurance and life companies want. And so that way, you'll see this evolution of product set much more tailored, because when you refer to the 19-year paper, it was actually 19.2 precisely. But it's a specific date that a particular life company wants to have. So we can issue series of papers at the specific date that a maturity is coming.
Great. So now if I add to this, I think in 3 years, we've seen only 20,000 crores of debt that Adani has brought to Indian domestic markets. And I think the markets have shown to you the depth, the kind of structures that we can take on. So what do you see is now going to be the role of the Indian debt markets participation out of the 335,000 crores of debt that you've shown? And how much do we see is the fraction that the Indian debt markets will contribute compared to global borrowings and bank borrowings?
I think we are confident that we will equalize the domestic market to our global market. So we will take it to give or take around 75,000 crore.
Okay. And that's what time period?
I mean, ideally, say 2 to 3 years, but certainly by 2030. There are a couple of things which we have to resolve, which we will work with banking partners and with our own treasury also, which is to create a much more depth in today there's depth in the availability of funds, but there's not depth in market making. So we need to create depth in the market making. So that has to happen. Initially, we'll have to sort of help ourselves, but we will do. Then the other thing is that we are still not 100% credit. We still take, people say, no, election is coming, can you wait for election and those kind of stuff. So people have to decide whether they're credit investors or
I will come to that
event
in
investors.
some time.
So, yeah. So.
Okay. So, Robbie, to take it from there, so I'm happy to hear that we are going to look at about 70,000 crores. So 20,000 is going to be added to 70 and we take it to 90?
About 100,000 is our target.
Okay.
Yeah.
So we are looking at about 100,000 in the next 5 years by 2030.
Yeah.
Great. If I now look at it and, you have one of the largest sizable renewable players in India and with energy transition space, what are you considering as innovative structures other than the cash pooling structures that you have brought in from sustainable linked instruments or anything for a low carbon initiative from an Adani Group?
We look at energy from a slightly different point of view. So you don't want to do sort of transaction or instrument for the sake of instrument. Adani Green is overall
yes.
Green. AESL is also in energy transition. So we will, our main objective is that in the next 10-year phase is our scale is still not at the global levels. So our first thing is to lift the scale to global level. So being like, get Adani Green to about 50 gigawatt or so. AESL to be able to distribute from current about 4,000 megawatt of power to about 20,000 megawatt of power. Because finally, what's coming in the next 10 years is that while there's a lot of hype about AI, but AI is nothing but the cheapest electron because of the compute power that is required. So what you want to end up is to be able to, for us as a country, to be end up to be able to have a compute cost so low that we can be a meaningful participant in the revolution that's coming. And we would have to do that. And to do that, we need to make sure that our energy infrastructure is in a position to deliver that electron that is required for compute. And so that becomes the bigger objective. So to do it very simply from a debt and equity point of view, simple capital, because the focus is on development and building the operations for the AI age.
Okay. So now I'm going to move from a debt cycle that we've been talking about and maybe talk on an overall perspective on an Adani Group. And, so how do you see the group enhancing in terms of disclosures, governance, and communication practices to increase investor confidence in the domestic debt markets, especially in the light of the expanding investor base? And I think you talked about the fact that Indians should participate in the India growth story. So how do we work towards bringing in confidence among these investors?
See, I think one of the things that we deliberately try to do is that I think we are one of the few corporates that do regular domestic roadshows. The idea is that our objective is that longer term majority of our infra has to be owned, as I said, by Indians. So consequently, our people must own the infra. And that has been the case in the world. Germany built its own infrastructure, US built its own infra, Australia built own. Nobody came from outside to build the infrastructure. So we have to do it ourselves. So the confidence is that we have to, whenever I travel sort of non-metro areas in India, one of the things you find is that people are not aware. The financial literacy and the availability of financial information to non-metro participants is low. So it's our objective to create information flow that goes all the way to our non-metro areas. Because we fundamentally believe that if that was the case, then people who have just, and investors and families who are just currently deposit based as the only means to earn fixed income, that they can increase their income by 200 to 300 basis points for the same credit quality, but if they participate in the capital market. So the objective is to inform that risk element so that people, when they invest, because bank they can see, bond is a piece of paper. Where is the money gone? Okay, so you have to answer this question. And so we have to answer this question, and no pun intended, this is trust issue. So we have to build this trust that people see this clearly and can fundamentally see the money.
I agree with you, Robbie, sorry, but how is Adani actually, what are the steps that Adani is taking in terms of communicating the sort of changes in the governance practices, the ongoing sort of developments in order for investors to get that comfort? So for us to reach that number that we've talked about.
I think even our language, even your question, even our language is based around a lot of assumed knowledge. Yeah?
Okay.
See, if I can show someone on their feature phone, yeah, that they gave 1,000 rupees to Adani, and we claim that it was to invest in Adani Green, in a wind farm facility in Rajasthan. If I can show to them on their feature phone that once they gave this 1,000 and that 1,000 is gone to that particular wind turbine with this number which they can see. And what we want to do is to be able to, this is basically another way of saying you put the blockchain onto the investment and then let people see where the money is going. And we'll be able to provenance each rupee. And we'll be able to say, when you say, I have a security on wind turbine, we'll be able to say, you have a security on wind turbine number 2734. It sits in Rajasthan. Here it is. It's operating. You can see.
When will I be able to see this?
We can give you OTP now itself, but we want to make it available to public. But we'll make it available to. There's a disclosure issue, so and so forth. We have to meet with SEBI guidelines. But to rating agencies and banks who are behind the wall, we can already do it. We have that capability. We can provenance down to the asset. You can see it yourself. We don't have to intervene. Go type your code, and you will see whether it's there or not there, as producing, how much it's producing. You'll see every single thing.
That's great. I think that's a great initiative, and I think it'll be good for some of the rating agencies and others to look at it and actually communicate that, I think, to the market.
Yeah.
I'll come to this question, and this is something where I feel that investors would have. And so what are the risks or opportunities that might arise for the group if there is a shift in the political leadership?
See, you might know this, but those who don't, since the killing of the Sikhs in Delhi in 1984, I have not been to Delhi. I will never go to Delhi. I meet no politicians. I have never met a politician. Because quite frankly, I don't care about which political party is in power. No decision I make on behalf of Adani Group, and I sign every single investment of the group. So before the chairman's signature is mine. So no signature of mine includes an assessment of which political party is in power where. I don't care. It doesn't matter to me. I personally will never meet a politician since 1984.
Okay, I'm going to delve a little further on that. Okay, so that's great. The question here, if we push it further, is that do we foresee any regulatory policies or anything that may make changes that can impact the group in any manner that anyone from a risk perspective should consider?
No, I think when we broadly have a federated political structure, so our regional parties are quite strong. So most of infra, which is for us, happens in the state, because the land's in the state. So land will be in some state. So we have to see what is the political landscape in the states. So if you look even today in the political landscape, it's roughly 45-55 between sort of say the regional parties or opposition and BJP. So states are already 50-50 practically. So the state landscape is meaning that your actual ability to build infrastructure doesn't change. Doesn't matter who's in the. What will change is that, say for example, this government's focus is on capex as a part of fiscal policy. You can conceivably have a government which says, no, our focus is on say, subsidies. So you'll have a shift of government expenditure. But I think, and the numbers which I showed, I think now at the people level, it is unlikely that a significant variation can occur between governments because of the fact that you simply can't pull that many people out of economic structures. And because of that macroeconomic change, there will be a policy convergence. We notice this is a state level. Doesn't matter when the governments change. The states continue their policy structure because of the fact that GST can't be unwound, employment can't be unwound, insurance can't be unwound, and university changeover that is taking place can't be undone. So as long as those microeconomic things remain, there's a convergence. However, the stresses on the topic will be different.
Okay, great. So I'll just wind it up with one last question. Sure. Out of all, you're present across every value chain of the infrastructure sector. What are the top 5 sectors that you believe are going to be adding to the growth of the Adani Group over the next 5-year period?
No, for us, just the two, energy transition and logistics. Logistics driven by airports, primarily, for us, and energy transition driven by the fact that there's a step change coming in the use of power in India. So our installed power capacity will go towards 1,500 gigawatt from current about 465. So just that change and the change in the logistics infrastructure.
Great. Thank you so much, Robbie. I think it's been a pleasure. And once again, thank you so much for spending time at our summit.
Thank you.
Thank you.
Thank you.
Now, wasn't that what we all heard? Wasn't that wonderful? Put your hands together, honey. Please say thank you to him on our behalf for his presence here this evening. We'd like to present you, Mr. Singh, with a token of our deep appreciation.
And that, ladies and gentlemen, was Mr. Robbie Singh in session with Hani Jalan at IDCMS 2025. Thank you, thank you, thank you. Thank you. Thank you, Hani, for stepping up for this session. Hani, ladies and gentlemen, is a strategic financial leader with 25 years of experience in investment banking, debt capital markets, business development, credit solutions, securitization, private credit, and credit ratings. Recognized for her excellence in leading complex transactions, developing innovative financial solutions for a broad spectrum of Indian corporates, and successfully enabling first-time issuers in accessing capital markets, Hani's contribution to trust is invaluable. We thank her for moderating this session. Once again, reminding all of you esteemed delegates about the QR code that will be shown to you on the screen. Do scan the QR code and access Knowledge Vault, painstakingly created for all of you. Great value right here at IDCMS 2025. And let's take a very, very, very short beverage break of just 10 minutes, and I'll see you back in your seats for the next business session. 10 minutes, ladies and gentlemen, and I'll see you back here. Thank you very much. Ladies and gentlemen, all of you near the entry of this hall, if you can step forward, settle down, take your seats. We'd like to head into the next business session. Thank you. Welcome back, ladies and gentlemen, from the beverage break. Moving into the next business session of the day. Now, introduced by SEBI in 2014, real estate investment trusts and infrastructure investment trusts have transitioned from policy experiments to quiet pillars of India's asset monetization strategy, turning operational assets into tradable securities and channeling long-term capital into sectors that need it the most. They have bridged the gap between infrastructure ambition and fiscal limitation, offering a credible market-based mechanism to recycle capital, deepen ownership, and channel long-term savings into productive assets. These vehicles provide unprecedented access to institutional-grade real estate and infrastructure assets while offering attractive risk-adjusted returns and portfolio diversification benefits with combined assets under management exceeding 9 lakh crore and growing investor adoption. REITs and InvITs have emerged as critical components of India's financial ecosystem, bridging the gap between traditional investment avenues and alternative asset classes. In a sense, they represent more than financial instruments. They mark a structural shift in how India builds, owns, and finances its infrastructure and real assets. To lead us through this next conversation, esteemed delegates, I'd like to welcome on stage Mr. Vinay Sekhar, Chief Executive Officer, Cube Highways Trust. I know we have fewer delegates right now, probably many of them out there still catching a cup of tea or coffee, but we can put our hands together louder for the esteemed moderator of this session. Very warm welcome to you. The esteemed speakers of this session, Mr. Ramesh Nair, Managing Director and CEO, Mindspace Business Parks REIT. Sir, please join us on the dais. Good evening and a very warm welcome to you. Please also welcome Mr. R. Govindan, SVP Corporate Finance and Chief Risk Officer, Larsen & Toubro Limited. Good evening, sir. Very warm welcome to you too. Also, please welcome Mr. Rajiv Radhakrishnan, CIO, Fixed Income SBI Funds Management Limited. Namaste. Good evening, sir. Very warm welcome to you. And also, please welcome Mr. Gaurav Malhotra, Chief Executive Officer, Sustainable Energy Infra Investment Managers Private Limited. Please take your seat on the stage, sir. Good evening, warm welcome. And Mr. Krishnan Iyer, Chief Executive Officer, NDR InvIT Managers Private Limited. Good evening, and a very warm welcome to you on stage. Ladies and gentlemen, good to see you all walk in and join us for this next business session. Handing this over to the Honorable Moderator, hoping that more of our delegates take their seats in this audience. Thank you very much.
Thank you so much. Thank you, everybody, for turning out. Before we get started, I want to thank the Trust Group for putting this together. It's a wonderful panel that we have here. I'm looking forward to a session, 45 minutes, where we explore various topics within the InvITs and REIT space. Maybe what we do is, I think we've laid out the fact that InvITs REITs over the last 5 to 10 years have been fairly successful in building assets. They've grown to about 9.5 lakh crores. How do we see this sort of progressing? What's the role that InvITs and REITs are going to play incrementally for monetization of assets? Maybe we just go through around, just set the context. I just want to hear everybody sort of give their 5-minute, 2-minute view on what's next, and then we delve into a few questions, if that's okay. Yeah, maybe Krishan.
Hi. Thanks for having me over here. InvITs are a platform, right? I mean, if I have to look at what Utpal Bhai mentioned this morning, is there an echo? There seems to be an echo. Am I audible? We're audible. Okay, right, yeah. So it talks about resilience. It talks about growth. It talks about breakout, the conference. Where are InvITs today? I think InvITs are relatively new product. I was just talking on the sidelines to Rajiv here that it's still not mature enough for the retail investor. So that's where I think we should get. Because I truly believe in one thing, price discovery happens when trade happens. And I think that will show that InvITs have truly matured. But yes, we have grown. You know, as an industry, it has grown. If I have to look at warehousing per se, I think it's really helped. The industry has grown, and InvITs have been a great platform. And we were fortunate to be the first perpetual listed InvIT. And yeah, that's what I can say.
Sorry, if somebody, we're not able to hear ourselves, so if somebody can sort of just adjust the volumes. Yeah, thank you, Rajiv.
Yeah. Thanks, Vinay. In fact, it's again been a good evolution of the whole the InvIT and REIT piece. In our journey, just to go back, we started off actually starting to invest in bonds of REITs and InvITs. Then we have progressed incrementally to the extent that it's permissible buying or investing in the units. So in a way, that evolution has actually started by the traditional method of starting with a bond investment and then sort of progressing along. And I think a lot of things have been put in place from a regulatory perspective. I guess going forward, maybe you see new asset classes beyond. So it's largely been roads and maybe initially transmission assets. Possibly a lot more of other infra assets could get added. The second, and I think or more importantly from an investor perspective, where possibly a lot more needs to be done is awareness, a little bit more on liquidity and pricing. I think this could be the challenge for the sector. And again, from an investor community, some of the prerequisites for it to be even, I would say, much more widely held than what it is today.
Thank you so much. Ramesh.
Vinay, I was reading this article in September 21st that Nifty and the Sensex year-on-year returns were 0%. And I asked our CFO to check what was our total return, yield plus appreciation during the same 365 days, and it was 36%. So it's a nascent asset class. Today, only around 300,000 people invest in REITs in the country. But one thing to be noticed here is today between the REITs and InvITs, AUM is around 9 lakh crores. This was exactly where the mutual fund industry was in 2013. And we have seen how the mutual fund industry today has grown to a 75 lakh crore industry. So that's one. Globally, there are close to 1,000 REITs in 40 different countries. 50% of American households invest in REITs as a product, compared to our 300,000, which I think is 0.01% of the households or something. So that's the opportunity. We have only 5 REITs in India, and in spite of everybody writing off office as an asset class, when COVID happened, all the 5 REITs, all the 4 office REITs, if you had invested when they listed, still you would have made a 16% return, and all the tax benefits available with investing in REITs. So I think it's a matter of time before you have many more REITs. We will see REITs in retail and hotels and data centers, in warehousing, logistics, industrial, all these. One funny thing I was reading the other day is in markets like US, there are prison REITs, there are cannabis farming REITs.
So I think it's a matter of time before the industry becomes big, and there's 300,000 people who currently invest in grow. I think with India REITs Association, we're trying to spread that message that people like us have given 36% return in the last 12 months. And I think it's a matter of time before the market grows.
Thanks, Ramesh. Sir.
Yeah, you can hear? Yeah. I think if you go back in history, 1,000 years back, India used to be 45% of world GDP. Right? You had the Mughals, then you had the British. They sucked out everything. So you became something like 1.5% of GDP by 1945.
Okay.
Can you hear now? Better? So,
I think we're not able to hear each other. Yeah. Okay. There's a lot of echo.
So you want me to continue or?
Yeah, it's better now.
Okay. So in 1947 we became what? 1.5% of GDP from 45, right? So it's a very young country. We are doing something spectacular 1,000 years back. British and all that industrial revolution we were still running. We just Desh Ki Dharti Gana wahi chal raha hai, right? We used to be very different. If you go back to visualization 1,000 years back, it used to be one of the most. What is US now? We were maybe 100 times that. Okay. So if you look at it from that side, so we spent that first 25, 30 years on food because we used to import food. And all our colleges were IIT Bombay was done with Russian help. Chennai was done with Germany, right? And Kanpur with US. All the educational institute and public sector with the old technology, whatever the Western world gave, that is how the country started. So we dealt with first 30 years food, then milk. By 1980-85, we realized this economic framework is not going to work. We wanted private sector to play a role and all that. We couldn't have done it in 1940. We got taken over by Britishers, foreigners. So you couldn't say FII investment should come to India. You couldn't have said this in 1947, right? So you had dhoti-clad people. It's all changed. I think only in the 80s, I think the world, India government influence on the GDP used to be something like maybe 95%. 5% used to be private sector. That's changed now. You had the manufacturing, then you had the opening of the economy. Ultimately, only by 2000 we realized infrastructure high in country mein. Road hi nahi hai, kuch bhi nahi hai. Now if you have to move forward, there is nothing available. So from a perspective of supply of infrastructure assets and real estate assets, there is a lot of things to be done. If we grow at, given the population, if we grow at even at 6.5%, we will be a 25 trillion, 30 trillion economy by 2040-45, right? It is just a power of compounding numbers, right? Now, if you have to go there, you have to invest. And government ka fiscal ka problem hai. State government ka fiscal ka problem. Fiscal ka problem meaning they have not yet evolved yet, right? After the GST tax to GDP ratio went up, so the government is doing a bit. But government cannot do all the infrastructure which is required to be done for the next 50 years. If India is to be somewhere like 20% of the world GDP, you need a lot of innovation to happen. But at the same time, infrastructure is very important. Infrastructure, logistics, everything is very important, very critical. It's all very base, the framework on which the entire economy will sit. Now, government started this public-private program. Very horrible earlier, later on changed, right? Later on changed significantly better in the last 10, 12 years. I think the framework became better. So if you look at the supply, let us say 9 lakh crores, I think we need at least 300 lakh crores of additional investments in infrastructure, easily. $3-4 trillion or $4 trillion is going nowhere. If you have to go there, you will have to do all of that. So supply side government is there. How will you fund it? Now the PPP framework, some of this framework, either from foreign funds and domestic funds, a lot of GPs are required. You need a lot of funds and a lot of promoters. There are companies who are the developer community, right? You need a lot of them. You need more of GPs here. banks, institutions like State Bank, they have to play a bigger role here. So on the supply side, today banking assets are something like 220 lakh crores, right? And mutual funds and stuff like that is around 75, 80. Insurance is around almost 75, 80, 90. वो अभी 3-4% भी मतलब 1% भी इन्वेस्टेड नहीं है यूनिट्स में थोड़ा डेट में थोड़ा बहुत कर लेते हैं बट वेरी लिटिल सो मोस्ट ऑफ द एग्जिस्टिंग इनविट्स एंड रीट्स the benefit is with foreign institutions only. It is not lying in India. It's all with institutions outside. Now we will have to build our own institution. And my sense is that 20-30% of the assets in insurance companies and provident funds and all of that, we can move to the InvIT. Today, equity can do 15% in most of the provident funds and all of that, 15% in EPFO and all of that, they can do 15%. But InvIT REIT में तो करते नहीं है, debt करते हैं, but units नहीं करते हैं. If you do all of this, if you do total size of the total finance available is, as I said, at 220 plus. If you just total up, 500 lakh crores ka to hai. And if the GDP grows, that will go to 1,000 lakh crores, right? In not more than 2, 3, 4 years. उसमें तो 15-20% तो कहीं भी नहीं गया. मतलब आपको 200 lakh crores, what we are talking about, 9 lakh crores. 200 lakh crores should be easily be possible in maybe 10, 12 years. 12, 13, 14 years, it should be possible. But the framework needs to continue, that sense of that fair play, the sticking to contract, government framework, state government framework. If it is all made reasonably comfortably, right, that is what has changed in the last 10 years. So my sense is that demand supply can be 20 times of what we are today in not more than 12 years' time. 10, 11, 12 years, it should be there. We should be working with that sort of vision and it should be possible. So that's the scale, should be possible.
Understood. Thank you so much.
Thank you. I think just to supplement Govinda sir, I think talking about the power sector, just to put some numbers in perspective, the largest transmission InvIT in the country today just owns about 2% of the overall capacity in the country that exists today, which is a phenomenal statistic. Even if you talk about the renewable energy, for example, we are the largest renewable energy InvIT in the country. We own 1.5% of the solar generation capacity in the country. And both these sectors are expected to grow at a phenomenal rate. Just about solar, we expect the 100 gigawatt today going to 300 gigawatt in the next 5 to 7 years. And that is just replacement capacity. Once we start replacing our thermal capacity into more clean sources, only sky is the limit. So I think just to supplement the points the sir made, I think it's a phenomenal road ahead for all of us.
Yeah, thanks, Gaurav. Maybe Rajiv, I'll just, I think we've sort of looked at what's possible and what's the potential. But I think one of the questions I had for you, because you not only invest in InvITs and REITs, but in the wider economy and in infrastructure otherwise, I think we've seen the fact that a lot of sponsors have used InvITs and REITs to clean up their balance sheets, right? Have you seen that play out in the way you've invested over the last 5 years?
To some extent, yes, but I think it's beside the point because the main thing that we are incrementally seeing is clearly new asset classes emerging. I think that's possibly the area that we would incrementally want to be looking forward, going on an incremental basis.
So you've not seen as many?
No, not to that extent. Yeah.
Understood. Krishnan, maybe I just want to. One of the things that I find interesting is that the last 9 lakh crore growth of InvITs and REITs have been largely sponsor driven, right? Do you see that changing going forward? Do you see InvITs and REITs growing beside the sponsor?
Okay, I'll use a disclaimer because I would go and stick my neck out and say that it's good to be sponsor driven. Because a few things. One is the sponsor understands the domain. The sponsor comes to their expertise. I mean, be it Raheja's or in our case, NDR or whatever it is. Second is, it gives them a chance to, let's say, churn their balance sheet. As a developer, how long do you wish to hold an operating asset? You develop and then you churn it. So what it gives us, the InvIT, the platform, is a pipeline asset. So as long as governance measures are in place, and as long as we are buying not above the market rate, whatever we've acquired from the sponsor, it's been below the market rate, because we want to kind of maintain that. And I think it's good. I mean, I don't see a perceptible change going forward. I think investors are also okay with it. So as long as, you know, I mean, what are we? We are, I mean, end of the day, whether it's real estate, it's energy, it is transmission, it's warehousing, I'm in the yield business. I'm not in the warehousing business. I have to be very clear, because investors come, they ask for a yield. My only grief is they want debt kind of a security, but they want equity kind of returns. Right? I mean, InvITs are a great platform. But I don't see a change or a shift happening that from a sponsor-driven, it goes on to where a set of other professionals come. And I'm not saying that's not necessarily a bad thing, but I think it's good to be sponsor-driven, where the sponsor skin is in the game as well.
Sir, I think you, as L&T, you've had experience in infrastructure even before InvITs and REITs. How do you see the whole paradigm change now that there are InvITs and REITs? Would you be investing very differently if InvITs and REITs had existed 20 years ago?
Of course, I think you'll have to simplify the challenge, right? Nobody knew what is PPP and stuff like that. So you had a draft concession agreement and all that. I'm not talking about REITs, I'm talking about InvIT, I'm talking about infrastructure. First projects which we did in Coimbatore bypass, basically Kerala and bypassing Coimbatore, the other parts of the India connecting to Kerala via the 30 kilometers away from Coimbatore city. We said nobody is going to use the damn road, right? And government gave one more small bridge, which is in the city of Coimbatore, 100 meters bridge. They allowed us to toll. Now, people used to come, they said, we used to charge, I think, 20 paise toll for a scooter and maybe 30 paise for a car, right? They used to park their vehicles. I said, hey, government, who the hell are you to collect tolls from me, right? So for 1 or 2 years, it was like that. So this entire framework of concession agreement and all that, I think to put it in a nutshell, let us say a project, the ultimate users, ultimately when I say power or long-term utility, right? Roads, power, core infrastructure. I'm not talking about REIT now. Let us say they're willing to pay 10% return to the developer, right? If it is with the government, it will become 5 or 10 will become 5. Private sector involvement, PPP and all that, they will be better, and hopefully that's the whole logic of allowing private sector to come. So the 10% is the base. During the construction period, those days, when you're talking about 15, 20 years back, the volatility around the project IRR used to be something like 7%. So either you 10 करके सोचते हो, वो 17-18 हो सकता है, but 2-3 भी होएगा. Right? And that's the level of risk which was there during earlier, before the construction period, before the InvIT REIT framework, SEBI, all of that the sector got cleaned up completely. Now, that is at the pre-construction phase. Post-construction, chalu hone ke baad mein, maybe the 10 is between 4%, either 4 or +4 or -4. This is during the operational period. It is obviously that 8% has become 4% during operation. Now, that is not acceptable, because 10 करके सोच के जाएंगे, आप 1% बनाओगे, debt का भी नहीं दे पाएगे. You can't pay the debt holders also. If you have project IRR is 8%, you can't pay the debt holder. You won't have any money to pay the debt holder, right? So that volatility around this pre-construction and post-construction risks, right, has got addressed through concession agreements, legal framework, clauses, lots of things over a long period of time. When we were in the infrastructure development, we used to have a company called IDPL. This was not there. We were in that earlier period where maximum risks were there. And 3-4 project mein you get into difficulty, you are basically wiped out, right? So that environment has changed except in the last 8 to 9, 10 years. It has changed significantly. So this is in the developmental stage. And they also created a platform. Like developers always had problem in recycling assets. They couldn't sell the assets to anybody. Kitni saal rakhenge? I mean, equity release ka to scene hi nahi hai, right? Nobody will buy the equity of the project which is there. So they created that REIT platform, InvIT platform, so that developer is able to manage something, he is able to sell something, right? He is able to sell 30, 40, 50% of the assets, and he is able to go to the new assets. And this long-term asset, which is the 10% IRR, if the volatility is reduced now because of the way the government runs its process, let it be in multiple sectors. If you look at, see, even renewable energy, AP, we had a challenge, they said they will not pay, right? I mean, they had some, but 6 mahina, 8 mahina, 1 saal mein nikal gaya. As long as you plan for 1 year delay at a portfolio level, it's taken care of. Single project you may have suffer, but if you have a portfolio, it doesn't. So I'm saying a lot of changes have happened. So our experience is the environment has got cleaned up, both for the developer environment, investor environment in the InvIT and REIT. SEBI has played a fantastic job. They have come with a very good framework. So the sector is a lot cleaner now. And the only challenge is that if people say, somebody will say, REIT InvIT में 100 रुपया में डाला, अभी 150 हो गया. So the government or somebody should not end up thinking, oh, 100 था, अभी 150 हो गया. And maybe the developers are making too much of money or somebody else is making too much of money and come with tighten the process. As long as you don't have all of that process. Because ultimately it is only 10%, 9.5-10% project IRR. ये 12 होता है, मतलब basically you will be in a smaller range because the volatility is reduced. So you cannot have increase in volatility in all this framework as we go forward. So my sense is that it has changed significantly for the better. So there is a reasonable condition under which we are able to visualize that 10-20 times. There is a serious possibility of thinking about it. Like he was mentioning data center, just the data center itself in US, new data center, their power demand is going to go up by 40%, 35-40%. New power development in US only is going to be 40%. इंडिया में भी रिन्यूएबल एनर्जी ठीक है, न्यूक्लियर भी करने का, ये बहुत सारा चीज़ करना है. ऐसा नहीं कि एक सेक्टर एक ही चलेगी, बहुत सारा घोड़ा है, बहुत सारा जगह पे दौड़ेगी. So it's, I think once it is changed. As long as you feel, if you are an investor in InvIT, you have to take a view this that regulatory framework, that environment for the developer, investor, rule of law broadly will remain. And nobody will crib saying that uska 1 rupee extra paisa ban raha hai. Because if you had the money to do it, you should do it. And the right way to do all this is you create that. See, today, let's say take the example of NHA, 10,000 kilometers of roads they can do, right? If they go fast and say, no, I will not do 10,000, I will do 20,000 roads for the next 10 years, so that you have to think like that and scale up the speed, not like, 10 ka 10.5 karenge, they will say I can finance that extra 500 through marginal debt. So मैं extra क्यों देना है? That is not that's not the point. By doing it well, you have to create that productivity improvement in the economy, take the GDP itself off, create lot of value for listed companies and other people through infrastructure and REIT and development. Development will happen only if you think like that. Not like, it has to be a CEO thinking. It can't be a CFO thinking, saying that marginally मेरे को 5 basis point extra कम कर लो, ज़्यादा कर लो. You have to have a leap of faith. If India has to go to be like that, I want India to be 5 times, 10 times the size of this and have some 20% of the world GDP in the next 25 years. Innovate, and spend a lot of money on infrastructure development. And penny wise pound foolish काम नहीं करना है. You ought to have a heart. ये सब नहीं करेंगे तो GDP infrastructure नहीं आएगी. You will always be cribber. You will say India से हम, China से हम better है, Singapore, Sri Lanka से better है, Maldives से better है. We'll keep Nepal से better है. We'll keep talking about that. If you want to be in that scale, this is how China has thought about it. This is how US has thought about it 100 years back. You also have to think like that.
Thank you, sir. That's very. Ramesh, turning to you, I think these global capability centers have been a big sort of success for India, and I think that's been one of the tailwinds that's helped the REIT industry as well. In addition, you also, Govindan sir spoke about data centers. How do you see these two factors playing out for the REIT industry, and how do managers now have to think differently because of these factors?
Govindan sir said we need to be better than Nepal and Sri Lanka, but in the office asset class today, India is the #1 office market in the world. In terms of net absorption, more office was absorbed in India, which is demand, than even US and China last year. And why is this happening? It's global capability centers who are driving that demand. Today, we have close to 1,900 global capability centers in India. This number is expected to go to around 2,500. Today, around 300 million square feet office space is already occupied by global capability centers. This is expected to, in the next 4-5 years, go to around 540 million square feet. Simple, commonsensical things why India has become the global destination for GCCs. Our talent cost is still around 1/10. Our real estate cost is around 1/8. Our overall cost is still only around 20% of what it'll cost if you want to set up in US. I was looking at how much does it cost to build an office building in New York versus how much does it cost to build an office building in India. It's around $60 versus $500. Now, that kind of things are not going to go off, even if tomorrow there is a little bit of tariff, that's not going to impact. So India's that competitive advantage continue. When we started our careers, we used to call it call centers, remote processing centers, back office, all that. But today, you look at some of the largest banks in the world, largest pharma companies, engineering companies, what they call is innovation and transformation hubs. So GCCs have become that, doing the highest end of high-end work in the country. So that's the GCCs today. Demand is around 40% of all office space lease. We have been big beneficiaries of that. Today, 55% of our office portfolio is global capability centers. Last year, same time, we were doing 2 buildings, a 1 million square feet building in Pune and a 1.5 million square feet under construction in Hyderabad. Both have actually been taken by 1 GCC each. So 1 million square feet, 1 company, 1 deal, and 1.5 million square feet, 1 company, 1 deal. So that's the kind of deals happening in the market. Coming to data centers, I think sky is the limit. Today we have only 1.3 gigawatt capacity in the country. All of us would have read about how Reliance, Adani, Microsoft, Meta, everybody is creating huge capacities in the country. India needs a lot more data centers. Like I spoke about how creating an office or talent or real estate is cheaper. Even creating a data center in India is only around 35 to 40% the cost of creating a data center in a big market like US. There's massive amount of investments happening as we talk. At least 5-6 gigawatt is under planning or under construction in the country. And again, we've been big beneficiaries of that. Navi Mumbai, and Mumbai today is 50 to 60% of the data center capacity in the country. And we already have 5 data centers in our portfolio, the only REIT with a data center in our portfolio. And we want to see, we have 100 acres which we have developed, but there are pockets in those 100 acres where we can look at further data center development. So we believe all this data centers, because the leases are long, they sign 20 to 30-year leases. For us, it's also de-risking, because when you have 63 office buildings, having 5 data center buildings is good. And also from a portfolio perspective, if tomorrow something goes wrong with the office market, there's always something happening on the data center market. So both 2 big trends in the market, GCCs and data centers.
Great. Gaurav,
I think you spoke a bit about the renewable energy and the energy transition ecosystem in India. But you also mentioned the fact that currently very little of that comes into InvITs. How do you see this evolving? Which parts of this ecosystem potentially could come into InvITs in the future?
So I think solar and transmission is already there. Obviously, solar has and transmission both have established a certain amount of stability in terms of how the cash flow generation work and also how distribution to unit holders will work over a period of time. I think that is fairly established. New sectors and new technologies that can come, actually it's a function of what kind of supply is there in the market today. What's happening is if you look at how the energy capacity has or generation capacity has grown in the country today, it's basically following the economics of cost of generation. So if you go back to, let's say, 2010, you actually had hardly any solar and hardly any wind. And over the last 15 years, you've seen a reduction of cost primarily for solar. It's almost come down by almost 90% over the last 15 odd years. Now, what is happening over the last 3-4 years, we're seeing a similar trend with battery storage. We're seeing almost a 40 to 50% reduction happening as far as battery prices are concerned, because of which a solar plus battery is giving a firm power to the grid, which is actually as equivalent to coming up with a thermal power station fueled by coal, and you can then dispatch power whenever you need. Now, with this equivalence possibly happening in most places, you will see a lot of solar plus battery coming on board and supplying energy to the grid. Now, all of that, when that comes in, I think given the certainty of generation and hence of cash flows, I feel all of those assets should also become inevitable. But a connected point to this is, I think, apart from the fact that, Krishnan, you mentioned about the fact that we yield investors and we are supplying yield to our investors, but I think most important thing we're also doing is to provide this operational capability. I think all the development that's happening, and it's a very focused, complicated activity. And what happens is that the focus actually is to make sure that there's no cost overrun, time overrun, approvals, land acquisition, but not a lot of focus on operations, right? And hence, I think InvITs and REITs are actually performing that role in the country to create that operational ecosystem of excellence so that we can operate these assets as we go along.
No, very, very valid point. I think, but I just want to pick off what you said in terms of yield, and probably Rajiv. So I think what we've seen is that while all the InvITs have been yielding cash flows, a lot of them have been growing very fast as well, right? And there is potentially this trade-off between yield and growth. As an investor, how do you look at this trade-off?
In fact, when you look at how some of these REITs, more so the InvITs and REITs have done over the last, say, a year or so, a large part of the appreciation is again market, right, and the market price changes, right? It's more than what the underlying distribution is, much more than what the growth in the underlying asset is. So there is a lot of, I would say, incremental interest that has clearly come in from a slightly wider set of investors. Possibly some of the tax changes in the previous budget could have led to this incremental interest coming in from, I would say, the retail and the HNI segment. So clearly, when you look back, a large part of recent price appreciation is clearly, I mean, I'm not saying froth, but to some extent, there is a bit of exuberance clearly there. But as an investor, the first 2 points are very, very essential for us, right? The distribution plus what is the growth that you foresee over the, over the future. So I think for us, that clearly remains a very important consideration when you're looking at it. But yes, to the extent that the market depth is improving, it sort of creates that secondary liquidity. I mean, investors like us, typically, we would clearly require ongoing liquidity. So I think we would appreciate that as well, but that's not really a great consideration in our, when we look at some of these asset classes.
Understood. Govind sir, I think Rajiv spoke about the fact that there are new investors coming in. How do we increase the breadth of investors, and how do we therefore solve for liquidity in this segment? Is there any ideas? You've been in the capital markets.
I think the long-term investor, provident funds and EPFO and all of them have to come, insurance companies have to come. They are coming, but very marginal, right? One is they don't know about the product, right? Enough understanding is not there, right? And वो equity है, debt है, बीच में है, वो confusion बहुत है, many of them. And conferences like today and whatever, I think there was a national conference last week in Delhi. Regularly करना होगा so that investor has got some understanding about what is happening, and the institutions, long-term institutions, the provident fund and pension funds, 30-year का cash flow है, उन्हीं लोगों का है. मैं यही बोल रहा, actually sometimes I feel bad. Most of the benefit in the last 15-20 years on the units and returns and all that has gone to foreign pension funds. It is not with the Indian pension funds. I can't understand why they didn't participate or why they should not be participating. They should be participating strongly. They will say, okay, I'll participate, but only in government, central government-led institutions and all of that. So we'll have to get that education thing going. And that is one main thing to be done, understand this. And a road sector is stabilized. Transmission line is sort of, people have an idea about how it works. Solar, it just started, but it is not scaled up yet. Thermal तो आई नहीं है अभी तक. Thermal तो अभी GPs and LPs, they say thermal तो भागो. Though in Europe, coal को green color paint करके, green power करके, मतलब they are spending it because of energy shortage. But यहाँ, some of those things are there. So our institutions have to step up. I think HNIs understand this by slightly better. Institutions need to understand, government institutions and even private institutions. Provident fund, if they run the way the government will run, just mimic what the government is doing, then it's not going to work out. So you will have to do that. And even, in fact, just for example, even our IT companies in L&T invest in InvITs, right? But it's very rare because IT company, every IT company has to do what other IT company only is doing, which means government security, 6 महीना का duration है, तो 6 महीना ही करना पड़ता है. Otherwise, so that is the way it works. We have tried to change it, but the investor base will have to go. Institutional level, I think people, HNIs understand this a lot better, but a supply also has to come. अभी supply भी नहीं है, मतलब रुका हुआ है. It's like slow, too slow.
Thank you so much. I think we've run out of time, but I think this is a very good note to probably end this panel. Clearly, we've had a wonderful set of comments people have made. I think we've got a target of 300 lakh crores, which I'm sure this everybody on this table will remember. But I think there is a lot of positivity that we see across this from everybody in this panel. We've seen a good amount of success, and I think the future looks quite bright as far as InvITs and REITs are concerned. Yeah. Thank you so much.
Thank you very much. Please stay with us on the dais. I'm going to request for trust group representatives to please join us on stage. Darshan Ringshia and Sandeep Baglaji, please join us on stage to present tokens of our appreciation to the Honorable Moderator and the panelists of this session. Good evening, are you please? We'd like to say thank you to Mr. Vinay Sekar, Chief Executive Officer, Cube Highways Trust, who moderated this session you just witnessed. Thank you very much to Mr. Ramesh Nair, Mr. R. Govindan, Mr. Rajiv Radhakrishnan, Mr. Gaurav Malhotra, Mr. Krishnan Iyer. Thank you all for taking the time out and joining us here at IDCMS for this panel. And I request you all to come together for a photograph. The last but one panel of the day, and it was still full of energy, still full of value, input, discussions, debates, and lots of takeaway in this panel. We're now moving into a very special session, but first this photograph. nice little memory for us at the Trust Group to have you all with us, grace the stage, and add great value to the summit. Thank you all. Thank you. Once again, I request you all to my left, near the entry of the main function hall, to come forward, take your seats. This next session is indeed very special. We'd like to have you all seated for it. And thank you one last time. Ladies and gentlemen, it's truly a privilege to invite this lady on stage, really. Ms. Rekha Jhunjhunwala is the chairperson of Rare Enterprises. She's skillfully continuing the legacy of her late husband, the legendary investor Rakesh Jhunjhunwala. She oversees one of India's most significant equity portfolios, managing the family's investments and philanthropic initiatives. A discerning and highly respected investor in her own right, Ms. Rekha Jhunjhunwala is celebrated for her long-term conviction in quality businesses, mirroring the disciplined value investing approach established by the family. Ms. Jhunjhunwala maintains a strong commitment to social causes, upholding the family's philanthropic tradition. She serves on the board of trustees at Sankara Eye Foundation, India, balancing strategic financial stewardship with a clear commitment to healthcare and education. As I said, it is truly a privilege to welcome her on stage. Please, ladies and gentlemen, put your hands together. We have Ms. Rekha Jhunjhunwala on IDCMS 2025 stage. And ladies and gentlemen, to help unfold further this very special session at IDCMS 2025, may I please invite on stage Nipa Sheth and Utpal Sheth.
या तो सौदा मत करो या रिग्रेट मत करो. There are no regrets in life. There are only learnings. Markets teach you giving. Markets teach you patience. Markets teach you can always be called. Markets teach you boldness. Truly, markets mirror life. Right? They humiliate you. They teach you. Never forget your word is your bond. Be fearless. Right? And may God bless you, for He is the only blesser.
in conviction, unshaken in belief. From our hearts, let's put our hands together for the legendary, iconic, the great Rakesh Jhunjhunwala. May I please request Nipa and Utpal ji to please present Rekha ji with a token of our deepest affection and respect.
Friends, I can tell you that trust would not have been Trust Group had it not been for Rakesh ji and for Bhabhi ji. So, heartfelt thank you to both of them.
I request all the three of you to come together for a special picture, and then we'll take the proceedings forward. And that, ladies and gentlemen, is a beautiful tradition at IDCMS that I have seen since I've begun hosting it last few years. It every year touches my heart and instills my faith in relationships that continue if they're real and authentic. Moving on to the next session, ladies and gentlemen. In the past 1 year, particularly, Indian equities have underperformed relative to peers amid growth slowdown and higher valuation compared to other economies. The sentiment remains somewhat sour with the impending US-India trade deal, but with the fiscal, monetary and regulatory policy support this year, could 2026 be a better year for the Indian economy and also equities, particularly with domestic investors continuing to be dominant and bullish? What's the buzz around AI-related trade? And how does India fare in this context? We explore this and a lot more in this session on equity markets between uncertainty and opportunity. And to lead us through this conversation, it's a delight to welcome once again on stage Mr. Utpal Sheth, founder and mentor, Trust Group. He is, someone who has made an invaluable contribution, of course, to the growth of the Trust Group, an institutionalized, multi-line and multi-asset financial services platform with leadership in the debt capital markets and a differentiated advisory, asset and wealth management platform. He was the senior partner and CEO of Rare Enterprises, a multi-billion-dollar proprietary asset management firm based in India. Mr. Sheth, focus is dedicated to long-term investment in both public and private markets, emphasizing rigorous portfolio construction and risk management. With a comprehensive career spanning over 30 years in the capital markets across various reputed Indian financial firms, he possesses extensive experience in critical corporate finance areas, including investment management, fundraising, mergers and acquisitions, corporate buybacks, and high-level corporate advisory. Sir, I'd request you to take your seats. I have a few more lines to go. He regularly engages with investee companies to actively enhance shareholder value by emphasizing and implementing sustainable value drivers. Mr. Utpal Sheth, dear friends, is a recognized thought leader and contributes significantly to the financial ecosystem this side of the world. He currently serves as the co-chair of the Capital Markets Committee of FICCI and is a frequent visiting speaker at various educational institutions. He is
a chartered financial analyst from ICFAI Hyderabad, and a cost and works accountant from the Institute of Cost and Works Accountants of India. He also holds a bachelor's degree in commerce from the Mumbai University. Ladies and gentlemen, please welcome him as the moderator of this last session. And the esteemed speakers, the panelists of this session are Mr. Navneet Munot, Managing Director and CEO, HDFC AMC. Zordar taaliyon ke saath is our last panel. Let's welcome this power pack panel on stage. Mr. Navneet Munot walking up as I speak. Good evening and a very warm welcome. Mr. Manas Tandam, Partner and Co-Head of the Private Equity Goods and Products Partners Group. Good evening and a very warm welcome to you. Aye, please. Mr. Mihir Vora, Chief Investment Officer, Trust AMC. Good evening. Aye, please, sir. Join us on stage. And ladies and gentlemen, last but not the least, Mr. Kunal Shroff, Managing Partner, Chris Capital. Good evening and a very warm welcome to you. I hand over this last session to the able moderator, Mr. Utpal Sheth. Take it on, sir.
Good evening, friends. We are all here today, and this is an exciting time for both equity markets as well as debt markets. However, let's take a wider perspective of all investment options and alternatives available to investors today. It's not just equity and debt. It is public equity, private equity, performing credit, alternate investments, commodities, and so on. It's all part of one continuum. Today, for the first time in our equity panel, we have a combination of both private equity investors as well as public equity investors. We are at a juncture where we have a new high, but किसी के गाल पे लाली नहीं है. Index is up, but portfolio is down. Not a great state to be in. This has been a year where the relative performance of Indian equities compared to emerging equities as well as the developed markets has been quite poor. The rupee has not behaved well last year. In dollar terms, Indian equities have really underperformed. 1 year ago, there were various concerns. Valuations are high, growth is low, and then in between, we had the tariff shock, and so on. However, in the midst of challenges and crisis lies opportunity. And that is the topic of our discussion today. Opportunity and uncertainty. I was telling you about how there are different asset class options for investors. Let us now look at it from the perspective of corporates as well. Corporates on their balance sheet can take equities, can take debt, can take structured debt, and so on. In the last few years, we've seen buybacks being eliminated because of the changes in the taxation on buybacks. We now know that the taxation on dividends is very high. Indian corporate balance sheets have the lowest leverage in the last 40 years, probably the highest cash as a percentage of the balance sheet in the last 40 years. This is a great time for Indian corporates. Corporate tax rates are low, interest rates are low, credit spreads are low, and so on. What is not high? Growth is not high. Private capex is not high, and so on. So I would request first that we talk about a few of the challenges and uncertainties that the markets and the economy are facing. And I'll request Navneet to kick off with that.
Thank you, Utpal. Great to be here, and many compliments again. Every year I say the same to you and Nipa and the entire trust family for putting this together. Being a bond trader and bond investor for a good part of my life, it feels so good to see a debt market conference this big. So compliments to you. And nice of him, he invited me for the morning panel also. I could make it on the bond side, but so I'll start with a joke, evening time. Anybody knows here, and a lot of my peers are here from the bond side, what is the difference between a bond and a bond trader? Bond matures, Sandeep ne bola. So it's very interesting, and we were discussing. I'll take 1 minute. I could make it in morning. So we were talking about the rising volumes on the retail side in the bond market. Of course, very tiny still when you look at the size of the market and the way equity markets have grown in India. But I started as a bond trader. Used to give two-way in like many bonds, right from Arvind Mills, ACC to Indian Rayon, Hindalco, Grasim. Those days SR Gujarat and like Tata Steel, Tata Motors, so on and so forth. From there, like we have seen where there are only few of the bonds get traded, but I hope that over a period of time, this market will also become as big, vibrant, deep and liquid as the equity market. आपने वो राकेश जी के glimpses दिखाए from the previous conference, and he used the word like be fearless. You mentioned about all the uncertainties. I would say, he would have been like so happy seeing the GDP number just now that India can grow at 8.2%. So you can clap for him and what India is doing again. So I would say like this, that we are in a country, we are so lucky, where a growth is higher than China, inflation is lower than Japan, current account deficit, fiscal deficit, public debt as a percentage of GDP lower than United States, and foreign exchange reserves higher than most of the other parts of the world, most of the other, even the developed markets. We are lucky to be here. There's like political stability, social stability, macroeconomic stability, and financial stability. In one breath, you cannot say all four for many other countries in the world. Of course, there are challenges, but I'll rather focus on, I think, the opportunities which are in front of us. I think last few months, policymakers have done a great job. I think there is a press conference. There was a press conference, I think, at 5. I don't know what RBI has announced, but in last few months, I think they have been very, very bold. I think we have done only twice in this century, last 25 years, a 50 basis point rate cut. One was global financial crisis and one was the pandemic. And then the third time we have seen this. Only twice we have seen a 100 basis point rate cut in last CRR cut, which we have seen now, and many other things that RBI has done. So is the case with the government, and I feel like very optimistic. You said किसी के चेहरे पे लाली नहीं है, but I travel across the country. I go to hinterland. मैं पहली बार देखा है मैंने, after this, maybe around this whole Dashara Diwali, it could be because of the GST, it could be because of welfare spending by the states, it could be because of maybe the income tax cut and the liquidity injection and all, थोड़ा काफ़ी टाइम के बाद मेरे को खुशहाली जरूर दिखी है. I think if you go to the main street, there is definitely, I think, a sense of खुशहाली, and I feel very optimistic. Globally, I'll just take 2 more minutes. I think globally there is a greed trade and there is a fear trade. The greed trade is like investing in AI. This is the biggest promise for humanity, and that's why you see the US, Korea, Japan, Taiwan, China, these 4 or 5 markets where all the money is going. Or the fear trade, which is like this big challenge in the world. That's why the gold, silver, Bitcoin, all of them doing well. While I think India has not been on that side, maybe I have more views on how this time could be different than the 99, 2000 and 2006-07 cycle for India relative to the other markets. But I think at some point in time, I won't say, because the last leg is always very difficult to predict, but at any point in time there is a reversal in trade. I'm sure you are going to see a big shift towards India from the global investors, while the domestic investors continue to keep their faith.
Thank you, Navneet. You know, they say east is east, west is west, and the twain shall never meet. Public equity investing and private equity investing used to be like that, but no longer. I think they are both now joined at the hip. The public markets are providing exits that private equity investors have not seen before. And more importantly, it's one of the few markets globally which is providing fabulous private equity exits. Therefore, I would like to request Kunal to share his perspective of how private equity investors have a view on the macro, the fundraising, the exits, and so on. But let me share one statistic with you. This year, all offerings, whether through IPO or block deals or any other such offerings, which include offer for sale as well as fundraising, has exceeded 5.4 lakh crores, of which 65% is offer for sale. And offer for sale is primarily only by promoters and by private equity investors. Nowadays, many Indian high net worth investors have also become very active private equity investors. This is a fabulous number. I can share with you that between the year 2000 and 2010, this number, which is 65% today, was between 10 and 15% at that time. So we've come a long way. Kunal, over to you.
Sure. Thanks, Utpal, again for having me here, and thank you, everybody. I know this is the last session. Hopefully, it's interesting for people who are mainly coming from the debt perspective. Utpal, I'll answer a few other questions as well, just to provide the backdrop. So as Chris Capital, we are known for private equity. We manage about 8 billion of active AUM, but we also have a public market fund, which we started 5 years ago. So we have a little view on that as well, not anywhere close to what Navneet will have. So I would say a few things on the public side first. Yes, listening to Navneet, I've gotten more bullish on India myself. But it is true. If you ask the question, how do you de-risk yourself? At least my view is, on the equity side, the best way to de-risk is focus on high return on capital businesses and have a long-term view, because compounding will take care of mistakes. Now, investing in debt may not give you that, so you may think of debt as less risky, equity as riskier, but played the right way, equity can actually deliver really good compounding and wealth creation without the kind of risks that you think volatility brings to the table. So we did this analysis where we said 25-year history of Indian stock market, US stock market, all the major countries. What has been the compounding? And while people do point-to-point analysis, we said point-to-point can mess it up depending on whether you start before GFC, after GFC, things like that. So let's do 7-year rolling. So if you had a 7-year horizon, and you invested at any day of the year and held it for 7 years, what is the return you'll make, and average those returns. The only two markets that stood out in US dollar terms were US and India. And depending on whether you took a 20-year history or a 25-year history, US was first, India was second, or India was first and US was second. All the other countries paled in comparison. China had growth but didn't have profitability, and therefore it didn't have the market returns. India had growth along with profitability, and that's allowed the compounding. Now, when you look at India today, you may say, oh, at this level, how will I keep seeing it? But there's so much growth, so much under-penetration still available. And that makes me feel good that we are in this market, both for our public fund as well as on the private equity fund. On the private equity fund, I would say the industry is still at that nascent stage. Annually, it's about $40 billion, largely by global firms like Manas, who have captured much more of the market share. But we are seeing the change. We are seeing interest from domestic investors to say, look, I'll do a little bit in alternative assets. And you're seeing some institutions also really embracing it. So we expect the liquidity to invest in private equity as well as to exit private equity increasing quite a bit over the next decade. And I think that is another cushion that we would have. You mentioned exits. So yes, exits have picked up. There's been a lot of return of capital from private equity over the last 3 years particularly. But it's still very small relative to the big base. And what's more gratifying is if you look at that trajectory where OFS was 10%, is now 60%, I think it'll also marry with domestic investors ruling the market versus foreign investors ruling the market. I remember 15 years ago when we would take a company public, you would have to do your Asia roadshow, London roadshow, hope that the foreign investors are very interested in you. And that was what made the book. Today, the book is made in India. You add the international roadshow just to get extra demand and maybe better pricing, which is very different from 10 years ago. And when there are geopolitical issues, I mean, we've had some in the last year, you would expect normally market reactions, but market has taken everything in stride. So you can argue that market's overvalued today, but the best way to de-risk it is to have a longer term horizon. And we've seen that play out in the last 25 years at least.
Thank you, Kunal. As I was sharing with you earlier, uncertainty is there, challenges are there, but there is opportunity as well. As Bhaiya or Rakeshji used to say, the greatest risk of investing in India is not investing in India. So in that context, I will now request Mihir to talk about the public market opportunities that he is seeing arising from this volatility and dislocations.
Thank you, Utpal. Good evening, everybody. Happy to be here. You know, as a as a young fund house, you know, it's always exciting to see the opportunity out there. But having come from an institutional background, you know, this makes it even more interesting. You know, we've been launching funds and we've been seeing the investor response. And the one thing that I can say is that like a small fund house growing very rapidly, when you go out and meet companies in the small cap space, in the micro cap space, in the mid cap space, the kind of bullishness that you get to see, the kind of energy that you get to see in those companies is just something different, you know. I mean, we can keep talking about macro and, you know, GDP growth and cycles, etc. But there are at least 500 to 600 companies with a market cap of more than 2,000 crores listed already, which are in the high growth space, you know. And many of these companies have nothing to do with what's happening in the next quarter in India or next year in India. I mean, there are people in Saurashtra. They have capacities in casting, for example, which are probably in the top 10 in the world and doing complex components and growing at a crazy rate, and they are getting orders from all over the world, 80% exports, you know. People supplying equipment, say for example, in the Apple ecosystem now in India, right, which is growing so rapidly. I mean, their order book is like 10x what it used to be 5 years ago or 2 years ago. And they have nothing to do with the growth of India. So the macro is important, but the micro is, I think, getting very, very strong. And, you know, there's few things that we probably may have missed in the last couple of weeks. The labor reforms, the ease of doing business proposals that the government has, gotten around to. I think these are some of the micro steps which are going to enable growth even further. And you mentioned about the private sector capex cycle not happening. My feeling is that you probably will not hear those billion-dollar fertilizer plants or petrochem plants being set up, but there will be hundreds of these, smaller investments which will go under the radar, but which will keep adding to the growth in the country. So I think they are very exciting times, irrespective of the macro.
Thank you, Mihir. I would also request Manas to now share with us how they look at this balance of uncertainty and opportunity from a private equity perspective, and especially from a global private equity perspective. I would add one more dimension to that, and which is that public market investing is essentially minority investing. But some of the private equity funds are actually buyout specialists. Manas has done quite a few buyout deals in India. So I would request Manas to add the buyout context as well. We are now seeing so many IPOs where the promoters are effectively the private equity funds, or the private equity funds are the largest shareholder. They are also the largest selling shareholders, and so on. So over to you, Manas.
Thank you, Utpal Bhai, and it's just such a pleasure to be here. Thank you for having us here. And you started the session early on. You said the East is East, the West is West, the twain will never meet, and you mentioned that in the context of private equity and public equity. And I think globally, if you think about the evolution of the industry, our industry, the private equity industry, actually it's not possible without the debt capital markets, right? So it's actually such a big part of our industry globally, and hopefully it'll become a very big part of what we do in India. Because frankly, control investing, which is a kind of investing we do, just wouldn't be possible without a very robust and deep and very kind of engaged debt capital market. So it's been a big part of that. When you talk about opportunity in the face of challenges, I think there are kind of three aspects to it, right? The first one is choosing the right business, right? And it's about being thematic. It's about saying where do you want to hunt. It's about saying what sectors and what kind of growth characteristics you're looking for. But eventually, my experience in India in the last 18, 19 years is every time, there are three things that almost never fail you, right? It's buying a company or a business with good kind of governance practices, growth, and good cash generation or return on capital. And every time we've bought something that has that trifecta, it's worked out. And every time we've compromised on one of the three, we've actually struggled and paid a price. The second aspect of finding opportunity in the face of challenges, especially as a control investor, is in some ways backing yourself to say we'll be able to get the best management team around the table. We'll be able to get the best experts globally and make things really happen, right? Because, and many of us have done, been around the block where you're dependent on someone else to always execute. And frankly, just being able to back yourself and really back yourself and say, we are going to make these changes happen. We are going to execute to this plan really helps when you're looking for, especially when you're facing hard situations. And I would say the third place where we've gained a lot from challenges is in the face of challenges, when you out-execute, you build a really world-class business. And that's the opportunity that we have in India. And that's the opportunity, frankly, for me as a patriotic Indian who's trying to build businesses in India. That is the real opportunity to be able to say 15 years later that here are 5, 6, 7 companies which are board governed, truly professionally run, and scaled business, which are world-class businesses that we've been able to build. And to me, that's the opportunity set that I look forward to as a controlled private equity investor over the next few years.
Thank you for sharing that, Manas. let me add another dimension to this. Public market investing, especially mutual funds or even HNIs or proprietary investors, are fundamentally, or even investing through provident funds, pension funds, which channelize their assets into equity assets, ETFs, and so on, all represent effectively perpetual capital. There is no fixed date to pay it out. However, private equity funds all have a fund life. There is a fixed date to pay it out. There can be extensions, but at the end of the day, that capital is to be returned. That returned capital may come back in your next round, but it still has to be returned first. How does this reflect in the difference in the way that public equity funds are invested and managed, and in the way that private equity funds are invested and managed? I'll request Kunal to start on the private equity side.
Sure. So I think there are pros and cons. I think for the equity mutual funds, you have to deal with daily liquidity, right? So you need to make sure you're managing for that. In private equity, we have the luxury of the lockup. So typically a fund has a 10-year life, and then you can get extensions beyond that. So when we are investing, most of us will invest in the first 5 years, which is the investment period, and you will harvest in the next 5 years. So whenever you're investing, you automatically think of a 5 to 7 year horizon. And that allows you to sometimes avoid the basic mistakes and also do a lot more due diligence before you get in. Because one of the challenges we have is when we've invested in a company, whether it's a control buyout or a minority, it's not that we can tomorrow wake up and say, let's sell this, let's get out, because it's illiquid by design. So we end up doing a lot more analysis pre-deal to understand the business, the industry dynamics, the entrepreneur, the alignment. And we spend a lot of iterations doing that. Increasingly, we also spend a lot of time identifying value creation levers. What can we do with the asset, whether we are a small shareholder or a large shareholder, to improve revenue growth, to improve margins, to do better capital allocation. So what you end up exiting 5, 7 years is an enhanced version of the investment that you've made, right? So for us, the process is a lot more, let's not make a mistake, because in each private equity fund, you'll typically have 10, 15 companies. So each company has to matter. Now, you will also benefit in some ways. And I'll give you an old example of ours, where private equity used to do a lot of pipes. We used to do pipes as well. Now we don't, because the market has matured. But when we did some pipes, I remember this was what, pre-GFC, so 17, 18 years ago. And we looked at the IT sector. And we said, you know what, all the private deals we're looking at in IT are looking more expensive than some public deals available. So let's go ahead and do a pipe. Let's invest in the public market. And we invested in some tier 1 IT service companies. And when we did the research, valuation made sense. We even spoke to public market analysts and public market investors, and they were all negative. They're like, rupees at 39, this business model is broken, we don't think this is going to make sense. Year over year, earnings growth is going to be poor. So we heard all of that. And we said, we understand it's negative right now, but just paint me a base case of 3 years or 5 years. Oh, 3 years, 5 years mein to ho jayega sab, right? And we said, okay, that's good. We're happy being contrarian and wrong in the short run, and we'll hopefully do well. And those deals ended up delivering 25+% IRRs for us at a time when the index did 0 on the public side. So having that long-term horizon sometimes allows you to be contrarian and be more patient. Of course, not every deal like this has worked out, but it gives you the chance to do well. So I think that's the big difference. When it comes to the investor, though, I think there's a lot more education that's still needed. We raised our 10th fund recently in private equity, which is the first time we took money from domestic investors. And we just wanted to dip our toe in and see what it's like. And we'll find out over the next 5 years how it is. But we were at pains to explain to people this money is stuck for 10 years. You know, we will come to you with Fund 11 before we return any money in Fund 10. I think those institutions get it, but for family offices, individuals, there's still a bunch of education that still needs to be done there.
Right. Thank you
I might
for
just
sharing that, Kunal.
add something very quickly, Utpal, on this. I really envy perpetual capital as much as we have 10-year lockups. Last week on Monday, Lenskart went public. Ronnie Screwvala and I had invested in Lenskart at around the same time. We exited with 4x after 5 years. He's sitting on 70x. So when you find an awesome opportunity, having that perpetual capital and having that source of just not having that pressure to exit is such a luxury if it's used with judgment.
Thank you for that perspective, Manas. I'll now request Navneet to share how this is very different when you're managing perpetual capital in a mutual fund construct. And prior to HDFC Mutual Fund, Navneet was also with SBI Mutual Fund. And so SBI Mutual Fund also manages a lot of EPF and NPS money, right? Through ETFs. So Navneet, if you can share that perspective.
No, sure. So historically, there has been a perception that mutual funds are like short-term traders, so they are always worried about the daily liquidity, daily NAV. Their perspective is for short to medium term, while private equity, these are like long-term strategic investors. The more interaction, I feel like we are a perpetual investor. Bulk of the time of our team goes in like if they can find a company, a business, a management where they can own forever. And we own like large number of companies where our stake would be 5, 7, 8, 9%. We are constrained at like 10% of the issuer capital. I hope at some stage, and I'm saying it with responsibility, I hope at some stage a regulator actually reviews it that can we own more than 10%? Why not 15% or so to change that? And I hope it will happen. And I'll give you one number. HDFC AMC, we manage more than 6 lakh crores in equity. 11 years back, the total mutual fund industry owned 2 lakh crores of India's equity. This is the pace at which the industry is growing. And I think this is just the beginning. Over the next 10, 20 years, our ownership of corporate India is only going to go up. And that's why I think more and more of us are thinking of this as genuinely as a perpetual capital. Our interests are completely aligned with the business. That's why we engage constructively, we engage deeply, we look at the governance, we look at what they are doing in the business. And it's, of course, I mean, the daily NAV also brings in a lot of discipline. The daily valuation also brings in another dimension. But from a mindset perspective, we think more and more as a perpetual investor because the fund size will keep growing. If you look at the monthly SIP size of 29,530 crores a month, that goes to $40 billion a year, $40 billion a year. And I have a very strong view that this number is going to be a lot bigger 5 or 10 years down the line. So you can calculate in which direction the ownership of corporate India, in which direction it is moving. You also made an interesting point, or he made that now you are seeing like historically, majority shareholder has been either the government of India or a multinational company or a family promoter. Now you are seeing a different cap structure where a large part is owned by a private equity and venture capital. We also run a fund of fund. We have partnered with 14 GPs and now have investment on the private side as well. And the more I think like over the next 10 or 20 years, the founder will own 5%, 10%, 15%, largest market cap company in the world, NVIDIA, I think Jensen Huang owns some 3.5% or so. You will also have very large companies in India in next 10, 20, 30 years where the founder would be owning a smaller percentage and a larger float would be there in the market, which will be owned by public market investors like us. So I think that's changing. And also one more point I will make that we look at like private or this from a different lens, but I think this is just the continuum, right? In fact, I can add even the credit investors. So whether it's a credit, whether it's private capital or the public capital. They should not be looked at in silos, but like as a capital continuum, and you will see like markets getting more mature. The more I look at India's capital market, the three words come to my mind. I think they're getting more sophisticated, they're getting more integrated, and they're getting more democratized. I was so happy when I heard that Chris Capital is also raising money domestically, and I think you have taken some money, and I'm hearing that from more and more of my friends on the private equity and venture side who historically only made the teachers in Quebec or maybe the pensioners in Europe richer, but over a period of time, I think Indian investors will also participate in the growth pre-public market journey.
Thank you, Navneet. One should also consider that a typical mutual fund will have what? Between 50 and 100 stocks? And a typical PE fund would have 10 to 15 names. So the degree of concentration is different. The ability to embrace volatility is also different. The way they are assessed is also different. A typical PE fund would be assessed on MOIC or something like that, and DPI. But a typical public markets fund would be assessed on relative returns or how much alpha and so on. So I would request Mihir to share some perspective on how the public market side measures things, and then Kunal, you can add on the private equity side.
Sure. So as you mentioned, the way we control the risk of liquidity, because that's what you're worried about, right? That if there's a run on the fund or there's a bunch of redemptions, how do you manage it? So that's typically, as you mentioned, taken care of by diversification. So like the PE funds have 10 to 20 holdings. Public funds typically have 40 to 100 holdings depending on the size, etc. So I think that's taken care of. And what we have also seen is that probably the risk of a run on equity funds is overestimated, because now we have a history of almost 25-30 years of mutual funds in India, and we've seen the worst of crises, whether it was GFC, whether it was COVID. We've never seen a run on equity funds, right? Because I think the exposure of investors to mutual funds as a percentage of their net worth has typically been very low. That's one. And second is that corrections typically have been short and sharp. So by the time people react and absorb the shock, the markets already started recovering. That's been the history for the last 20 to 30 years. So I think that risk of the run on the fund is overestimated, and diversification anyway takes care of it. I think the bigger issue or the bigger challenge for the fund manager is in the performance versus either the peers or the benchmark. And that's where some of the short-termism may creep up in some of the decision making, because daily NAV is just too much under the limelight, too much scrutiny, so to say. But there also we have seen that now with 20 to 30 years of history, funds, fund houses, and fund managers have now begun to clearly articulate their strategies. And investors and distributors are also becoming more and more sophisticated to understand that not all styles, not all fund managers will work under the same conditions. So to that extent, I think that that maturity is appearing in the industry, and I think it's a long way to go now.
Thank you, Mihir. Kunal?
So, private equity gets measured in a different way, but that's also because the client base of private equity funds has also been different. So I mentioned we raised Indian money for the first time, but until then it was only foreign money. And if you look at the 40 billion that gets invested in India, the bulk of it, vast majority of it is foreign money. So unfortunately, we get measured versus absolute and in some ways relative. And you have to fight that, right? So global investors will say, nobody's put a gun to my head to invest in India. If I'm making better returns in the US, why will I come here? So to come all the way to India, pay me for the country risk, pay me for the currency risk, pay me for all of that. all the uncertainty risk. And to be fair, the US historically over the last 5 years has delivered fabulous returns. Very hard for any other country to catch up to it. But the nuance that they miss, and Manas addressed this a little bit, the way it's practiced in the West, leverage plays a very big role. And leverage has allowed companies to amplify their returns pretty significantly, which we don't have. So when you look at our returns, we've been at pains to explain to global investors that I may not have, I may have the risk of being in India, but I don't have the risk of leverage. So we're doing growth buyouts here, we're doing growth investing here, time is on our side, compounding is on our side. We don't get the amplitude on the upside or the amplification on the downside. And there's got to be some value for that. On the other part, we've actually been at pains to describe MOIC and say, look, ultimately you can only make, eat dollars that you make. But because it's very hard for global investors to compare funds, IRR has become the benchmark. Right? That's how the managers get measured for their KRAs. That's how they get rewarded. And so this gets driven at the highest levels. We are a small player in the global mix. And everybody wants to measure it on IRR. We have been surprised when we see most IRRs, even the good IRRs will be in dollar terms, let's say slightly below 20% or around the 20% mark. But you'll see the MOICs, they'll be below 2. Which tells you what? That you're compounding for less than 3 years, even though you talk long term, even though you say 10-year fund and all of that. So we've kept pushing that narrative, but it's a losing narrative. Everybody wants to compare IRR because it's the easier way to compare across the board.
Thank you for that, Kunal. And thank you for bringing up the leverage context for private equity investing. Globally, it is a far greater proportion of their assets. And in India, it is much lower. I remember when Manas, which is Partners Group, and Kedara were doing the Vishal Mega Mart and what was it? Sunbeam Auto.
Yeah, Sunbeam was not us. I think Sunbeam was Kedara.
That was only Kedara. So it was the first time that a private equity fund was taking domestic leverage. Usually, private equity funds only take external leverage. And I can speak about this because it's been so many years. Otherwise, it would have been confidential. And Trust Group partnered with them to raise that domestic leverage. But we haven't seen that take off. We haven't seen domestic PE funds using domestic leverage. And this is probably one of the best quality of domestic leverage possible for Indian lenders. Hopefully that will change. So I'll request Navneet and Manas to talk about it. Navneet more because he's also the largest debt mutual fund in India. And because he was a bond trader earlier. And Manas because he has seen much more of that globally and has used it in India. He's one of the few people who have used it in India.
Sure. So I think, Utpal bhai, there are two aspects to leverage, right? I mean, I remember Nipa and I first met in the context of Vishal in 2017, 2018. And we were raising 800 crores of leverage or Nani Yaad Aa Gayi Thi, right? And I'm talking about what, 7 years ago, right? I mean, Nipa, all the conversations, and then there were some rule changes, and then there was the liquidity crisis, and everything that could go wrong went wrong in those 3 or 4 months, and we were like, we really need this, so it, and honestly, if you think about it from a regulator's perspective, it's one of the safer forms of leverage, right? Because we are not doing it for interest deductibility. We are not doing it to juice returns. We are actually, it's like if you think about lending to a typical Indian group to which most lenders, most banks are very comfortable with lending. And if you think about like the kind of stuff that we are doing where we would be like levered 3 or 4 times EBITDA at most, right? The risk reward profiles actually insanely, in my view, I'm biased, but in my view, the risk reward profile is actually quite a bit tilted in the favor of doing it with private equity, number one. And we are talking about acquisition leverage now. Let's talk about operational leverage for our portfolio companies for a second, right? When we bought a housing finance business in 2016, at the time, private equity was a first-time promoter of a lending business in India. We had the CRISIL page on our favorites, the ratings page, because we used to get a call that we will do 3 or 4 rating downgrades because the promoter is gone, right? So we had to almost take the rating agencies, take the lenders. I personally met 17 or 18 lenders at the time, including your team at HDFC, right? Just to give people credit, give people that comfort that, you know, private equity as a promoter is, you know, a credit-worthy promoter, is a promoter you can kind of bank on, right? And I think there a lot of progress has been made, Utpal Bhai, on the operating side. A lot of progress has been made, I mean, in the last 10 years. On the acquisition financing side, between the regulatory reform that is required and the depth of the market and the participation, it's been a real struggle. I wouldn't say things are so much better today than they were 7 years ago.
Thank you. Navneet?
So, I mean, we are at other extreme. We look at the US, I mean, there is a leverage at the OpCo level, then there's leverage at the private credit fund level, and there's like, for lack of a better word, something like a CLO. So there are like 3 tiers, and there is so much of leverage there. And of course, you are hearing like some of the challenges of late. In India, we are at the other extreme now because, I mean, you made opening comments that free cash flow is at an all-time high. As percentage of balance sheet, debt to EBITDA is like an all-time low. I mean, equity is available a lot easier. So I think obviously like nobody is looking at leverage, but over a period of time, how do you expand ROEs, margin into asset turn into the leverage? So at some point in time, there would be pressure. As of now, everybody is looking at like raising more equity because that's easily available, but that will change. And in fact, the more equity is available today, and historically, I think one of the criticism in India used to be that even equity is funded by either the banks and then by, in some or the other manner. There was hardly any equity available in the country. Now it's like very good to see that equity capital has become a lot more accessible and affordable and easy. Over a period of time, once you raise so much of equity capital on one side, the demand for that is going to go up and there'll be more comfort. Automatically, the risk premium that would be asked for would be lower. So I think it's just a matter of time. As the capex cycle turns, over a period of time, you'll see more and more credit deals as well. And the good part is that balance sheets are in a great shape. I think both the financial sector as well as the corporate sector balance sheet. In fact, people who look at the valuations today and compare with the historical average, I always say that you also look at the balance sheet quality relative to when you are comparing the P alone, because this time there is no leverage. A small cap P is like substantially higher than the long-term average, but you look at the small cap index, debt to equity is some 0.1 or something. मतलब किसी के पास debt ही नहीं है अभी. So there is like a lot of potential for people to raise that over a period of time, and this will happen, just a matter of time.
Thank you, Mihir. When one has such champion investors on the panel, I think I will be missing something, and we all will be missing something if we don't ask them what are the themes, investing themes, that they are pursuing at this point of time. So we'll start with the private equity side first, and Kunal and Manas, if you can share the investment themes that you are pursuing, where you see great potential over your investment time horizons.
Sure. So I'll take 2 stabs at it. One is, it's not a sector-related theme, but it's more of an India-related theme. And we've seen this play out in IT services, we've seen it play out in pharmaceuticals over the last 20 years. What we are seeing is industry growth is slowing down. IT services maybe from 25 to half of that. Pharmaceuticals industry used to grow at 15+%, is now growing in single digits, high single digits. And still very high return on capital businesses. So the theme that we are looking at here is to say, okay, how can we help these companies on areas other than growth? And even on growth, how can we help them? What's changed is in the last 5-7 years, entrepreneurs have become very receptive to external inputs. Why? Because the easy growth is not there. And there are so many trends because of that. Because the easy growth is not there, the next generation is not necessarily interested in running the business. Because the next generation is not interested, the entrepreneur says, okay, when I want to retire, I'll need to professionalize. Will a professional team work for me or my family, or am I better off using private equity as a change agent? So you're seeing so many of these trends play out, which is driving deal flow to us. For example, Chris Capital has been known for minority investing, but in our Fund 9, we have half our capital in control, because India itself has moved from, let's say, 5-10% control deals to more like 30-40% control deals. So that's one trend that I think will continue playing. And what we are doing there is to say, your organic growth is X%, but you're generating so much cash. If you can do an adjacent acquisition and pump it through your distribution as a pharma company, or have a go-to-market that's broader as an IT services company, you will get faster growth and you will get synergies out of it as well. We've done that with almost all our companies. And in fact, we've even sold to other companies when they've been looking to do this. So we feel this trend will continue. And frankly, if you think about leverage, you'll see a clamor for that as well. When growth slows down, companies want to try all the different levers that they can. Leverage is one that is still not really fully used. Second is a little thematic. We've historically not invested as much in the industrial sector, but we are very actively looking at it, because that's an area where, in some ways, I'd say it's a miss, because there's been some really strong trends in EMS and other areas that we haven't played so far. But we are seeing scale, whether it's the Apple ecosystem, whether it's other areas. We've seen scaled players. We've seen a push from the government to say, look, let's make in India for India. And you'll see that flywheel turn. So that is an area where we think we will be a little bit more represented in Fund 10 than we have in the past.
I'll just pick up from Kunal's point on family businesses, right? And one of the areas we are hunting in very, very actively, global LPs are a little fatigued with one private equity GP selling to the next one, right? And by the time you come to the 4th or 5th sale, there is this feeling that now, what else will you improve? You tell us a good story, but what else will you improve, right? And I think one of the themes that I'm super excited about in India is finally Indian families and children in Indian families are saying, look, I don't want to be in my mom or dad or granddad's shadow, and I want to do something different. And by the way, you have cousins and uncles and aunts. And so private equity actually has a unique opportunity in India to be a solution provider to Indian families that are looking to hand over their business, either fully or partly, to someone who will then be a good custodian of that business, help professionalize the business. Often it's happening in 2 steps or 3 steps. But that's an opportunity that global LPs, by the way, when you talk about this to global investors, they love the fact that India is a primary buyout opportunity. Also corporate carve-outs, right? Like situations where you have all these like conglomerates and where you have all these subsidiaries, many of them are not strategic, many of them are available. And so those are the areas from a control perspective where I'm excited about hunting because you have so much you can do with those companies and those businesses.
Thank you for that. I will now request Navneet and Mihir to share the themes that they are pursuing.
In fact, taking the point from my friends on the private equity side, I've been saying for over a decade now that there are so many changes in the world. The world is transforming at such a rapid pace. It's geopolitically realigning, demographically diverging, digitally redesigning, climate change is for real. And in all of this, I think the management which are more nimble and agile would continue to trade at a substantial premium to those who have size and stability. Size and stability is not a guarantee of of success going forward. You need to be nimble and agile. And I think we are clearly seeing in the market behavior of late, and that will continue. And there are like opportunities at many places. I'll give you one on the AI side. And like before that, I think the resurgence in manufacturing, agree with him. There are like lots of opportunities that we'll see over the next several years, and government is determined. I mean, whether you look at the labor code and many other efforts they have been making, I think there is a genuine effort this time, both at the central and many things that are happening at the state level. I think one data center project won by Andhra Pradesh, putting so much of political pressure on the governments of Karnataka, Tamil Nadu, and others that how could we miss it, and then next time we need to get that. There's a great thing that's happening in the country. I think the whole the competition among the states is a great thing happening, and that will make it that journey easier. The other is on the consumer side. I think the three big trends, and I've just like created this acronym that I think it's a care, convenience, and compound. You can see the big changes in the consumer over the next several years, and you look at the demographics and the per capita and the pyramid. With the next several years, people are spending a lot more on caring, whether it's like preemptive or in terms of healthcare, many other things. They want to take care of themselves better. They want things to be more convenient, right? Delivered everything. I come from a generation where we had to wait for months, if not years, for a telephone connection, and today you want everything in like 10 minutes. And maybe there are 20 other examples of that. And third is a compound that people want to make money. People think that their money needs to make more money. So nation is transforming from a nation of savers to a nation of investors. And I think this is just beginning. This is just beginning, has a long way to go. On the AI, I'll make one point that if you compare the previous bull market, and you've been around for 40 years, Utpal, you have seen this, that, and forget the 92 and 84. If you look at 99, 2000, we were exactly like NASDAQ. So it was the same TMT trade here. And we rose and we fell with the NASDAQ. And it was like there was no question of any decoupling. We look at the 2005, 6, 7 bull market and India's market, we were very similar to the big rally of the emerging markets. People have forgotten. I have always asked them, what do you think was the first $1 trillion company in the world? People say, was it NVIDIA? Was it Apple? Was it Amazon? Was it Alphabet? I said, nahi, PetroChina in 2007. That was the first $1 trillion company. And same trade in India. Capital goods, engineering, construction, real estate, all of those like in India. So we rose with China, we fell with like China. It was same trade. This is the first time, we look at this year, MSCI Europe up 13%, MSCI US up 15%, MSCI World up 18%, MSCI Japan up 20%, MSCI EM up 28%, Korea is off the chart, and like MSCI India 8%. There is no AI trade in India. This is the first time, and it's not by, I don't know, by accident ho gaya ki design, humne miss kar diya wo. But it can actually be a blessing in disguise. I asked who was the biggest beneficiary. AI is much bigger than internet. It's the most underhyped thing, but it's overhyped on the stock side. I asked people who was the biggest beneficiary of internet, and they say, of course, Meta, Amazon, Alphabet, these companies wouldn't have been if internet wasn't there, right? And I said one of the biggest beneficiary was HDFC Bank. Because but for the internet, the success would have been very different. Internet really gave them a big opportunity to do something that would have taken much longer than what they did. AI is very similar. We are not investing in that horizontal, which requires like all the infrastructure, where the world will deploy hundreds of billions of dollars, if not the trillions of dollars. But I think we will be the use case capital of the world. And there could be many businesses who will benefit immensely from the right leverage on the AI investment which is happening elsewhere. So the Cisco and the WorldCom and Nortel and Corning and all of those guys invested billions of dollars. We were like a big beneficiary of that. On top of that, so of course the IT services, some of these other businesses that benefited. Then you had the next leg of DPI, which gave birth to like many of the other consumer tech, fintech and all. The next leg is very similar, where world is investing in something and will create outstanding, great businesses on that.
Thank you, Navneet. Mihir, yours.
I totally agree with Navneet that we'll be the use case capital of the world. For example, what we are doing with UPI It's already being exported. Some of our R&T companies are now providing services to other countries, mutual funds, etc. So I think we are going to be the services capital, like the use case capital of the world, because we have the biggest laboratory of consumers to test it with at low cost. So that's one big theme. I agree. But my view is that if we have to grow at anything more than 5.5% GDP growth for the next 5, 10, 20 years, it has to be on the back of manufacturing and asset creation. So we've horribly underinvested in infrastructure, in manufacturing, etc. And of course, the government now realizes it. But everything to do with the manufacturing ecosystem, whether it's for domestic to domestic manufacturing or domestic to export manufacturing, that has to do well. And I think the government is doing the right things to take care of that. So we are talking about capital goods, construction, real estate, infrastructure, renewables, defense, T&D. The renewables will need a lot of additional expenditure in T&D. So I think this segment has to grow at significantly higher than GDP growth for the overall GDP growth to be anywhere close to 7%. So that's one big theme we are looking at. And of course, I think Navneet only touched upon consumption and different, but we are definitely looking at premium consumption categories growing much faster over the longer term. Similarly, as savings pool is increasing, capital market plays, whether it's broking, insurance, wealth management, asset management, R&T agents, exchanges, depositories, all the ecosystem which caters to savings will grow probably faster than the banking system or the NBFC system, because that growth rate in this savings pool is much higher. So these are some of the themes we are looking at. And of course, we love the new age companies which are using technology to either disrupt or create new business models. And I mean, in my previous avatar in insurance, we used to invest in AIFs and PE funds. And the kind of flow that I could see, the kind of portfolios that I saw in the VC funds, the PE funds, I'm sure there'll be dozens of new listings coming up in the next few years in this space.
Thank you, Mihir. That's very helpful. Friends, we've had a wonderful session today with these champion investors, and I'm sure there's a lot for all of us to take away. But the biggest takeaway is that we are up for exciting times ahead. So hang on and make the most of it. Thank you very much. And a special thank you to each of these 4 investors who've also been my friends for a long, long time. I've learned so much from them, and I continue to learn from them. Thank you.
What a wonderful panel, ladies and gentlemen. Inviting Nipa Sheth to please join us on stage to felicitate the Honorable Moderator and the esteemed panelists. Thank you all so very much. A round of applause, please, for our esteemed panelists there, and Mr. Utpal Sheth for so ably steering this session. You all can share your experiences, your thoughts, your views on IDCMS using the hashtag TrustIDCMS25 on social media. We'd love to see what you thought of today's day, the 5th edition of this summit. A photograph to mark this session, and tokens of our affections to the panelists presented by Nipa Sheth. Thank you very much to Mr. Navneet Munot, Mr. Manas Tandon, Mr. Mihir Vora, and Mr. Kunal Shroff. And of course, thank you to Mr. Utpal Sheth for moderating this session. And I hope you get that picture. And that's what they call a happy ending to a great day at conferencing, ladies and gentlemen. Come together for a group photograph, please. While I invite on stage Pranav Inamdar for the vote of thanks of the 5th edition, a day of conferencing at IDCMS 2025. Thank you all.
Good evening, ladies and gentlemen. Today has been a testament to what happens when you have market leaders, innovators, and long-term partners come together. Thank you for being part of the conversations that contribute to shape the future of the Indian debt capital market. Special thanks to our distinguished speakers, valued investors, valued issuers, and all delegates and interface participants. Thank you for lending your intellect, experience, and presence. A special thanks to our media partners and our event agency, CAB Experiences. A big and a special thank you to all our internal teams, especially the core team, which has worked relentlessly over the months to shape a successful IDCMS 2025. Thank you once again, ladies and gentlemen, and please join us for cocktails and dinner. We are not yet done. Thank you.
And thank you to you. I'm going to invite the entire team of Trust to step on stage for a photograph, please. Ladies and gentlemen, for all of you, thank you for being here for the 5th edition of IDCMS. Cocktails and dinner will be served soon. Please enjoy yourselves. We have some fabulous entertainment lined up for you in the evening ahead, a short while from now. This is your host, Geetika Ganjudhar, saying, yes, my job is done, but your party and my party has just begun. Let's enjoy ourselves, the 5th edition of IDCMS. Zordar Thalia. Namaste.